It's a Friday. Usually it means risk off. But Guy, we're heading towards the Open.
We are. 20 seconds to go. A little bit of an orange twist into the weekend with the Campari numbers to think about. But what we are watching definitely is what is going to be happening in Geneva. That's the trade. In some ways, everything else doesn't really matter. Some of the single stock stories are going to be interesting in terms of the overall picture. IAG is interesting. The positive story on the transatlantic certainly helps. Echoing sounds coming out of Tim Clark, I would argue, over at Emirates as well on the premium story. But here we go. The Friday trade is almost upon us. Trade being the operative word. The FTSE 100 absolutely flat as a pancake right now. Not much movement after the trade deal that we saw yesterday. May I mention the Bank of England as well. So not much movement there. We'll keep an eye on what is happening on the broader picture with the Stock 600. It is up by a measly 0.1%. Market doesn't feel like it wants to have a strong sense of direction this morning, certainly at an index level. Single stocks might be a little bit different, but it feels like it's a macro rather than a micro day. The IBEX is up by a staggering 0.1%, but the DAX actually out early, up by 0.5%, and the CAC 40 is also up by 0.5% as well. So the German market and the French market, a little bit of outperformance coming through this morning, Lizzie.
Yeah, break it down by sector across the continent. You've got about 3/4 in positive territory this morning. So energy leading the gains at the moment. That's up 0.7%. You've got autos and parts not far behind, up 0.6%. Middle of the road banks, and we talked about Commerzbank beating expectations across the board, really. Commerzbank shares up 0.7%. Bottom of the basket, though, insurance and real estate, as well as telecoms this morning. But generally, positive sentiment as we head towards the weekend, Chrissy.
It's fascinating here because when we talk about the individual movers, right off the bat, I'm seeing a reversal of the move we've seen in the last couple of days in terms of the healthcare story. And I think that's crucial because we've seen Novo Nordisk take a hit. We've seen AstraZeneca. I mean, 24 hours ago, this is the exact conversation we were talking about. They are your biggest index gainers this morning in terms of contribution. I think that is going to be a crucial piece. I don't want to dive into details too much. I imagine Joe will do this later for us. But BP also higher by about 1.8%. Some drama in terms of what the deal making behind the scenes may actually look like. And I imagine Glencore probably taking its cue from that story as well. And then a slew of Italian banking earnings that are actually kind of in the positive direction. So Guy, I think outside of the sentiment story, there's a couple of earnings and sector stories that are also perhaps positive.
The BP story, I think, is interesting, and certainly the noise is gathering around that narrative of a possible takeout. Shell is up, BP is trading higher as well, but you've also had a move in the oil price, which you want to pay attention to too. So that's moving that sector quite significantly. There is a little movement in some of the pharma stocks, maybe a little bit of a reversal, maybe an opportunity around there. Novo and Roche are both higher. There's some ex-dividends at the other end, so I'm not going to get too excited about that. But this is a market, let's take a step back. This is a market that's got 428 up, 149 down. There's enough down to basically balance out the up, which is interesting. So some of the bigger stocks are seeing some weakness. And it's fascinating. The market's going nowhere. This is not a market. This is not an equity market here in Europe that I think has a clear sense of what is going to come out of this weekend, that has a clear sense that you want to take that risk trade on board and talk about the idea that you are going to see some sort of bounce on the back of anything positive happening. Is the risk of something negative happening or nothing happening just too big to keep everybody on the sidelines at the moment?
So you have no idea, I have no idea, the market has no idea. Let's see if our next guest does. Hi, Will Franklin, head of European equities at Mirabad Asset Management, joins the program this morning, joins us around the table. Pleasure to have you. You've picked a great day because...
Good morning, Trudy.
Good morning. As in, it feels like nothing's happening, but everything's happening at the same time. So what do you do with risk going into a weekend like this?
So, Trudy, I think one of the key things right now is investors are trying to work out, what does it mean? What is, Trump's real strategy here? And what's the way forward? And for me, what's really critical is we've got to look at what kind of expectations are embedded in the market now. If we look at investor positioning across the board, it's clear we're still really heavily skewed towards the US. The US is still on very high valuations, kind of 20+ times earnings if we look at this year. And, we've seen it recoup a lot of the losses, since Liberation Day. And for me, one of the key things is really for Europe, expectations are still quite low, valuations are still quite low, and irrespective kind of what comes out of the weekend, it's clear that there is a bit more scope for maybe things to go a bit more right in Europe, and people are starting to question still the environment around US growth and some of what the impacts will be of the trade negotiations. So for me, in short, we've got finely balanced kind of expectations in the very near term, but in terms of the level of valuations in markets, there's a much stronger signal there.
So what is, I will ask a broad question here, take it where you will. What's the secret sauce to alpha right now?
The secret sauce to alpha, I mean, if we could bottle that, we'd all be doing quite well. I think, for me, again, one of the keys is really taking a longer-term perspective. We've got some areas of the market which have really driven very strong long-term performance, and which are now really under the cosh. So if we take a long-term view, as we mentioned,
give us an example. Give us a sector. Give us some direction here.
Okay, right. So what really stands out is the smaller end of the cap scale for us. So we've seen, as I just mentioned, Europe looking at a big discount to the US. What really jumps out is the small end is really trading at financial crisis levels of discount relative to the large caps. And so while we've seen sentiment starting to improve in Europe, I think the DAX is up almost 30% if we look at it in dollars year to date. We've still seen people have started to reinvest in Europe, but the smaller end is just starting to catch that bid. So that's one of the areas we find quite attractive.
If we zoom in particularly on the UK, does all this progress, being the front of the queue when it comes to the US, getting the India deal as well, does that actually make any difference when it comes to your view on UK equities, or does it even matter?
So, Lizzie, I think one of the things we've been worried about in markets, just this uncertainty. What's the kind of the end point as far as the UK is concerned? There is just so much skepticism priced into that market if we look at it in global terms, and getting a bit more certainty about what the kind of off-ramp looks like, what the environment will be for companies to invest in. I think that's got to be good for UK equities, for European equities, because there is just so much risk priced in there. So yes, I think the trade negotiations and the agreements are going to be good for sentiment towards the UK and Europe more broadly.
Is US exceptionalism over?
Well, I think if you look at what's now being forecast, let's think about the underpinnings of US exceptionalism. It's all been about stronger growth rates, a more dynamic economy, innovation, and the role of the US dollar. And actually, we're seeing some of these key planks starting to be eroded, guys. So I think if we look at now the fact that we've got the Fed being questioned, the judiciary system being questioned in the US, and we look at forecasts for Europe starting to converge a bit more to the US, there is a real question now in investors' minds about whether they should be as heavily invested in the US. And if we look in global terms, that weighting of the US, that exposure of the US, which investors have, is at really quite unprecedented levels still. So what we see when we're talking to clients is that there are a lot of them who are wondering why they want to have 3/4 of their eggs in that one basket, and whether it's not time to consider other areas.
Hywel, thanks very much. Thanks for joining us this morning. Hywel Franklin, Head of European Equities at Mirabaud Asset Management. Core 6 looks like this morning. Let's take a look at how the pharma stocks in particular are performing. As you can see, you've got some upside in pharma. It's quite decent upside. LVMH also rising quite nicely. You do see some mild weakness maybe in some of the chips this morning. ASML's a little soft. But broadly, this is a market that feels like it's slightly on the front foot, tiptoeing onto the front foot as we wait to see what happens this weekend. Let's talk about some of the other stocks we're watching so carefully this morning. Joe Easton is here with the detail, and we start with IAG.
So IAG pretty volatile at the open of trading go. We're actually edging higher into the open now, coming down pretty significantly, actually losing around 1.3% at the moment. Now, we did have that big rally at the back end of last year, of course, and also some of the comments around the premium offering, the first class, business class cabins, as Guy mentioned earlier, not the first airline to flag strength there. So potentially some of this just priced in. But overall, the earnings were looking pretty good. And of course, we did have that big news around the plane order as well. So potentially that factored in. But IAG kind of surprising a little bit, coming down very slightly today, around 1.6% at the moment. Then in terms of commerce, that was a beat across the board, as we said, particularly in the net income level, but it has had a decent run over the past few years, actually rising around fourfold on a 3-year basis. We're only up around 1%, but still not a bad return for that one. Then more misery for Campari. The stock down once again, already was down around 50% over the past couple of years. Another weak update, warning of softness, not drinking enough Aperol Spritz. Of course, probably not the right season. Well, maybe coming into the right season for it at the moment. But the Aperol maker hit again, warning of geopolitical and macroeconomic uncertainty weighing on the drinks market at the moment. Then take a look at Bavarian Nordic. This is the best performer today over in the health space. Only around a 2 billion market cap, but this is the vaccine maker. Did well on the Mpox vaccine, and a strong update from them once again over in Denmark. That one really rallying. We're up 13% for Bavarian Nordic today. And then finally, just to end on BP, as was mentioned earlier on a few moments ago in the show. So the latest news on this coming from the FT, a report saying that other companies, including ExxonMobil, also Total and even ADNOC, potentially looking at just how this stock is developing in terms of whether it could then be a takeover target. Of course, we had the Bloomberg report of Shell looking at this over the weekend, and looks like a little follow-on, and also the higher oil price as mentioned. But BP up 1.4% in London this morning.
All right, Joe Easton from our equities team, we thank you so much for walking us through some of those early movers. Coming up on the program, we're going to continue the conversation around the corporates and dive into more of the earnings. A boost for Commerzbank's CEO as she tries to fend off a UniCredit takeover. We're going to dive into the results from the German lender and some of its Italian peers. This is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
Bloomberg Bloomberg surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern. Only on Bloomberg. Context changes everything.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly. There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Welcome back to the opening trade. We're 15 minutes into today's session, and it's green across the screen for European equities. The stock 600 up 0.4%. Outperformance in France and Germany this morning. But if we flip over to the bond space, gilts outperforming this morning. Well, they have been. Earlier on, they'd been up 4 basis points on the 2-year at 3.97%, the highest in 3 weeks. It's down now, so we're at 2 basis points higher at 3.95%. Really, yields higher across the curve, across the continent, and it feels like it's a follow-through, surely, from the risk-on mood yesterday because of Trump saying, you know, buy stocks, we're going to get progress on the US-China trade talks. You're seeing the read-through here, and, of course, the BOE move yesterday.
Well, the BOE, gilts, you would have thought would be underperforming right now, which is the logical trade. So they continue to do so. Yields are higher, prices are lower. We're trying to figure out kind of where we go ultimately with the Bank of England. What were they trying to signal yesterday? Was it a more hawkish tone going forward? Do ultimately, if the data turn lower globally, do we see the Bank of England being forced to make more aggressive cuts? And there was talk of 50 basis points yesterday, and we ended up with completely the other end of the spectrum, which is a much more hawkish split. The governor always talks about the fact that the split is a mechanism for communicating. What were they trying to communicate yesterday?
Well, surely he says that it's not a mechanism of communication.
He's told me that it is, but okay.
I think it sometimes is when he wants it to be.
Yeah.
Look, I think it was hawkish in that we didn't expect people to be voting to hold.
Yeah.
And actually, if you look at the minutes, were it not for Donald Trump, they would have held. And so actually, you know, this is something that's an imported problem. It's a temporary problem, hence why it's a Trump cut. And the fact that they didn't even change the guidance was, you know, that was going to be another dovish twist. That didn't happen, hence why I think the market read it hawkishly.
I'm looking at a cable right now at 132. I feel like is
the pound in theory should get stronger from here, right?
Exactly.
That should be the trend.
And because especially when we're talking to Elsa Ligos about this, about kind of the dynamics that are potentially driving the euro higher and the positioning there, the pound isn't necessarily a part of that trade, although it feels like it should be.
Yeah, but, you know, is it surely not more the optimism around the US taking steps ahead rather than the pound? It's more a dollar story than the pound in itself.
Yeah, the dollar certainly rose. So how much further has the dollar got to go? Like in the short term, I think you've got to think about the short term, medium and long term and try and work out what it's going to do. Short term, you've seen a fairly big more positive dollar move coming out of this week. The back end of this week, but the front end of the week it was quite negative. So short term, and Nelson was talking about this, are we in a period of kind of consolidation right now? Yeah. Ultimately, though, the trade is for more dollar weakness coming down the pike towards us. The pound sits kind of somewhere between the euro and the dollar. Where does that ultimately leave it? Well, I think normally it would leave it kind of somewhere in the middle, but I think with a slightly more hawkish Bank of England, the pound may actually have more positivity behind it going forward. Negative for gilts, positive for the pound. In some ways, that's not great news for the UK economy and not great news for the government either.
And that's just the monetary policy of this all. We didn't even talk to Elsa about the fact that euro sterling may be in focus simply as a function of a trade deal and softer relations with the UK and not so much with the EU. That's the bond market story. Let's go back to the equity market here and talk about one of the major earnings stories coming out this morning. Commerzbank shares higher after reporting an unexpected first quarter profit beat to the tune of a higher by 1.7%. We spoke to the CEO, Bettina Orlopp, about the results.
This is why we also improved our guidance for next year with respect to GDP. And given that we are financing, for example, 30% of German Mittelstand, it will also have a positive impact on Commerzbank, that's for sure.
Bloomberg's Charlie Wells monitoring all the banks for us. Let's start with Commerzbank here. Walk us through those results.
I mean, Kriti, you can see that their CEO is clearly thrilled there, Bettina Orlopp. She's been in the job about 7 months, and she has had to contend with this takeover bid from UniCredit. She's had to navigate the elections, this new, German government coming in, which looks positive for them, but still something to navigate. And you can just see this sense of relief. This first quarter, profit, they're the highest in 14 years. There had been concerns about net interest income. This is a bank that was really boosted when rates went up, and the concern was as rates started trending down, this could be hard on them. But so far, she was talking about how they have a really well-diversified loan portfolio. They're seeing strength. They're seeing their guidance maintained in 2025, and then optimism on that German defense spending. So this is certainly the sort of report that they needed as they try to bolster themselves against that UniCredit bid.
Okay, let's go to the other side of the fence. What's going on in Italy?
Yeah, so M&A wave really dominating the country, and we've got some of these key players who are in this M&A wave reporting today. We had Monte Paschi, we had Mediobanca. They beat. We've got Banca Generali coming this morning as well. And I think this is just a kind of transitional moment in Italian finance. And I think that's what everyone's going to be listening for as these executives start talking about this M&A wave. How likely does it seem that this could happen? Because this is not just about the markets. There's politics coming into play here too as well.
So what are we expecting from those UniCredit earnings on morning on the other side of the fence?
Yeah, so look, the year has been pretty good for Orcel. I mean, he's got the difficulty of this M&A that, he really kind of came into the position trying to orchestrate cross-border with Commerzbank, of course, but then also with BPM. Those are moving more slowly than I think a lot of people anticipated. And that's not great news, right? Because the longer this takes, the more uncertainty there is. So I think the huge focus for investors on Monday when UniCredit reports is going to be how they talk about M&A.
And already, UniCredit, and we're seeing headlines that have crossed the terminal in the last 20 minutes or so, receiving the ECB's okay for a second tranche of their 2024 buybacks. Buybacks to start immediately following the BPM bid completion. Whether or not we get that completion is a different story, but the fact that buybacks would be right off the back of it is crucial. Charlie, you've been covering all of these banks from Germany to Italy and frankly all across the continent, arguably the U.S. as well. It feels like buybacks and shareholder returns don't usually happen at the same time as M&A. And yet, these European banks are so flush with cash, they're just kind of throwing it everywhere. And these profit numbers that you just outlined seem like a green light to be doing more of that.
Yeah, I mean, I think at a time when net interest income, I think everyone is thinking it could come under threat, this capital allocation becomes so important for these banks, right? And so kind of how they're going to allocate that, how they're going to please shareholders, keep them coming. Because, banking has been the top performing sector in the Stock 600. But I think that doesn't mean that there's not, headwinds coming, right? Because a lot of these European banks, they've been boosted by the optimism of Germany. They've been boosted by this story of, increased defense spending in Europe, but there's also these trade tensions to contend with. So I think, it's looking great this morning. These earnings reports coming from Germany, from Italy are really solid, but it's that second half of the year that there's still questions about.
Charlie, great stuff. Thank you very much indeed. Charlie Wells on what is happening in the banking space. Let's turn our attention to what is happening in the aviation space, one of my favourite subjects. I like banking, but I really like aeroplanes. IAG announcing a major order for wide-body jets this morning, doubling down on a long-haul business with a $10 billion fleet investment to help sustain its earnings momentum. It's buying from Boeing, and significantly, actually, this morning, it is buying from Airbus. Let's bring in our aerospace reporter, Kate Duffy, to get a take on what is happening here. Kate, what's the story out of IAG this morning? Is it the fact that they've stuck to guidance? Is it the fact that actually they're seeing the front of the plane relatively full and actually the numbers look good? Or is it this commitment to the future and this slightly bigger than anticipated order for wide bodies?
I think it's fair to say it's absolutely this order that's taken us by surprise. It was the US that really teased the order yesterday, saying an unnamed British airline would buy $10 billion worth of Boeing planes as part of this trade deal with the UK. And shortly after, our team broke the news that it would be IAG, about 30 Boeing 787s and then some A330s. And IAG announced today that it was 71 aircraft in total that they're going to be ordering. So there were actually a few that they snuck in around March time. But the fresh order is 32 Boeing and 21 Airbus. And these planes will be spread across British Airways, Iberia, Aer Lingus and Level. And the majority will be going to BA in total. This was widely expected. You know, Gallego, the CEO, he did say in the last earnings that he was looking to buy more wide bodies. But yeah, it was a really exciting evening yesterday to report on.
Well, where you've got a carve-out for Boeing in this US-UK trade deal, morning, Kate, is that a signal that there are going to be more carve-outs for Boeing in the, say, US-China, US-EU deals going forward? Is that clearly a priority for the US?
Potentially. I mean, the order marks a huge win for Trump and Boeing. And since the tariffs have been announced, you know, the aviation industry has been quite concerned about how they'll fare, given aerospace parts are sort of a major component of US exports to the EU and sort of beyond that as well. And both numbers of carriers, both sides of the transatlantic, have said that they're not going to accept additional tariff charges on their planes. So yes, this could facilitate more orders for Boeing potentially, but we're yet to see.
Kate, do you think Louise had already got this order lined up? We saw all obviously the sound and fury around yesterday, and as you say, it was an exciting afternoon. But nevertheless, these orders take a while to negotiate, and I'm assuming that they've probably been a long time gestating, and IAG have thought about this quite a lot. Are there extra Boeing aircraft in here as a result of the trade deal, or was this an order that was going to get announced at some point in the relatively near future? In fact, on a day of IAG reporting the corporate numbers, probably the right time to do it.
Yeah, it's absolutely good timing. I mean, Gallego said on the call earlier this morning that it was a long time coming. The order started a long time ago, so definitely good timing for both sides of the coin.
Okay. Kate, we will leave it there. Thank you very much indeed. Kate Duffy, our aerospace reporter, joining us in London. Exciting afternoon, trying to work out who was going to be buying what and which airline it was likely to be. It was probably always likely to be IAG that was making this kind of scale of an order coming through from Boeing. But it is, so it's really significant. Two things that really stand out today, one of which is the North Atlantic actually is doing okay.
Yeah.
Which actually the data that we've seen maybe suggests that actually fewer people are flying to the United States and vice versa. So that's quite interesting as well. But the front end is holding up as well, which is a really useful consumer signal. The high-end consumer is still spending, and Sir Tim Clark was saying the same thing at Emirates. People are switching to the front end of the aircraft, which is quite a positive sign for what happens in terms of the consumer story, Lizzie.
Well, coming up on the programme, President Trump hails a, quote, historic trade deal with the UK, but the details leave some disappointed. We're going to get the view from John Alty, a former UK Director General for Trade Policy. This is Bloomberg.
What makes it India's time?
It's us women who are going to transform India. I truly feel that the time for Indian women has come. They're not only breaking glass ceilings, but they are redefining, you know, whether it is in sport, whether it's in medicine, whether it's in creative arts. They are everywhere, and I have so much positive energy that comes back to me when I'm talking to Indian women. And I just think at all these little girls and boys, I don't want to discriminate, who are now in school-going age. Imagine once education, sports, we empower them. What a difference they would make not only to India but to the planet and the world. And the world needs it now than ever before.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
This is a maxed out deal that we're going to make bigger. And we make it bigger through growth. I think it's going to be something very special for UK and special for the United States.
We've agreed the basis of a historic economic prosperity deal. And that is a deal that will protect British businesses and save thousands of jobs in Britain. Really important, skilled, well-paid jobs.
The UK Prime Minister and the President Trump hailing yesterday's announcement of a trade pact, framework, deal, whatever you want to call it, between their two countries. It's taken 5 years to negotiate, but it does fall short of a full and comprehensive deal. Let's get more now with John Alty, who knows a thing or two about trade. He's senior advisor at Pagefield now, but previously he served in the UK government as Director General for Trade Policy at the Department for International Trade. John, really good to have you with us around the table. How do you see this deal? Is it actually meaningful? Is it just one step forward after 2 steps back?
I mean, it's really important for the sectors such as cars and steel, which were facing very high tariffs. It's quite limited in its scope, and obviously both sides are saying that it should be the start of a wider negotiation. So we look forward to seeing that. In terms of whether it fully recovers the position, no, not the position before Trump, but given Trump's view on trade, you have to be realistic.
I mean, you were at the Trade Department from 2016 to 2021. I hate to, bring it up, but there wasn't a trade deal with the US in all of that time. What made the difference? Can Starmer be taking credit for this personally? Does it vindicate his kind of softly approach with President Trump?
Well, I'm sure, it's the first deal the Americans have done. So, you should be able to draw some positive conclusions from that. In terms of the previous Trump administration and the negotiations then, they were far more wide-ranging, and they started very late in Trump's presidency. So they started, 8 or 9 months before he left office. To do a trade deal in 8 or 9 months, a comprehensive trade deal, is pretty difficult.
Okay, which is interesting. So what is the usefulness of what we've just seen out of the UK in relation to the rest of the world? There is this expectation that the White House is going to be doing trade deals with around the world, with lots of different countries, and you're saying that 8 or 9 months is an awfully long time, is an awfully short time to get a trade deal done. How long does it take to get a trade deal done?
Well, it depends on the scope of the trade deal. And,
okay. How long will it take to get a trade deal done between the United States and India, or Japan, or South Korea?
Well, often these deals take years. I mean, India in particular has been negotiating for over a decade with the European Union. The EU is also negotiating with Mercosur, that's Latin America, for about 25 years. So it depends on political will, frankly.
Right. And going into this weekend, therefore, with China, what shall I expect? What shall I be looking for in terms of what we should get out of that?
I mean, I would be very surprised if I look to be surprised, maybe, but I'd be very surprised if at this first meeting you get more than a sort of indication of the mood music, and is this going somewhere or are they flouncing out? I mean, both of those are possible.
Well, John, so much from the part that we discussed this earlier, the part of the UK-US trade deal that stuck out to me, even if it was just an early framework of this, was the fact that you are now seeing potentially barriers of US exports to the UK pulled down, whether that's in agriculture, whether that's in exports, et cetera. You mentioned India and the EU. India's #1 issue has always been this massive protectionism to support and to protect its domestic economy. I think the biggest, for me, I always remember my parents, for example, talking about there not being an IKEA in New Delhi. And that's a great example of not letting those kind of European companies in. Donald Trump has a manufacturing-first trade agenda.
Yeah.
How important is it that trade leaders, whether it's from the European Union, the UK, India, or whatever, come out and say, from the get-go, here's what we're going to buy from you?
Well, I think it probably is important. I mean, I thought one of the intriguing points was the order of the Boeing aircraft because it's, that's an order by a private sector company. It's not the government buying, but it's obviously being coordinated to some extent. And that is exactly what I would expect countries negotiating with the US and Donald Trump to be doing.
But it's interesting. So I suspect the CEO of IAG was already going to order those aircraft. Like, how much of this is real, and how much of this is dressing up for the cameras and trying to get some sort of positive momentum? What effect do things like that have? Even though they are completely unrelated, they obviously have a sort of halo effect.
Well, whenever you see ministers going abroad, never mind concluding a trade agreement with a delegation of businesses, they always want to announce like billions of pounds of deals.
Yeah.
Those deals were probably going to happen anyway. They've probably been announced already.
Yeah.
But it's part of the choreography. So, and VE Day, the choreography is important, I think, to the president and probably to all politicians.
So what can the U.S. offer the rest of the world here then, in terms of actual goods purchases? I'll take the services, I'll take the taxes, I'll take the intellectual property out of it for right now. In terms of actual goods, what does the rest of the world want from America?
Well, I mean, there are restrictions in the US. They don't so much tend to be tariffs, although there are some products with high tariffs in the US, like light trucks, etc. But, there are restrictions on maritime trade. There's arrangements about their intellectual property rules, which are problematic for the UK music industry, for instance. So that's why I said these are the sort of things that do not get sorted out in 4 weeks. They can take 4 years, but hopefully they can be done quicker.
Yeah, can I talk about one of those things that hasn't been sorted yet, the digital services tax?
Yeah.
What should the UK be giving away to the US, on the flip side of Critty's question, for more lenience here? Because, we can't really afford to lower or abolish the digital services tax, can we?
Well, I mean, that's obviously a question for the government, and it would be very politically unpopular if they did abolish it. I mean, it's meant to be an interim measure for an international agreement, but the international agreement doesn't look like it's ever going to come. So I think they will I mean, it's interesting that nothing was done on that. But there are other things. I mean, we still have a 10% tariff on US cars coming into the UK, just as the US has a 10% tariff on us. There's no reason we couldn't reduce that tariff. We still have very high tariffs in our agriculture sector, which is a sensitive sector, but as we've seen, the government has opened that up a bit, as long as we keep our regulatory system, our safety standards. So Donald Trump seems to be focused on goods mostly, so I would suggest we should focus on the things that will allow more American goods to come into the UK.
What about agricultural goods? Because we were talking earlier about lowering the barriers, tariff barriers, but as I'm sure you did last night, dug into the weeds of the non-tariff barriers, do you see cause for concern aligned with what the papers would be worried about, which is hormone-fed beef and chlorinated chicken?
Well, again, the government's not changed anything there, and the previous government was saying it wouldn't change anything there. Obviously, this also links to the negotiations with the EU, because if we want a better veterinary arrangement, we want to make it easier for our exports of food and drink to go to the EU, we do need to stick pretty much to the EU standards, which don't allow hormones or chlorinated chicken. So I don't think that's going to change, but tariffs is a different matter.
Thanks for stopping by to see us. Thanks for updating us. Thanks for the knowledge and the experience of what happens in these kinds of negotiations. John Alty, Patriot's Senior Advisor and former Director General of the Trade Policy at the UK Government. Thank you very much indeed. Coming up, Moody's ratings warning of rising risks as retail investors flock to private markets. We'll talk about that story next. This is Bloomberg.
What would it mean for India to host the Olympics?
Heslinda, I don't think it's my dream alone. I think it's a dream of 1.4 billion Indians to see the Olympics being held in India. I think once sport takes over, the transformation will be seen, not only in the lives of the youths, but in the economy of our country. India is one of the biggest centers for digital usage, and 1/3 of the viewership of the Olympic channel comes from India. So India as a sporting market is huge.
Countries which have hosted the Olympics have always grappled with the issue of infrastructure, for instance. Building it is one thing, maintaining it is another. How can India do it differently if it were to host the Olympics?
So I think we're talking about innovation and sustainability. And I think the same holds for holding the Olympics. What if you look at a sustainable model? What if you look at refurbishing old stadiums, reusing what we have? So I think the move has to be a sustainable move.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bring you up-to-the-minute geopolitical news wherever and whenever it happens. I'm Anne-Marie Hordern in Buenos Aires, Argentina, and this is Bloomberg.
our clients globally are wondering whether they need to back off on how much exposure they have to the U.S.
It's created a significant opportunity so far.
Find better opportunity to invest than the weaker credit at this stage of the business cycle.
We had this dry powder to step up and provide liquidity when other people couldn't.
We have $13 billion of dry powder. Very much open for business, very interested in providing that capital.
Private credit comes up in every meeting that we have here at the conference, and there are certain slivers of the private credit market that would do quite well in an area of lower growth or uncertainty.
They all sound really positive, don't they? Really positive. Attendees at this week's Milken Institute Global Conference taking place in California, giving us a sense of how the credit markets see the world right now. Like equity-like in some ways, you could argue, in terms of the positivity that maybe is coming through there. Mark Pinto, Global Head of Private Credit at Moody's Ratings, joining us around the table. Good morning.
Good morning.
You had a conference here in London.
We did, absolutely.
What was the mood like there?
You know, it was pretty optimistic, I would say as well. But one interesting thing is we asked the audience when they came in, would the volatility that we're all experiencing today, would it be beneficial for private credit or would it potentially be damaging? And the audience was split right down the middle. So,
is that a surprise?
It was to some extent, but I think that it might have reflected the audience in the sense that I think a number of the people in the room were fairly familiar with what's going on in private credit, and there was probably a big swath of people who are kind of looking at this for the first time, and I think they're probably a little bit more cautious.
Everybody's so it's interesting actually you talk about this split within the room, because I think there's a sense of a split within the market, and Moody's highlighted this this week, that there is this. You have the situation in private credit where retail is starting to come in.
Yes.
There's this kind of idea that retail is starting to become a bigger force within this space. But on the other hand, you've got quite lumpy assets. And so you're ending up in what is a classic within financial markets of kind of a short-term liquidity story, which retail thinks it has, and a longer-term liquidity that the industry thinks it has. And the two aren't necessarily seeing eye to eye right now. How big a risk is that?
It is definitely a risk. It's interesting because when the private credit sponsors started talking about the retailization, if you will, of this market, there were, in my own mind, we thought, well, if this happens, it's no longer a question of if, it's when. And the important thing, as you mentioned, is how, because we're dealing with illiquid assets, so you're going to need more transparency, you're going to need more education. I think that's key.
How does that set up the relationship with some of the traditional banks that have always been kind of the key lenders, at least pre-GFC? And it feels like they've taken a step back. Private credit has come in, but the risk you run with that, and I think Jamie Dimon had made a comment like a year ago comparing the private credit space to the mortgage crisis, the risk you run with that is the illiquidity of all of it. That if something were to go wrong, the banks can maneuver faster than these private credit players. How fair is that?
I don't know that that's completely fair, to tell you the truth.
Correct me, please.
Yeah, sure. So the private markets are very agile. They're very creative, and they tend to step in when the market dislocates. So they've had a number of growth spurts over the last decade or so. So we can go back to the great financial crisis. Banks pulled back. Private markets froze up to an extent. Private credit leaned in. We saw the same thing during COVID, and we saw the same thing during the spring of 2023 when we had Silicon Valley Bank and Credit Suisse had issues here. So private credit markets are agile. And one of the things they have that's a big difference is that they're funded with long-term deposits, if you will, locked up capital. And so therefore you don't have that asset liability mismatch as you actually do within the banking system.
Is private credit, for that reason, that agility you hone in on, can it come to the rescue of some of the deal gluts we're seeing in private equity?
It's an interesting question. They're definitely leaning in right now. I thought when we first saw the volatility that we might see the private credit lenders also kind of sit on the sidelines. Many of them have jumped into the pool. There's still some on the diving board, and there's still some around the edges, but they've jumped in, and they're doing deals today.
How risky is that, though? How risky is tying private credit's fortunes to private equity at the time when people are pulling back from the capital markets, not in?
Yeah, they tend to be counter-cyclical investors, and they tend to be very sophisticated, very smart. They, I think, are good risk assessors. And again, because they're not as regulated as the banks, they have more agility than the banks do today. In fact, as I mentioned, risk is on the move. We're talking trillions of dollars. It's moving out of banks and into insurance companies through the private credit sponsors, into pension funds, and as we were talking just a minute ago, into the hands of retail investors.
But how much is that pivot because of a necessity, and how much is it actually because of innovation in your space?
It's a combination of two. Like water in nature, capitalism will find a way. So as the banks have become more and more regulated, and there are financing needs in the market, the private credit lenders have started to grow. I think about it as a balloon. You push it down over here, it pops up over here.
Okay, and then amidst all of this volatility, how are you kind of shuffling your portfolio?
I mean, the way we think about it as a rating agency is we're looking for the risks that may be emerging. One of the things we've been talking about with investors as well as regulators is, does private credit represent an increase in systemic risk?
Yeah.
It's certainly becoming more systemically important, but the question is whether it's actually adding risk, or is it mitigating some risks in the market?
We're not going to know until we've been through a cycle. And isn't that the case here, that actually what we need to do is stress test the model and see what happens? Well, that's where the risk... We thought that we disaggregated risk going into the GFC. We thought that it was all great, and central banks talked about this, and we had disaggregated risk, and as a result of which everything balanced itself out.
That's the exact argument that Jamie Dimon is saying is going to happen again. He's comparing it to the housing crisis. Why is this different than the housing crisis?
Well, I would say, first of all, again, you've got locked up permanent capital. So you have a run on the bank. Run on the bank is not good for the economy. You don't tend to have a run on the private lender. You don't tend to have a run on an insurance company.
But isn't this where the mismatch comes in? That you've got retail investors who think they have got liquidity.
So we're at early days in terms of retail investors getting into this, and that's why I was mentioning you're going to need education. You need more transparency.
Do you think the industry's doing a good job on that education at the moment?
One of the people who was at our conference the other day was a big asset manager, and they were talking about, particularly for high net worth individuals who are fairly sophisticated investors. Today, they have about 5% of their overall portfolio in private markets. This gentleman was suggesting that over the next several years, that will double or triple. So you could have somewhere on the order of 10 or 15% of a high net worth individual's portfolio. This has not yet reached Main Street.
Yeah.
But the private sponsors are salivating at, for example, in the U.S., you've got 401ks, $8-9 trillion worth of money.
Yeah.
Why not get some of that? If you put that into, let's say, the target date fund sleeves, you're going to need education, because that can be liquefied. You can get money out of your 401k for hardship, for your first-time home buyer, for a number of different reasons. So you need that education. So to answer your question, it hasn't started yet, per se, to really get to Main Street. It's still in the hands of Richie Rich. Richie Rich has got a little bit of private credit, but not a lot of other people.
And probably is reasonably well educated, but maybe, as you say, as we spread it out, we're going to watch it very carefully.
We have to watch this super carefully.
Nice to see you. Thanks for stopping by to see us.
Thank you. Thank you.
Hopinso, Global Head of Private Credit, joining us from Moody's Racing. Thank you very much indeed. It is Friday. The weekend's going to be busy. There's a lot going on this weekend. I've got Liverpool-Arsenal. It could be a tough week for Arsenal. Sorry, Prime Minister. But Bloomberg Originals has taken a deeper dive into the English Premier League. As owners struggles with rising costs, clubs are embracing American luxury to boost revenue. But some fans are a little worried that the pursuit of profit is leaving them, the fan, behind.
The Premier League is the pinnacle of club football. The theatre, the tension and the talent are unrivaled in a league which boasts nearly 2 billion followers worldwide. And yet...
Now, I'm not sure what would make you more miserable, being a Manchester United fan over the weekend or holding the stock this morning.
There's loads of losses. If we look at the top 5 leagues of English football, more than half of them are technically insolvent.
Just look at how many clubs in the Premier League lost money in 2023 to 2024. Only a handful of them actually managed to turn a profit.
I've had executives say to me, we're looking like behind the sofa, we're looking everywhere to get, a few pounds, dollars or whatever.
They're also looking overseas.
One of the things that English football clubs have started to realize on the backs of what's been learned here in America is that people are willing to pay for experience.
But some fans are worried they're being left behind.
To the corporates who are running our clubs and making the decisions, we are just customers and we can only be thought of in that way.
As clubs explore new opportunities to keep the money flowing in, does English football need greater American influence to keep it afloat? And if so, what might that mean for the future of the beautiful game?
Is it sports or is it entertainment? That is the challenge that I think certainly all European sports, certainly all UK sport has got to deal with right now and try and figure the answer to that. Look at rugby, look at what's happening in cricket as well. All of that happening at this moment in time as we try and get that balance right. You can watch the full documentary, Bloomberg.com. It's also available on YouTube. Well worth a watch. As I say, Liverpool-Arsenal, Sunday, 4:30. It's been a tough week for Arsenal. The Prime Minister.
Real Madrid, Barcelona. Hello.
Yes, you've got the Champions League coming up. I'm just talking about English football here, which has had a tough week. Arsenal being knocked out by PSG. It was the real game was the Barca game where they got knocked out by Inter. That was amazing. My son was shouting at the television. I was trying to go to sleep. All he could hear, he was meant to be doing his GCSEs, but he was shouting at the television. It is a busy weekend coming up. We've got lots going on.
Aside,
no,
I tell you that it's the 25th
of
anniversary of the Tate, a cultural thing to be happening at the weekend. There's some relief.
Yeah, okay. If you want to do
If
that.
you don't watch sports, you go to the Tate. Apparently.
Okay. Well, great. There's other things happening as well. You got the Pope's first mass is this weekend, isn't it?
It's happening today, I'm told, at 10 a.m. UK time, 11 a.m. local at the Sistine Chapel. I think he's got the most exciting plans of us all, perhaps.
He's a White Sox fan, though, isn't he?
I don't know. I don't know his sport affinities, Guy. But
I'm told he is a White Sox fan.
We're gonna have to do some research. Maybe invite him.
Ice hockey this weekend. The ice hockey's going to be
Guy,
amazing.
leave me alone. I don't want to talk about sports anymore.
Okay, sorry.
Let's talk about what's happening this weekend. Of course, we are going to be exploring all these things. I'm sure sports will be on the agenda. You can get that edition of the Bloomberg Weekend Newsletter. Deeper analysis, feature pieces, profiles, unique insight, all that fun stuff on the weekend newsletter. Be sure to tune in. But I think the real highlight of this weekend, sports aside, culture aside, is what's going on in Geneva. Do we get some sort of reprieve between the United States and China?
Well, everybody wants to think that they've got the upper hand going into these talks. Interesting to look at the China data this morning. Actually,
not very good.
Exactly. Well, your Chinese exports rising more than forecast. You had bad US export data, trade deficit. Surely that gives Chinese the upper hand in this.
Yeah, if you look at the Chinese data, it got better for the rest of the Asian countries. I'm assuming that's reshipments. So stuff's going into other Asian countries and then coming out of other Asian countries and going to the United States.
Exactly.
So
you can make up the losses.
You can balance it out. But how long can you do this? This is still early data. Take a look at what's on the water right now, and you've seen a massive drop in the number of ships coming out of China and going across the Pacific. I think that is a crucial piece in all of this. So yeah, I think it's going to be good. It's going to be really interesting. I'm going to be watching the sport. There's a lot of great sport to be watching, but I will be paying attention to this, and I think Monday morning will be dominated by this. It's the symmetry of this is fascinating. How much good news is priced into markets already? Yeah. Is there the risk that nothing happens and you get the bad scenario that Mark Hubble was talking about coming through on Monday morning? That's the one to maybe watch out for.
Is that the positioning story that is perhaps a little skewed this morning? I'm looking at these equity indexes here that aren't moving to the upside that much in Europe. Even futures in the States, higher by 0.1%. The dollar weaker, but by marginally. People are in wait-and-see mode. This is a cautious market.
Okay, the Reykjavik Economic Conference, ECB and Fed officials are going to be speaking there. Fran's going to be there as well. Francine Lacroix interviewing some of the biggest names. John Williams is going to be there. I think we're going to be having a conversation with him, or Fran is. Can't wait to hear what he has to say about what is happening. Talking of which, the Pulse is next, and this is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Ottawa, Canada, and this is Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly.
There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
Markets buoyed on hopes that tariffs between the US and China will be cut during trade talks in Switzerland this weekend. A diplomatic win for the UK as it strikes the first trade deal with the Trump administration, but 10% baseline tariffs remain. And Pope Leo XIV will preside over his first Mass after becoming the first American to be elected leader of the Catholic Church. Let's check in on your markets then. The tailwinds are there from the trade conversations, expectations that maybe you get a significant reduction in tariffs at these conversations between China and the US in Switzerland this weekend. Though, if you go from 145 to 50%, to what extent should the markets lean into that, given the significant increase, of course, still on those tariffs on Chinese exports to the US market? So we watched those talks, of course, after the US and UK sealed what some have described as a framework deal. US futures then pointed to modest gains of 0.1%. European session is strong as well, worth noting. We'll break that down for you shortly. 438 right now on the benchmark US 10-year, largely unchanged after some pretty sizable movements across the Treasury curve yesterday. Some repricing around expectations on the Fed and fading some of the bets through the rest of the year until how fast and how far the Federal Reserve goes on potential additional rate cuts. 103 on Bitcoin, so the risk-on sentiment is feeding through to the crypto space with gains of 1%, breaking through 100,000 on that cryptocurrency with the biggest market cap, of course, within that space. And the Japanese yen at 145, currently a move of 0.5% for the Japanese currency. A little bit of strength coming through, and we keep an eye on that. Let's check in on the European map then to see how this is percolating across the European session in terms of the trade conversations. The focus is on Germany, the DAX getting back to close to record highs. So the losses that came through on the back of the April the 2nd tariffs, all but being wiped out right now. The focus on the fiscal stimulus impulse, of course, and to what extent that is going to support the German market. Autos, basic resources, all getting a lift as sectors so far in the session, up 0.5. Positivity in the UK as well, gains of 0.4% so far on the FTSE 100. For the conversations that matter and insights you need, let's get the show started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Tom McKenzie, standing in for Francine Lacroix. Now, the UK has become the first country to strike a trade deal, of course, with the US after President Trump's tariff onslaught. Trump has pitched his trade framework with the UK as an historic achievement after speaking with UK Prime Minister Keir Starmer by phone yesterday, but the agreement fell short of a full and comprehensive deal.
This is a maxed out deal that we're going to make bigger. And we make it bigger through growth. I think it's going to be something very special for UK and special for the United States.
UK Prime Minister Keir Starmer conceded the pair did need to, quote, finish ironing out some of the details.
We've agreed the basis of a historic economic prosperity deal. And that is a deal that will protect British businesses and save thousands of jobs in Britain. Really important, skilled, well-paid jobs.
OK, let's bring in Bloomberg's EMEA News Director, Ros Madsen. And Ros, you and the team, I know, are quickly focusing on the trade conversations in Switzerland this weekend. And I know that's arguably where the market's eye is now. To what extent, though, is the UK-US agreement a framework, if not for China, then maybe from other countries waiting in the wings, whether it's Japan, India, South Korea, maybe the EU as well? Is this a template that others can follow?
Well, certainly you look at this and you think, how did they get this done and what did they arrange to get it done? You know, what did the UK give to allow the US to claim a win? I mean, they didn't give a lot on the surface of it, but they allowed Donald Trump to say, I've got these things and therefore I have a win. And that's really setting the parameters for a much more complicated conversation down the road, because none of this really got into the tricky stuff. And that's part of perhaps the art of getting that initial deal for Donald Trump, is to punt the difficult stuff down the road. But is it really a template for other countries? I mean, China and the EU are much bigger fish to fry, arguably, for the US when it comes to trade. The UK has a trade surplus with the US, in a way far less complicated, what I would say, than the EU and China. And China and the EU actually have, they're bigger economies. They've got more heft. So a more complicated conversation. The EU, obviously, also a bunch of countries and not just one. So can you take it as a template for really big economies like that, or perhaps for some relatively smaller economies around the world might see that this is a template they can use? But also countries like Japan and India, you know, they've got very strong domestic imperatives to think about. You've got to be really careful, even in this initial gambit, you don't give too much away. You've got domestic industry to think about. You maybe got agriculture to think about. You've got autos to think about. In India, you've got market access issues, which are very complicated. So even in that early stage, you've got to keep it broad, because otherwise you're going to pin yourself in down the line in ways that you don't foresee and you certainly don't want.
So lessons that can be learned, but not a direct mirroring for other nations as they look to build out their own trade agreements with the Trump administration. On the US-China talks this weekend in Switzerland, what should the expectations of markets be around what could come out of those conversations?
Well, they're setting expectations simply to be, this is a feeling out exercise, a chance for us to get together in the room, have a conversation, get a sense of each other, build a relationship, because these are officials who don't have a direct relationship so far. And part of it is sitting together, looking at the body language, working out how to converse with each other, and putting out some lines, some red lines initially in that conversation. So this will be a scene-setting conversation. It's really important they've actually managed to agree to meet in person, because if this meeting goes well, does it pave the way for a phone call, for example, between Donald Trump and Xi Jinping? And that's the big thing everyone is looking for. They're not going to come out of this with a trade deal. They're going to come out and say, we've made all these understandings around it. The US is making clear it doesn't want to lift tariffs on China. China equally not wanting to move before this conversation. But it is an important step potentially along that road to getting the presidents talking. And from there, do you get towards a better understanding?
OK, just the fact that they are sitting down for talks is in itself an achievement at this stage. There's a low bar, isn't there? But we'll watch to see what details come out. And of course, could be impactful for these markets as well, particularly if they do move tariffs lower on the back of those talks in Switzerland. Bloomberg's Ros Madsen with the context around what is happening with the US, UK, and of course, those talks in Switzerland. Thank you. Now, IAG has confirmed, and this links to the UK-US deal, of course, a major order for wide-body jets, including 32 Boeing 787s for British Airways, in a deal tied to that trade agreement between Washington and London. The group has also ordered 21 A330neo planes for Airbus as part of a $100 billion investment in its fleet. The company reported first quarter earnings that beat analyst estimates and has maintained its outlook, saying demand is still strong. Let's take a look at how the markets then are pricing in that US-UK deal and how it could move the dial in terms of the economy of the UK. Very pleased to say we can bring in Yari Sten now, Chief European Economist at Goldman Sachs. Yari, great to have you in the studio, as always, joining us this Friday morning. Does it change the outlook for you and the Goldman team around your view, your forecast for the UK economy on the back of this agreement?
I think it's helpful, the auto carve-out in particular. It also sets a better mood music. But ultimately, we have only upgraded our forecast very slightly on the back of this by 1/10 of a percentage point and still see a significant drag from the 10% baseline tariff that, of course, is staying in place. And quite importantly, also from the weakening in growth prospects elsewhere in the world, where, of course, the trade policy outlook remains much more uncertain. So I would say, bottom line, yes, it's helpful, but we continue to be cautious on the growth outlook for the UK.
If we get a flurry of deals of this nature, framework deals, between now and the end of that 90-day period, if we get some progress in terms of a reduction of tariffs when it comes to the US and China, these are all caveats, of course, but there does seem to be momentum in terms of some, at least surface-level deals being made within that period. The UK is clearly an open economy. Does that change the dynamics? To what extent would you have to take a step back and think, okay, we're going to reassess our forecasts in a scenario like that?
Yeah, I mean, it would help, but it's also what we've baked into our forecast.
Right,
so
okay.
So we are assuming essentially that the 10% minimum baseline tariff stays on all countries. The sector-specific tariffs, largely speaking, stay on all countries, and that there's some reduction between US and China tariff rates. That's in our forecast. That already implies, I think, a pretty cautious outlook for global growth and for the UK. But of course, the risk is that we don't get quite as much in all of these country-specific trade agreements. So we would still approach all of this from a more cautious side. And I think consistent with that, we are seeing signs that the more forward-looking economic indicators, the surveys, are weakening. So the hard data is holding up, broadly speaking, in the UK, also around the world, but the forward-looking indicators are deteriorating, and I think we have to watch those pretty closely.
So top-line growth by the end of 2025, the forecast for the UK is currently what?
It's about 1% for this year and next, but of course that does come after a very strong first quarter print. So that's in those numbers, whereas the next few quarters are going to be slower than that, we think. So we have, on a quarter-by-quarter basis, around 0.2%, which is putting you a little below 1% in terms of the run rate, and that's below what the Bank of England is expecting and below what the OBR has penciled in.
And when you talk about caution, we got some sense of caution from the MPC, the BOE, yesterday, in terms of the decision-making and the three-way split. Markets are now fading expectations of a cut in June from the BOE. It's almost been completely cut out. How does it change your views on the terminal rate for the Bank of England, and in what time frame?
Yeah, the communication was hawkish with the dissents, also the gradual and careful being retained, as you said. So we do think it has implications for the near term, and we dropped our forecast for a cut in June. We now think the signaling yesterday means that the hurdle for them to cut in June is higher than we thought before, so we made that change. But I'm not sure it matters that much for where we should expect rates to ultimately settle, because that will be driven by the economic outlook, by growth, by the outlook for wage growth, inflation. And here, as I said, we remain cautious. We think that there is a growth slowdown in the pipeline. We think there will be progress in terms of the pay settlements in the April data, and we also think inflation will cool more than what the bank is expecting. So we still think they will cut more than priced. We have them cutting to 2.75%, but we now think it will take a little longer, but they will switch, we think, to a faster pace in the second half of the year as that cooling in growth and inflation becomes more apparent.
Okay, so 2.75% is the terminal rate that you're forecasting by March, and that's just right. Adjusted from February, but by March, 2.75%. And you talked about the inflation cooling in the UK. Megan Green of the MPC, of course, suggesting to us a few weeks ago that the trade war could be disinflationary for the UK. Is that an assessment that you would align with, and how? To what extent could it be disinflationary?
Yeah, I think that's right. We would share that assessment. First of all, we have seen a significant appreciation of the currency. We have seen a big drop in energy prices. We have not seen retaliation by the UK. That's important, of course, from an inflation perspective. And then lastly, we are also expecting quite a lot of trade to be rerouted globally, given the high tariff rates between the US and China, and a lot of that will probably end up in the UK and in Europe more broadly. We expect that to also push down on prices. So bottom line is the current run rate of inflation in the UK is still high, clearly compared to other countries, but we do think the outlook for inflation has softened. And so we think come the middle of 2026, the UK inflation picture will look more similar to other countries. It will not be that far away from 2%.
We have a new Chancellor now, fully confirmed, in Germany, Friedrich Merz. Potentially €1 trillion of spending on infrastructure and defence over a longer time horizon. But when does that start to hit the road, the rubber hitting the road, in terms of propelling a German economy that's faced 2 years of stagnation?
We think that the spending will ramp up gradually this year. We don't think you'll feel very much from that this year. I think this year will still be dominated by the trade headwinds and so on. But we do think from next year onwards, there's going to be a significant boost from that fiscal spending. So we did upgrade, after the German election, our forecast for 26, 27, 28 quite significantly, on average by 0.5 percentage point in each of those 3 years. So that's a big upgrade. I think the focus now really is on implementation. How quickly will this money be spent? What exactly will the money be spent on? And this is where we don't have a lot of details yet. We have the overall envelope, as you described, but not yet the allocation, and that's what we're now looking at.
Markets are expecting rates in Europe to be at about 1.5% by the end of this year on the baseline benchmark. Does that make sense in an environment where 2026 sees this fiscal impulse? Is the ECB going to have to respond in a different direction as that response comes through?
I think the 1.5% makes sense. Yeah. That's where we have the ECB cutting to in September. So 3 more cuts of 25 basis points. Of course, that improved growth outlook on the back of the fiscal stimulus is important and it does provide some resilience in the background. But I would say that's a reason for them not to cut further than 1.5%. Because when we look at the growth picture, when we look at the inflation picture in Europe, we do actually see quite a lot of cooling. So to give you a sense, we have core inflation in the euro area at 1.7% by the end of next year. For similar reasons to what I described with regard to the UK, energy prices, currency, China rerouting, also cooling in pay pressures. And so that is below 2%. There's some undershoot here in the baseline, which I think means that they continue to cut. But as you said, we have that fiscal coming in, we have that resilience, and I think that's a reason for them to stick to 25 basis point increments and a reason not for them to go much lower.
Okay, 1.5% for the ECB by September, 2.75% for the BOE by March. The forecasts on these central banks from Yari Sten, Chief European Economist at Goldman Sachs. Yari, thank you, as ever. Happy Friday. Coming up, is the EU prepared for the impact of US tariffs then? We're going to join Francine Lacroix, of course, at the Reykjavik Economic Conference for a conversation with the governor of the Bank of Lithuania. That is coming up. This is Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Africa,
a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything.
Central bankers from the ECB and the Fed are in the Icelandic capital of Reykjavik to discuss the role of central banks in an uncertain economic outlook. Of course, that's as trade tensions threaten both the US and European economies. Bloomberg's Francine Lacroix is on the ground for us with a guest. Fran.
Yeah, thank you so much, Tom. I'm delighted to be here in Reykjavik, and I'm even more delighted to be joined by the Lithuanian Central Bank Governor, of course, Governor Simkus. As always, Governor, thank you so much for joining us. Look, there's a lot going on, inflation, growth, a lot of concerns about tariffs. How would you describe the European economy right now?
Well, thank you for having me here, first of all, and I think it depends whether you are optimist or pessimist. If you are optimist, you'll be looking to backwards, to the indicators of, let's say, of the first quarter of last year, fourth quarter. They seem to be not that bad, right? The economic activity, it was reported positive numbers, inflation is falling back, so basically they are almost as ECB, as monetary policy institution, basically at the target. But if you are more on the pessimist side, and if you're looking into the future, you cannot see that everything, or so many things which is happening, not only, in the last 100, a little bit more than 100 days, but like from the start of the year. They are not good news for economic activity. Maybe it's good news for inflation, at least in Europe, maybe not that much in the US, but as for economic activity worldwide, Euro area, the US, this is not good news, and that's what how I would describe. And the common factor, for all this is uncertainty.
Yeah, but also, there are concerns about inflation, right? It kind of ticked up, and the question is, do you believe it goes back down, or is it just going to tick up for the eurozone?
I think on this we need to be frank and humble. So there are many things that we don't know at the moment, right? So we don't know what and if and what could be the retaliation measures to the U.S. tariffs. Retaliation by the European Commission. And this is an important factor, to consider when you think about the inflation in general. But I think to a large extent, if I take the information we have at the moment, so we have a clear disinflationary forces exerting downward on the inflation. So we have oil and gas fallen by 13 and 40% each. We have appreciated euro against the dollar, which lowers the import prices, but also negatively impacts the investment sentiment. We have so to say, possibility that China, it will very much depends how the trade tensions between China and US are going to be resolved. But there is a chance, there is a possibility that some of the China imports may be rerouted to euro area. And again, economic activity. I'm, the one which thinks that, in future, we might see deterioration of the economic activity, and I would say the projection is going to be a little bit worse, maybe marginally, but still worse than we had in March. So all this works as a disinflationary forces.
Yeah. What about stronger euro? So if the euro continues to strengthen, what impact does that have on both inflation and growth?
If euro strengthens, so first of all we have lower price of imports, right? So it's not only about the euro, but it's also very much about the retaliation measures, which I have already mentioned. And then strengthening euro, I mean, this might have on the possibilities of the exports from the euro area and also on the investment sentiments. So I would say for me, it's a disinflationary measure, not measure, but force.
Governor, I mean, given all of this, right, the market is expecting a cut in June from the ECB, and then maybe one or two moves after that. Is that the central scenario you're looking at? Do you think will happen?
I need to be, so to say, honest with you. We don't have a central scenario. There is no central scenario because there is no predetermined interest rate path. I mean, it's very good. We need that we are agile and flexible because we take decision on the best data in each meeting. You know the story, right?
I know very well, but you also must have an idea of what you would do, right? Is June a done deal?
Okay, let me put it like this. What I described, the story, the economic, the way I see the economics, it's obvious that for me, June decision is quite clear. I think the cut the other cut in June is needed. I cannot, so to say, reject the chances that there might be another cut after the June, right? And again, because of the economic story I described, that was in July, as markets expect, or in September, in December. I mean, in the last 100 days happened so much. Why we are so in a rush to think what might be even after June? To wait up until June, we have another 30 days and so many things may happen. So I think it's very important here to have this flexibility and meeting by meeting data dependent approach.
But, you know, Governor, there's clearly a rate cutting cycle, right? Yeah. And for the moment, we're in it for the ECB. What would need to happen for you to think actually it's really now time to pause this?
Well, to pause it, as I said, I think what's going to happen in June, in my eyes, is pretty clear. But then it's not about, you know, just making this deliberate decision to pause, but it's about we'll be at the level of a natural interest rate already, 2%. I mean, people may come up with different estimates of this, but I mean, we are more or less there. And this means that we can be, so to say, slower with our decisions because we are in a way will be moving into a more like really accommodative direction of the monetary policy stance. That will be accommodative or not. I mean, it's discussable, right? But we will be moving into that already, into that direction. So I think we are not late. I mean, we are nowhere late. So I think we can take a time to breathe in air and to see how the things are evolving.
Governor, I mean, in June, we're also expecting projections for inflation for 2026 and then 2027. If they were to actually fall, you know, below or undershooting the 2% target, how worried would you be about that?
Well, I wouldn't be worried in a sense that I'm the one who thinks that there are quite high chances we'll be undershooting, and I'm saying this already for some time. So first of all, the other thing is that we do need to be humble. I mean, 2026, 2027, it means 2 years to go. So, I mean, a lot can happen, and we always been, you know, a little bit, you know, so to say, it's not about this precise target or number, but I think it's about directions and how the inflation changes from the target. If it is below 2%, let's say in 2026 or 2027, I think it will be below marginally. So, I mean, we need to be, so to say, prudent. This is not, so to say, the end of the world, right?
Governor Šimkus, thank you so much for joining us. Of course, we'll have plenty more throughout the day here in Iceland, Tom.
Okay, Francine Lacqua on the ground for us in Reykjavik. Some great conversations coming through. Plenty more coming up, of course, throughout the next few hours, including conversation with the Fed's Adrian Kugler and John Williams. Catch those conversations this afternoon on Bloomberg. Stay with us. This is Bloomberg.
what is the issue between the type of information that's being collected by investors and the marking issue that you're describing?
What mark-to-market assets do is it forces honesty into the situation. We're talking right after the DeepSeek model surprised everybody in its efficiency. It took hundreds of billions off of market caps because it legitimately raised concerns that maybe the future of AI was different. I guarantee you that if you look at other portfolios that aren't marked, they didn't move. If private assets are going to eat the world, as they say, with the equity market halving in the number of names, you come to a world that is increasingly an echo chamber. Imagine you have a firm that has some public assets and some private assets. If you see your public assets in AI going down by 20%, you're going to be thinking very, very deeply about what your private assets are worth differently than someone who just has the latter.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Good morning, welcome to The Pulse. I'm Tom McKenzie in London. These are your top stories. Markets buoyed on hopes that tariffs between the US and China will be cut during trade talks in Switzerland this weekend. A diplomatic win for the UK as it strikes the first trade deal with the Trump administration, but 10% baseline tariffs remain. And Pope Leo XIV will preside over his first Mass after becoming the first American to be elected leader of the Catholic Church. We've had some movements as well in terms of a conversation between Friedrich Merz, of course, the Chancellor now of Germany, and President Donald Trump. Merz saying that he has told Trump that he favours a zero-tariff trade agreement. He's explained, apparently, to the US president that EU members cannot have one-to-one trade deals. You'll have to deal, of course, with the bloc. He has then, again, emphasised his preference for zero tariffs in terms of the trade agreement. We know that there has been little progress, in fact, between the EU and the Trump administration in terms of forging a deal. The Chancellor as well, updating us in terms of his plans to visit Washington, D.C., saying that President Trump has invited him to visit the U.S. Capitol, and we'll see when that happens. We know he was keen, of course, the new Chancellor, to be over in the U.S. in the next few weeks. Also saying that on joint EU debt issuance, that should remain an exception and not a permanent feature. So continuing that line from Germany on the question of EU joint debt and pushing back against any assumptions that may be coming down the pipe. But we'll watch, of course, for that meeting between the Chancellor and his US counterpart. Let's get into the details of the US-UK trade framework, meanwhile, because that deal, of course, has been hammered out. Both countries claiming the deal is a win for jobs and industries. Joining me now is Siobhan Haviland, Director General of the British Chambers of Commerce. Siobhan, thank you so much for taking the time. If you then were to assign a grade, if you were marking the homework of this deal, what grade would you assign this UK-US agreement?
Well, it would certainly depend, I think, what business you were running at the time. I mean, in general, we absolutely welcome this trade agreement. Our members have said over the last few weeks that the government is doing the right thing, keeping a cool head. Retaliatory tariffs should be an absolutely last resort. So we should definitely congratulate the government on bringing down huge tariffs for the automotive sector. And remember, it's not just those who make the cars, it's a huge number of businesses in their supply chain. And of course, aluminium and steel tariffs are back to zero is great. I mean, I visited a business they have a place in Glasgow, in Birmingham. They make incredible aluminium and steel parts for F1 cars in the US. They had millions of dollars worth of orders cancelled because of these tariffs. So it makes a real difference to our members. So that's very good news. But of course, that means at the same time, many other sectors are still paying 10% tariffs, the baseline tariffs. And so we really want to see UK government keep going with that negotiation and some easement there.
Yeah, does it feel like it's I hear you on those individual businesses, and clearly there's the relief, and I want to get your views on the auto sector, but we've gone from tariffs in the UK of 5.1% to 1.8%, and the US has gone from tariffs to 10%, approximately, across a broad range of exports to the US economy from the UK. It feels like a one-sided deal.
Our tariff situation is worse than it was in January. I mean, it is. But we are a lot better off than we were last week. So, that's the way trade goes. We have to find a balance. We have to negotiate. We have to find a compromise. We have to find a win-win. But as you say, we still have 10% tariffs across the board. And that's something, the UK government said this is just the start. We need a wider negotiation. Let's keep going.
So that 100,000 cap for UK cars, so they will be tariff-free into the US market. As you say, that's a clear benefit for the auto sector. Is that a stay of execution for a struggling UK auto sector, or a catalyst for growth?
I don't think our auto sector is struggling. I mean, these are incredible high-end cars in general that go over from the UK to the US. And they're our second biggest export. So it's absolutely right that those jobs and those businesses were protected. About 100,000 quota is about what we currently export to that market. So that's good. See, that doesn't leave a load of room for growth. But exports in general are a really important growth driver for UK PLC. I mean, we estimate that if we had 2 points more trade across the world last year, that would have added about 0.6% to GDP. So exports everywhere and across the world are really important, both to the US, to our EU partners. That's our biggest trading partner, of course. And we're encouraging our businesses to look around the world, look at the big growing markets of the Indo-Pacific. So we've got to keep remembering this is part of a bigger global deal.
What Siobhan, on that point then, the UK-India deal, I mean, it's going to take time to implement. 2026 seems to be the time frame. How are your members positioning to take advantage of that deal?
So we've just seen the deal this week, of course, that in the news cycle, it seems to have been almost immediately forgotten, but it is absolutely a huge across-the-board reduction in tariffs for UK exports into India. So we now have to help our businesses understand what that means for them, where they're currently putting their goods, what the opportunity is in India, but it's definitely opened up the market for lots of our sectors. So India, CPTPP markets across Indo-Pacific. We've got a big EU reset moment in a couple of weeks with EU leaders coming to London, and we're pushing the government to try and make trading arrangements better with the EU. So, lots more opportunity.
Are we seeing the dividends of Brexit now, Siobhan?
I'm not sure that I would relate that directly. I feel like a lot of things have changed since Brexit. I think we've probably moved on from that. I think what we need to do is need to deal with is a new world order, and that means ensuring that we have a win-win for UK PLC across the piece. This is not about a zero-sum game. This is about ensuring that we get the best deal for the UK.
And you talk about that EU-UK conversation on trade. You're in the room often with lawmakers and with those involved in these conversations. What is your sense as to how far this government is prepared to go on a trading relationship enhanced with the European Union?
I mean, we have been clear with this government and the last one since Brexit that the TCA is not working for our members. We thought they'd get used to it after a year or two. They haven't. It's still really hard. So we are absolutely clear that they need to be bold on the 19th. We need to see new arrangements around food and drink exports, around moving our business people around Europe, mutual qualifications, VAT arrangements. The list is clear. It can be done outside a renegotiation of the TCA. So let's be bold. Let's do some really good things with our EU partners in a couple of weeks' time.
Okay, Siobhan Haviland, thank you so much. Director General of British Chambers of Commerce, of course, on the need for a bold approach to relationships on the trade basis, of course, with the EU, between the UK and Brussels. Now, to the banking space right now, because Commerzbank shares are higher this morning, helping to lift the DAX after reporting an unexpected first quarter profit beat. I spoke to the CEO, Bettina Orlopp, about the results earlier.
We forecast an elevated level of risk results for this year. The 850 is more than you would expect, but we also have a very well-diversified, well-managed loan portfolio, and that now pays off. What we see is an increase in defaults, and that is not a surprise because we now have an economy which is in the third year of no growth, and that leaves traces. And that's what we also see. But one has to say that the resilience of German corporates, specifically also of the Mittelstand, is very high. So what we see is really single cases across sectors, but everything seems to be well managed, also from our corporate side, and therefore we confirm our guidance. Despite the tariffs, will clearly have an impact on German economies. This is also why we adjusted our GDP assumption from 0.2% growth, which is also a very limited growth, to basically zero. And only next year we expect a positive stimulus by the financial package of the new German government.
What are you seeing on corporate restructurings then? You're saying some relative resilience. Are you seeing a pickup in corporate restructurings? And if we don't get a deal between Europe and the US, does that start to become a more prominent and salient issue?
If we can't settle a deal, it will definitely put more pressure on the corporates. At the moment, as I said, we have seen a constant increase of the default rates already over the past quarters. And that was also expected because we always said that this very low number, which we saw coming out of the pandemic, also because of all the government support measures, was not the normal number you would expect. And now it has entered the normalized levels, which we also knew before the pandemic. And that is something which will continue, and it will only change to a positive when we really see the financial package paying off, a positive sentiment, growth in Germany, and hopefully also a solution for Europe on the tariff situation.
The CEO of Commerzbank, Bettina Orlopp, speaking to me earlier after those results came through with a beat for that German lender. Staying on the banking space then, Monte Paschi and Mediobanca earnings also beat estimates this morning as the lenders reported amidst an M&A wave in Italy. Charlie Wells is here with an update. Charlie, what have we seen from these Italian lenders and how much of a focus have we had on the M&A space? What kind of update have we had in terms of the potential mergers from some of these lenders in Italy?
Yeah, Tom, so a really big morning for earnings for both German and Italian banks, really caught in that M&A wave emanating out of Germany. So you had that significant beat from Commerzbank. They were able to achieve the best first quarter in 14 years. Now, that was on the back of the fact that they did not have to set aside as much in loan loss provisions as expected. And this is really going to bolster this bank that has been the target of UniCredit. This kind of helps build some of the share price momentum that we've seen for Commerzbank. If we bring up this divergence that we're seeing between UniCredit and Commerzbank, this just makes that potential takeover all the more difficult for Andrea Orcel, their CEO. Now, we're talking a lot today about Italian banking M&A. That is the dominant theme. As a lot of these Italian banks, some of the key players in this M&A wave report, we got a beat from Mediobanca, a beat from Monte Paschi, and you can see that they are performing relatively well in the market. And it's a little bit difficult to keep a lot of these players straight, but if you have a timeline, you can kind of break down some of the key players here. You got UniCredit making that bid for BPM in November. You had Monte Paschi in January making that Mediobanca bid. And then more recently, you have Mediobanca in more of a defensive mood trying to acquire Banca Generali, which will also be reporting later today. So we're watching for that. We're watching for signs of M&A activity in the comments from these executives and why. This is such a big theme in Italy. You've got political players weighing in. One of the reasons is just scale. Banking, we know, is increasingly an industry history of scale. And when you compare Italian lenders to a lot of their international competitors, you can see the size is smaller and you can see the motivation for all of this M&A.
Okay, excellent breakdown of a very complicated picture when it comes to M&A in the Italian banking space and the earnings lines as well. Bloomberg's Charlie Wells, thank you. Switching focus right now, because world leaders have been offering their congratulations to Pope Leo XIV, the new leader of the Catholic Church. Cardinal Robert Prevost is the first ever pontiff to come from the United States. For more, let's bring in Bloomberg's Flavia Rotondi, who is at the Vatican City for us. Flavia, give us a sense then of the mood ahead of the new Pope's first Mass.
Good morning, good morning. Well, definitely quieter today after all the expectations, the cheering crowd yesterday, the emotions are definitely quieter today, and also after the surprise, I would say, because of course, definitely Cardinal Prevost, well, the name has been starting circulating around lunchtime yesterday after the first rounds of voting, imagined to get a quorum, well, unsuccessful, and so the names of the two main contenders, let's say, Cardinal Tagle from the Philippines, Cardinal Parolin from Italy, seemed unable to attract the necessary quorum to elect a new pope. So let's say, definitely calmer today, but the agenda of the new pope is already pretty tight, already filled with engagements. In a few moments, in a few minutes, he will celebrate a mass here in St. Peter's Square for the cardinals. All the cardinals will be a kind of off-limits event for all the other people. We will be able to watch it, on streaming, but it will be no physical presence of everybody else. But still, it will be interesting to see what he has to say the day after the election, and then on Sunday there will be the official, the ceremony, the mass here in St. Peter's Square, where we'll speak to everybody, and again the attention will be on the first words, the first concept of the new pope, what he wants to signal, what his mission is going to be, what the main challenges he wants to take. So it will be pretty interesting.
What can we expect? He's seen as something of a moderate, and there's a question mark about the relationship with the Trump administration on topics like immigration. What can we expect from Pope Leo XIV then, Flavia?
Well, let's say that we expect some kind of diplomatic approach. Yes, there have been, as you say, some issues, but he has a very strong diplomatic skill. He's an expert in theological studies. From this point of view, it could be seen as very similar to the late Pope Benedict, and also, but also very expert in anything, in geopolitical matters. So we can expect a very wise and diplomatic approach, at least at the very beginning. Of course, we are navigating very difficult times. The church is still pretty divided, geopolitical tension still high, and I think it's very interesting that one of the first words he pronounced yesterday from the balcony was peace. He wants to, that will be the key word probably, and also bridge builder. He wants to be a bridge builder and pontiff. If you think about it, the word pontiff, the original meaning of the word is bridge maker, bridge builder. So the idea is to reach everybody, try to find a consensus, the larger consensus possible to bring peace in this world.
Flavia Rotondi at the Vatican. Thank you very much indeed, as we look ahead to the first Mass of the new Pope, of course. Now, back to the central banking world. A big switch in focus here, because Iceland's central bank is warning of turbulence for small countries from President Trump's tariffs. Its governor says that although the fallout is still unclear, it's concerned about the impact on critical industries such as pharmaceuticals. He's been speaking to Bloomberg's Francine Lacqua at the Reykjavik Economic Conference.
We don't know what the impact is. I mean, what is different is that we've seen not capital outflow, for example. Usually when there is a turbulence, small monetary systems, lose money, but we have seen inflows. So we don't really know what will happen. I see we are, as you see, the country is just between the Europe and the US. So we export both east and west. So of course we think a lot about the cross rate between the euro and the dollar. But but at the same time, our fishing companies they are selling in almost all continents. So we have been able to shift between markets. But as I said, small nations always worry about turbulence to international trade.
Yeah, and Governor, I mean, I know Iceland, a third of your exports are actually aluminium.
Yes.
Right. Yes. And so, again, do you worry about tariffs on that? Have you heard any concerns? You also have big producers here.
Yes, we have a large. Iceland is one of the largest producers in the world of aluminum, but most of our, or all of our aluminum, goes to Europe. So we, as of yet, we are not that actually worried because we have the same access. Our main export to the U.S. is fish, and there I think we have Iceland is big in fish. We have some pricing power there, and also actually no pharmaceuticals. So our main worry would be if there would be a tariff on actually pharmaceuticals to the U.S. Which is not, but we can manage a 10% tariff, and Iceland is also. I mean, we are not a part of the EU. We are not in a customs union, so we will not take part in any tariff war of any kind. So, and as you see, the country is just between Europe and and actually America.
Governor, talk to me a little bit about the consequences of what's happening on the dollar as a reserve currency. I mean, this is something that would impact, many central banks. Is it something that you're thinking about, or is it something that that is a little bit too soon to try and assess?
I mean, we have. We had our financial crisis in 2008, and since that time, we have been focusing on the resilience of our economy, and we have very large foreign reserves.
Okay, Iceland's central bank governor speaking to Francine Lacqua, of course, in the capital, Reykjavik. Coming up, Bill Gates criticises Elon Musk for pushing through steep funding cuts to US aid programs. We're going to hear from the founder of Microsoft. That is next. This is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern, only on Bloomberg. Context changes everything. It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Welcome back. Bill Gates has warned about the impact of the US aid funding cuts made by Elon Musk and the Department of Government Efficiency, or DOGE. The Gates Foundation plans to give away $200 billion over the next 20 years. Gates spoke with Bloomberg's Francine Lacqua.
Well, the foundation will be a strong voice in how impactful that generosity has been. The United States, starting with President Bush in the year 2000, supported HIV medicine so that people wouldn't die. And that's been a bipartisan thing. It's made a huge difference. The Congress, as it's doing the next budget, will decide whether the U.S. supports polio eradication or vaccines for the children in the poorest countries. It's less than 1% of the U.S. budget. And so I'm hoping that we can keep that money in place or only have modest reductions, not the gigantic cut that some people are proposing.
You had some pretty strong words for Elon Musk, saying he's involved in the deaths of the world's poorest children. Do you think this withdrawal of government support is permanent?
Well, there's no doubt that the USAID payment cutoffs that Elon drove have resulted in dramatic increase in childhood death, and children that would have been protected from getting HIV from their mothers during birth, that money has been cut off. In fact, they attacked a grant that was actually in Gaza, Mozambique, for being up in Gaza in the Middle East. But in fact, it was HIV prevention money that was cut off. And so we need to look at how this money represents the moral leadership of the U.S. and the relationships we get. And it's not only to save lives, it's to stabilize these countries. It's to have health systems that will catch potential pandemics early and avoid them coming to the United States. So there's a lot of great reasons this less than 1% of the budget shouldn't be cut off.
Have you had any conversation with any Trump officials about this?
I've had 2 meetings with President Trump, and the main focus of those conversations were the great work the U.S. has done on HIV and how we can do even better with that, drive innovations, including a HIV cure. I talked about the need for the U.S. to stay in polio, that they're a critical partner. And so, I think when push comes to shove, this money should be maintained, although the final word on that will come from the Congress.
What has that dialogue looked like from the other side? And have you met with Elon Musk?
I haven't met with Elon about this. I mean, in terms of USAID, I'm out in Nigeria and Democratic Republic of Congo and meeting the amazing people who did that work for USAID and understanding the impact that it has. So, that's my hands-on focus is global health.
The Gates Foundation chair, of course, Bill Gates, speaking to Bloomberg's Francine Lacqua. Do not miss the new edition of the Bloomberg Weekend newsletter, by the way, where you can get deep analysis, feature pieces and profiles that provide unique insight into the latest news. There's plenty more coming up as we look at US futures pointing right now flat. In fact, the S&P futures, Nasdaq 100 futures are up 0.1% after gains of a little over 1% yesterday. European stocks up 0.3%, and a solid session for Germany. The DAX up 0.4%. Stay with us. Happy weekend. This is Bloomberg.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Why is Baltimore so important to you? It's our state's largest city. And if your state's largest city is not thriving, your state can't thrive. And that is just a mathematical equation, because the only way this is going to be Maryland's decade is if it's Baltimore's time. And so that's why we did focus on things like being able to extend the Orioles lease and make sure the Orioles could be here for 30 years. It's the reason we focus on things like the Preakness and keeping the Preakness in Maryland for generations to come. While we've invested in the convention center, the reason we focused on housing and getting rid of the vacant housing, the reason we focused on violent crime, and now Baltimore is having among the most precipitous drop of anywhere in the country when it comes to homicides and non-fatal shootings and carjackings and auto thefts. So if you can have Baltimore thriving, your state is going to thrive. So if somebody's watching this and they're not from Maryland, but they want to know a little bit about Maryland, what would you encapsulate in a paragraph or two about what people should know about the state of Maryland? I would say Maryland really is American miniature. You tell me what you want to do. And no matter where you're standing in the state of Maryland, I can tell you where to have a world-class experience within 2 hours. We're the home of innovation. We're the home of Johns Hopkins University, the home of the NSA, the home of NIST. We have so much to offer in the state of Maryland, and I think it's one of the reasons that people are so excited about the growth trajectory we're on.
Is this a negotiation or the new rules of the game? It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly.
There will be deals cut. Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Good morning from our global headquarters in New York City. I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda. All eyes on Switzerland. Representatives from Washington and Beijing gear for trade talks over the weekend. China exports to the U.S. slump, but soar everywhere else, igniting fears that cheap Chinese goods will flood European markets. And a slew of Fed speak on deck to wrap up a big week for central bankers as the Fed's dual mandate comes under pressure. Well, we are trying to eke out something of a gain this morning. Ignore the Russell 2000 futures. Those are not trying to eke out a gain. They are decisively down this morning after gains yesterday, after we got pummeled with trade headline after trade headline. We are still headed for decline for the overall week. Michael Harton at Bank of America writing in a note this morning that the rally on those trade deals is over. Buy the expectations, sell the facts. Now, for this bond market, it was a huge sell-off yesterday. We ease off of that somewhat, some steadiness coming through the bond market, but yesterday 10-year yields higher by 10 basis points. We reached 438. We fall below that this morning. Your 2-year yield that is also down 1.5 basis points this morning at 385. Those are your overall markets. Let's get you some stocks to watch this morning. With that is Bloomberg's Joe Easton. Good morning, Joe.
Morning, Danny. So Expedia, one of the big decliners today as the travel company downgrades its forecast for earnings, seeing weakness in bookings of people traveling into the US, kind of in line with some of the data we've seen from the industry recently. That stock down almost 10% at the moment. Then we're also looking at Pinterest. Much more exciting for these social media companies, saying that they are harnessing their AI to use their client base to get more advertising revenue. That stock really rallying up almost 13% for Pinterest. And then we've got numbers out of Lyft as well. This one was a little bit better than we saw from Uber recently this week. The company saying that it had seen a 16% jump in its bookings in terms of its rides at Lyft. Keep an eye on that one and catch up with all of those on the Before the Bell opening wrap on the terminal now, Danny.
Joe, excellent work as always, and we'll catch up with you later in the hour. That is Bloomberg's Joe Easton. Also in this hour, in just moments, we're going to be speaking to Isabel Mateos y Lagos of BNP Paribas. And later in the hour, Jay Woods of Freedom Capital Markets will join us around the table. Now, Isabel Mateos y Lagos of BNP Paribas weighs in on the latest trade deal with the UK and the upcoming talks with China this weekend, writing that they are, quote, both positive signals signals, but merely confirming the no recession scenario that seems to be consensus right now is still plausible. It's no grounds for exuberant optimism beyond that. I'm joined to say that Isabel joins us now. She's chief economist at BNP Paribas. So Isabel, what does a UK deal and a potential upcoming talks with China change for you?
Well, it confirms that the Trump administration is serious in wanting to reach trade deals and reduce the pervasive uncertainty that the tariffs are created. So in that sense, that's positive. But it's important not to get overly excited. For one thing, this UK deal was probably one of the easier ones to strike, not to minimize the amount of hard work that's been put in by both sides, no doubt. But let's remember, the US actually has a surplus in trade goods with the UK. So that obviously is a more favorable context than in the trade talks with the EU or some of the Asian partners. And secondly, it was very helpful to see, well, what is negotiable and what's not. We can't be sure that this will be precedents for all the deals, but it's interesting to see that the 10% reciprocal tariff stays, no going down there, whereas the sectoral tariffs, notably on steel and on autos, which I think people were expecting would be harder to negotiate down. Well, actually, the UK managed to make some headway there. So that's a useful signal. The fact that trade talks with China are going to start this weekend is very positive because, frankly, these monumental tariffs that the US and China have imposed on one another are probably the biggest threat to global trade at this particular juncture. And so the fact that talks are going to start means we now have a reasonable prospect that they will be coming down. So all this is positive. The one caveat I would have is the central expectation from pretty much every forecaster out there was that we would see a decline in uncertainty and in some tariffs over the course of this 90-day window that President Trump set. And so this is the beginning of this probably happening, but this is just putting us in line with the central scenario, nothing better than that.
Right, and what we've gotten from the UK, Isabel, I think a lot of people were underwhelmed by it. And as you pointed out, the 10% tariffs stay on, and then you have some other adjustments around the edges. But it is a framework with more things to be negotiated later, and it's the easy one, again, to your point. So if there still is uncertainty, because let's be honest, trade deals take a very long time to figure out, how long does that uncertainty need to last for there to be real economic damage? Are these little bits of headlines enough to alleviate that threat?
No, for sure they're not. And as I was saying, I think the key piece right now is to get to a de-escalation of the US-China tariffs, because at the level they're at, this is basically a trade embargo. And in a trade embargo, you end up with empty shelves very soon. And we learned in the pandemic that supply chain disruptions are the kinds of things that create massive spikes in prices and are things that are much harder to control than the linear minor increase in prices. So I think these talks that are kicking off on Saturday are extremely important. And if we can get, ideally a decision to suspend the tariffs from their highest level, or at least a pointer that this could happen relatively soon, I think that will be critical. But if the uncertainty remains at the level it is at now for more than a few weeks, it's going to do irreparable damage.
There's a New York Post report yesterday that the U.S. administration is looking at slashing Chinese tariffs to as low as 50%. They're currently at 145%. 50%, Isabel, would still be the highest likely since the 1940s that we've had in tariff rates. How much enthusiasm would you have if we do go down to 50? How much is that? How much economic damage would that or would that not prevent?
Well, that would be very helpful. I mean, in our central scenario, we're assuming a landing zone of around 50 to 60%. So on China. So as you say, it's still prohibitive. but it allows some trade to happen. And more importantly, I think it would signal that the goal is not to completely kill any kind of economic relationship between the two economies. It would still probably get a lot of prices to go up in the near term. It would still generate some very significant rejigging of supply chains towards reshoring in the U.S. I'm not sure, but at least a reconfiguration of that particular supply chain. But it would be more manageable. But you're right, it would still be a major sand in the wheels, very much like the 10% tariff that is remaining in place in the UK is almost a 10 times increase over what was prevailing back in January. So yeah, we shouldn't get overly excited, but I think the more we can converge to these less prohibitive levels of tariffs, the more we are in line with the consensus central scenario where the US gets an acceleration in inflation, but something that remains, contained below, say, 5%, and a very shallow growth path this year, but not a very tricky recession.
A lot at stake this weekend in those talks. Isabel, really wonderful to get your thoughts ahead of them. The perfect setup heading into the weekend. Isabel Mateos Ilago, enjoy your weekend. And a quick programming note, don't miss our exclusive interview with Fed Governor Adriana Kugler and New York Fed President John Williams. They'll be exclusive from the Reykjavik Economic Conference. That's at 7 a.m. and 9 a.m. Eastern, respectively. Let's get you some other top stories now that are trending on the terminal this morning. President Donald Trump is pushing lawmakers to hike taxes on some of the wealthiest Americans to offset some of the other cuts in his signature economic package. The president's proposal calls for a new 39.6% tax bracket for individuals earning at least $2.5 million or couples making $5 million. The current top rate for individuals is 37%. Tensions escalating in Asia after India said it neutralized Pakistani drone and missile attacks targeting several military sites on Thursday night. India's defense ministry says military stations in some of the northern cities were targeted and no casualties were reported. Pakistan denied that it launched the attacks, saying the claims were, quote, politically motivated. And in corporate news, IAG announcing a major order for 71 large jets from Boeing and Airbus to grow its network. The parent company, British Airways, is doubling down on its long-haul business to keep up earnings momentum with a $10 billion fleet investment. The company maintained its outlook, citing good demand for travel across its core markets. Coming up, as we've been discussing, U.S. and China negotiators head to Switzerland for much-anticipated talks. We'll have more on that coming up next on your Bloomberg Brief.
To Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Season is here.
Earnings season begins. Is corporate America in a good place?
Wall Street is bracing.
Bloomberg is first to break the numbers.
We got Delta, Constellation Brands.
The wave of big tech earnings.
We've seen a re-rating of earnings estimates.
I got to pay special attention to all this.
With the smartest insights.
Given the degree of uncertainty, you haven't really cut earnings estimates that much.
Anyone who says they have certainty on where the growth outlook is going, where earnings are going, is probably exaggerating.
Continuing coverage on Bloomberg.
Any country or any groups of country talking about isolating China, do you know what's the response? We chuckle. Because from my perspective, it's a mission impossible.
If the Chinese don't want to renegotiate, well, that's their choice. But it is American options for what they want to do that is driving this. It is not holding a gun to the head. It is trying to take a different course in history.
It's reasonable to expect that a similar approach could happen with China and that the negotiations or the tariffs could be paused for 90 days while the two sides negotiate. And I think almost anything less than that is going to be seen as a disappointment by markets and by observers.
We got some trade data out of China overnight, and it showed that exports from China to the U.S. dropped 21%. That decline, though, was made up with exports to other nations in Asia and Europe, which jumped 20 and 8%, respectively. All of that coming ahead of the U.S.-China trade discussions that are set to happen this weekend. Joining us now is Bloomberg's Jenny Marsh. Jenny, if we could just start with the data that we got overnight. Maybe it was expected, but does it reveal a threat that there are cheap Chinese goods that are dumped elsewhere in the world?
Absolutely. I think that is going to be the concern regionally now from China's trade partners. You know, even before this trade war kicked off with the US, the European Union had already been complaining about a glut of cheap Chinese exports, and so had many regional partners in Asia. And the data today just sort of reveals those fears are confirmed, really. You know, and this is just the data for April. Where tariffs are sort of rising throughout that month. So I think, you know, the expectation is that sort of the May data will show these trends even more starkly. So, you know, I think this data really does lay out here where the tensions politically are going to be for China as it tries to sort of build more friendships around the world during this fallout, while, you know, facing all these concerns about its exports going to other markets.
So that's the backdrop, perhaps, for a meeting this weekend with, from the U.S. side, Jameson Greer, the trade representative, as well as Scott Besson. What are we expecting from the talks in Switzerland, Jenny?
I think going in, you know, expectations are reasonably low for any sort of big deal. They're not going to come away with something which solves all of these issues overnight. But I think, you know, they haven't flown halfway around the world for nothing. We had a story today, sort of with people familiar with how the US is thinking, you know, and we're hearing that basically the US is going into this with a target of lowering tariffs to below 60%. And those cuts could go into effect as soon as next week. They also want China to remove export controls on rare earths that are essential for making magnets. There's been some sort of real trade and sort of pain around that area. And then from the Chinese side, they're getting close to sort of offering something on the fentanyl problem, which would then help the US lift tariffs on that issue. There was a 20% tariff there before the Liberation Day tariff came into force. So it does seem like there's an area sort of and potential for real progress, although obviously, you know, lowering tariffs to 50% even would still be enough to almost decimate trade between these two economies. But as a starting point, from this very sort of extreme scenario they've ended up in, it does seem like actually something could come out of this.
To what extent do we see from the Chinese side, especially this week with various moves from the PBOC, that this is a country getting ready to dig in its heels and deal with economic hardships that might come as a result of wherever the tariff level ends up?
That is definitely sort of the line they wanted to project. And it is hard to know, you know, how much of it is just sort of trying to position yourself to have the best negotiating power you have going into these talks. The Commerce Ministry again yesterday was saying, you know, that the US needed to remove all of the tariffs it's imposed in order for them to sort of make progress. And you did see Pan Gongsheng on Wednesday in the briefing that they held, cutting virtually every rate the PBOC has, giving across the board support to small businesses, tech innovation. And the signal there really was, we have the tools to support the economy from this hit, from the trade war, and we're ready for a protracted war. You know, if that's what we have to do, we have the tools to accomplish it. So I think the Chinese go in from a very strong standpoint. You know, what we're hearing too is that in some ways the US is underestimating just how confident the Chinese feel about this. I think, you know, Trump has talked about the Chinese economy being in bad shape and not being able to afford this. But I think from where Xi Jinping is sitting, he does feel like they've got everything they need to sort of tough it out, and the economy is a lot more resilient than the US is giving them credit for.
Jenny, thank you so much for helping us set up that conversation over the weekend. Jenny Marsh out of Hong Kong. Coming up, a new pope. We head to Vatican City for more on the first American pope. He's a Chicago man. We're going to get more on that coming up. Stay with us on your Bloomberg Brief.
Let us pray.
What makes it India's time?
It's us women who are going to transform India. I truly feel that the time for Indian women has come. They're not only breaking glass ceilings, but they are redefining, you know, whether it is in sport, whether it's in medicine, whether it's in creative arts. They are everywhere. And I have so much positive energy that comes back to me when I'm talking to Indian women. And I just think at all these little girls and boys, I don't want to discriminate, who are now in school-going age. Imagine once education, sports, we empower them. What a difference they would make not only to India, but to the planet and the world. And the world needs it now than ever before.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly.
There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
Let's get you some front page news and look at what's making headlines across papers. This morning, the FT on their front page. This is a surprising one. German stocks hitting a record high, which you maybe have missed. Trade optimism swirling in markets ahead of U.S.-China trade talks and the U.S.-UK deal. The DAX rising over 0.5% in early trading this morning. Germany also confirmed its new chancellor this week, and that Chancellor Merz talking about that he's spoken with Trump and they agree on the need for a trade deal. Next up, the Wall Street Journal cools that optimism with this headline. Trump's bespoke trade deal with the UK sets little precedent for other nations. Foreign officials telling the Journal that the deal, limited in scope and including niche issues, doesn't offer nations a roadmap in negotiations. And finally, on the front pages around the world, including Bloomberg, a White Sox fan called Bob from the south side of Chicago becomes Pope Leo as the world faces turmoil through conflicts and trade wars. We also have some live shots from Vatican City where Leo XIV is giving his first mass as the leader of the Catholic Church. That is not him right there. We heard from him earlier. Again, it is his first mass with the cardinals in the Sistine Chapel. For more, we are joined by Bloomberg Rome reporter Flavia Rotondi, who is outside the Vatican. Flavia, just give us a sense of a mood. We had the white smoke yesterday, a little over 24 hours, and we have our new pope.
Yes, good morning. Well, definitely quieter today. Yesterday, it was a chaos, I must say, here on the square, cheering crowds, high emotions, and also sense of surprise because, as you say, the Cardinal Prevost was not at the very beginning considered maybe one of the key contenders in this conclave, but his name actually started circulating after lunchtime yesterday, after first round of voting. Actually didn't manage to get a successful results, a quorum by the cardinals. And so the idea was that maybe the Italian contender, Parolin, and other Philippine contender, Tagle, might not be the right person. So yes, today is quieter, but at the same time, the agenda of the new Pope is already full, as you say, you just said, yes, he's actually celebrating a mass here in the Sistine Chapel, just with the cardinals, is kind of open to the public in terms of being broadcast live, but nobody else is admitted. From tomorrow, things will be different. On Sunday, there will be the official mass in St. Peter's Square. We actually will speak to everybody. And particularly on Sunday, I think the focus will be on the first message of the new Pope, what we want to achieve, what message he wants to send to the rest of the world, what the first reforms might be. We know that the new Pope is very knowledgeable from the point of view of from his theological point of view, has strong diplomatic skills, and so this should help him in terms of navigating these very difficult geopolitical times.
Okay, Flavia, thank you so much. That is Flavia Rotondi. And again, just beautiful shots there at Vatican City and inside the Sistine Chapel, where we're hearing from the first Mass from Pope Leo XIV, the first American Pope and Chicago man. I wonder what he has to say about the White Sox. Really, really gorgeous images. Okay, let's get a look at maybe a less gorgeous image and what markets are doing this morning. S&P 500 futures attempting to gain. We are still down on the week, though. We are basically unchanged. We're unchanged on the 10-year yield after yesterday's 10 basis point move higher. Coming off the show, nearly 80% into this earnings season, a growing list of firms warning unexpected damage from tariffs. We're going to catch up with Freedom Capital's Jay Woods. That's coming up next on your brief.
in Davos, you were asking a question of President Trump, and he didn't quite answer the question, and he asked you a question. So the question he asked you was something like, why are you not banking certain groups? What is the answer? I don't think he gave you a chance to really answer that question, but what is the answer to that question?
Well, first off, the Bank of America has 70 million consumer customers and millions of small businesses all over the country, all over the world. And so we bank everybody. But the real question was about overregulation, frankly. And so as you look, what's happened is because the interpretations of AML, Anti-Money Laundering, BSA, Bank Secrecy Act, KYC, know your customer's customer. You know, there's a lot of burden upon the banking system to both report suspicious activity reports and do a lot of analysis. And we have to close accounts, so we can't tell people why we did it. And often we're told by authorities to close accounts. That creates confusion. Another area comes up in this discussion is in the crypto area where the regulator said you can't bank crypto operating companies, employees of crypto companies, et cetera. We are allowed to do, we bank everybody, but the operating company, they said that's a high-risk activity. Ask us for authority, and guess what? You would have never gotten the authority. So that came up as an issue. So at the end of the day, it's about getting these regulations right.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
From our global headquarters in a very cloudy New York City morning, welcome to Bloomberg Brief. I'm Danny Berger. Let's set your agenda. All eyes on Switzerland. Representatives from Washington and Beijing gear up for trade talks over the weekend. Meanwhile, China exports to the U.S. slump, but soar everywhere else, igniting fears that cheap Chinese goods will flood European markets. And a slew of Fed speak on deck to wrap up a big week for central bankers as the Fed's dual mandate comes under pressure. We attempt to do something of a gain this morning, a weak attempt at that. It would be another day of gains. We did gain yesterday, but we're on track for a decline for the overall week. Michael Harden at Bank of America writing that the tariff-related rally is likely over. Buy the expectation, sell the fact. Russell 2000 dips 1/3% for this bond market. It was selling yesterday. 10-year yields moved higher by 10 basis points. A little change this morning, just under 438. Your 2-year yield, that's lower by just about 1.5 basis points at 385 this morning. Let's now get some stocks that are moving underneath the surface. Here with that is Bloomberg's Joe Easton. Hey, Joe.
Hey, Danny. So Expedia, really the stock catching their eye at the moment. We're down close to 10%, now around 9% for Expedia. The company cutting its booking forecast, citing weakness in terms of tourists coming into the United States, kind of what we've seen in the industry data at the moment. So that one, a real weak one today. Then a couple of decent movers to the upside. Firstly, Pinterest in social media. The company says it's harnessing its AI capabilities to entice companies to advertise on the platform. Now 570 million users of Pinterest, according to their statement. That one up almost 13%. And then Lyft cutting its prices in order to take market share away from Uber. It's kind of exactly the opposite to what we saw from Uber earlier this week, with Lyft beating expectations, sending that stock up almost 8% in the pre-market. Keep an eye on Lyft ahead of the open in New York, Danny.
Joe, excellent work this week. Thanks so much for joining us. That is Bloomberg's Joe Easton. And look, Joe underscored it there. It has been a busy week. In fact, it was the busiest week of U.S. earnings of this quarter, and it is now drawing to a close. And companies have been reporting tens of billions of dollars in expected damage from tariffs. Both Ford and Nvidia, for example, warned of at least a $5 billion hit. Many others declined to give any guidance at all. In fact, the word uncertainty was said more than 9,000 times in earnings calls. That's more than COVID, and the most ever recorded in Bloomberg data. Well, one man who's been watching earnings very closely, Jay Woods, Chief Global Strategist of Freedom Capital Partners, joins me now. Jay, so wonderful to see you.
Good to see you.
Has this been a fun earnings season?
It's been a crazy everything season. Every time you turn around, there's a new headline. This weekend, we're probably not going to get the rest as we watch what's going on in Switzerland.
Correct.
So, you know, one data point at a time, as Jerome Powell says, and we'll deal with what comes later today.
Well, what have been your takeaways from this earnings season? It's been very uneven as to whether we hear about some damage, whether we don't know, a couple bright spots. What did you leave with understanding about corporate America?
Well, you just nailed it. Uncertainty is the word of the year, maybe the word of the decade at this point. 9,000 times. That's insanity. Jerome Powell used it 13 times, or a variation of it, just in that Fed meeting. So we are at the whim of Washington. We're going to continue to be, but now we're watching that guidance. Look at what Apple did. They gave 2 sets of guidance. If the tariffs continue in this way, we could lose $900 million. For GM, they kind of pulled back and they said the tariffs are going to have severe implications. So this uncertainty theme continues until we get some clarity. We may get some clarity on data next week, but what we're looking for is clarity out of Washington. So we got to deal with our little brother in England. Okay, great. You know, this is what we expect. But what's going to happen with China? You know, Britain just did a deal with China. It took them 3 years to hammer out this deal. We're supposed to do 90 deals in 90 days. I think the market is getting tired of hearing this rhetoric, and now we are at very interesting levels to watch. But on the earnings front, watch Walmart next week. We want to hear guides. Walmart gave a pretty bad guide. Well, it wasn't pretty bad. It's still unbelievable for Walmart, but they reined in their earnings last quarter. The stock has never recovered. It got back close-ish to those levels, but now it's starting to turn over again. Let's see what the shelves are, what the inventories are looking like, and what their future prognostications are, because if they cut guidance again, if they warn, I think that's a sign of what's to come over the next 3 to 6 months.
Is that a sign that just consumer discretionary, consumer staples, that you can't really be buying that sector right now?
You want to stay away. Some of the staples with nice dividend plays are okay. Coca-Cola is doing great, but yeah, it's hit or miss within that sector. To me, we've had a nice relief rally in discretionaries. It rallied, I think, 15% from the low. Technology up 21% from the low. These, to me, are relief rallies, and right now we're at this pause. And as a technician, where did we pause? Right under the 200-day moving average. Where didn't we get back to? Right before when Trump was elected, 57.83. So 57.45, 57.83, these are levels. And then the price action yesterday, we rallied. Trump said, go buy stocks. And guess what? At the end of the day, that last 30 minutes was pretty ugly. So let's see what we do today, what comes out over the weekend. If we get good China news, then, you know, all bets are off. We're going to probably rally a little higher. But, you know, COVID. We were down, you know, below that 200-day moving average for 2 months. You know, a V-shaped bottom recovery. People expecting that V-shape. We got a lot of work to do. There's been a lot of damage done. Too much uncertainty. So we got to wait and see.
It is remarkable. It feels like this is an administration that is throwing trade headline after trade headline, maybe intentionally, maybe not, at this market, trying to get it to rally. I mentioned before, Michael Hartnett of Bank of America said, just fade that rally, that we basically have gotten as much juice as we can get out for these trade deals coming forward. Would you also fade any of these trade-related headline rallies?
That's what we've been talking to with the Friends of Freedom. We've been just saying, you know, let's go back to the sideline. You know, there were some good opportunities. When this market washed out, it was overdone. Sentiment at historic lows. Now, you know, the RSI oversold, came back. So we had signs of the washout. I think the lows are in. For us to get back to where we were, to have that kind of fear, that kind of panic, I don't know what it would take us right now. But the earnings have been okay. You know, 78% beating right now in the S&P 500. You know, 402 reported. A little lower than last year at this time, but still solid given the cloud of uncertainty. So I don't know what's going to be that catalyst to take us back over and get us on that winning track to talk about new highs. That seems foolish. The S&P is down 3.2% for the year. April was almost flat, but the volatility in between there has been crazy. We'll get pockets of it now and then, and we'll see what happens over the weekend.
You also mentioned before that tech has done so well over the past month. And even in the tech earnings, they're still spending big numbers. I think both Meta and Alphabet, somewhere around $70 billion for CapEx.
Yeah.
Does tech continue to be this beacon of safety like we've seen it been in other turmoils like COVID? Or are we just repeating that playbook?
Well, pockets of it, yeah. The CapEx spend was like, if you could pull back, that's where you should pull back, but they're not. So that is a good sign of things to come. But I think all eyes are going to be on NVIDIA on the 28th, I believe they report. That is where the CapEx spend goes. So let's see how that's polling over. They have not recovered from the DeepSeek sell-off in January, and their news has been okay with the exception of that little warning. So to me, NVIDIA will be a tell, but until we get to that, I would take profit in some technology names, although we got good earnings. Disney was great this past week, and technically, it's turned the tide. So if this pulls back to 199, I think it's a good opportunity to buy. I wouldn't chase right now. Uber, not a bad quarter. Yes, we focused on gross bookings, but overall the numbers were solid. And technically it broke out above 80. Risk-reward setups are there. So there are pockets of strength. Technology, Meta, and Microsoft doing well, but Apple breaking 200. So it's an individual stock picker story, which it always should be, but the tide is not going to lift all boats in this market, so you really have to sift through the rubble to find the winners here.
Jay, I feel like if we were to ask most people who are more casual observers of international markets, and we said, what is the DAX doing right now? I don't think many of them would think that it's at an all-time high. No. What do you make of that?
Well, Europe is where it's at right now. If you look at the global markets, the U.S. is the laggard. So we've seen a rotational theme away from America into the European markets. How long does it last before that American exceptionalism comes back? It's going to take a few tariff deals and a little more simmering of the rhetoric that we've brought upon ourselves. So right now, yeah, Germany looks great. Japan is come back. I mean, there are a lot of foreign markets that you would rather be in right now than the U.S. And if you're looking for safety, these are safer markets. It's more stable.
Well, Jay, I wish you the best of luck for this weekend. I'd say I hope you can relax, but I think we both know no one is going to be relaxing this weekend.
Yeah, we'll be following Twitter pretty closely. So.
At least we got a new pope. There's some exciting news there.
That is exciting. Pope Leo.
Pope Leo the 14th.
He grew up, Philadelphia area. Us Philadelphians are taking credit for him. But
all right, I think that's fair. We'll give it to you. I think every country, Peru is also taking credit. There's a lot out there.
They should. But let's see if he can fix the White Sox. I know he's a big fan. That would be a miracle.
I'm sure there are going to be a lot of prayers going that way. Yeah. Jay, it is such a pleasure to have you. It's been far too long. Please come join again soon. That is Jay Woods of Freedom Capital Markets. Let's get you some other stories now that are trending on the terminal this morning. China's exports to Asia and Europe soared last month, while volumes to the U.S. slumped due to eye-watering tariffs at 145%. The data is the first glimpse at the damage of the trade war. Shipments to the U.S. fell 21% from a year earlier, with many analysts predicting that sustained tariffs will eventually see a trade relationship worth $690 billion last year crumble to zero. President Donald Trump is pushing lawmakers to hike taxes on some of the wealthiest Americans to offset some of his other cuts in his signature economic package. The president's proposal calls for a new 39.6% tax bracket for individuals earning at least $2.5 million or couples making $5 million. The current top rate for individuals is 37%. Tensions escalating in Asia after India said it neutralized Pakistani drone and missile attacks targeting several military sites on Thursday night. India's defense ministry says military stations in some of its northern cities were targeted and no casualties were reported. Pakistan denied that it launched the attack, saying the claims were politically motivated. Coming up, cuts and relief. The Trump administration mulls changes to tariffs against China. Ahead of this weekend's meeting, we'll have the details next on your Bloomberg Brief.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
But what about the diagnosis? If the diagnosis at the end is worries about growth rates,
Yeah.
how do you get from point A to point B? Why do you worry so much about that end goal of better growth?
Because if we can't grow, you're going to have a much more inflated debt to GDP and federal deficit, and that's not good for the economy. Growth is really critical, and I think what's underappreciated is what the inputs are to get to the growth number. And so we talked a little bit about productivity. I hope that we can continue to produce at 2% indefinitely on productivity. I think that would be great. But you got to make sure you have the other levers in place, I think, to buoy that. So if you look back over the last several years, we've had 8 million immigrants come into this country in the last 4 years. And that's helped growth. And by the way, that's deflationary.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Any country or any groups of country talking about isolating China, do you know what's the response? We chuckle, because from my perspective, it's a mission impossible.
If the Chinese don't want to renegotiate, well, that's their choice. But it is American options for what they want to do that is driving this. It is not holding a gun to the head. It is trying to take a different course in history.
It's reasonable to expect that a similar approach could happen with China, and that the negotiations or the tariffs could be paused for 90 days while the two sides negotiate. And I think almost anything less than that is going to be seen as a disappointment by markets and by observers.
The Trump administration considering a significant China tariff reduction. As the team gears up for trade talks, the meetings are expected to take place in Switzerland over the weekend with U.S. Treasury Secretary Scott Bessent, Trade Representative Jamieson Greer, and Chinese Vice Premier He Lifeng. All will be there. For more, we are joined now by Bloomberg's Josh Gallo. Josh, what are we expecting this weekend?
Well, all eyes are going to be on Geneva, where Bessent is meeting his counterparts. And I think the main thing that we're looking for here is de-escalation. So both sides have really dug in over the last several weeks. The tariffs are at 145% with China for the U.S., and I think the goal going into this is for both sides to reach some sort of an agreement that can signal that they're on a path to talking through these problems. So Sean Donnan, our reporter in Washington, he's written that the U.S. is ready to perhaps drop that 145% rate that's there down to 60 as an initial gesture of easing tensions. They're going to be looking for some assurances from China on imports of rare earth materials that are used for magnets, the fentanyl crisis, things of that nature. But really, this is initial. This is not going to be the details. We're looking to see something that sets the stage for the next few months of negotiations to see if things can move forward in a more detailed way.
Well, speaking of things that set the stage, we finally got the U.S.-UK trade deal yesterday. 10% tariffs stay in place with just some adjustments around the edges. Josh, to what degree is this, or is it not, a blueprint for negotiations going forward for other countries?
I think it's certainly a blueprint for other countries, but not necessarily every country. So the administration here is signaling that, of course, they took a really firm stance in April with all of their reciprocal tariffs. And, you know, the UK is obviously a country that Trump himself has always wanted to have a big trade deal with. But even there, So we see this initial, what's billed as a success by the administration, but it is really bare bones. So I think what they're signaling is that this immediate approach that they took in April with these high tariffs can quickly rebound into a more palatable general level if countries come to the table and if countries that offer some sort of sacrifice that the U.S. is looking for. Trump on many levels, not just trade, oftentimes wants to come in hard and then, for political reasons, signal some sort of victory, which he clearly did with the U.K., but the details there are scant. So again, that could be what we see out of China too, some sort of initial framework style agreement about moving forward. But it does look like a playbook, but I'm not sure it's going to function for everyone.
Elsewhere in Washington, Josh, we have Trump campaigning lawmakers to seek a tax hike on wealthy individuals earning $2.5 million or more. I think the figure is something like $5 million for couples at a 39.6% tax bracket. Is this something that can actually get through Congress?
Well, look, it does seem possible. More than a month ago, they were suggesting raising that rate on people earning $1 million or more. And since then, now it's up to $2.5 million and more annually. So, they're trying to balance the massive tax cuts with the fact that they have a very, the Republican Party, that's not going to hit many of their voters across the country, right? They're going to have to show that the tax cuts are not just going to be borne by people earning less, that people earning more are going to pay part of that bill. So, in the broad scene, it's against Republican orthodoxy to then have a tax increase on the wealthy. But you have to look at this more broadly. Are people who are earning $2.5 million a year on net, are they really going to experience a higher tax burden if the whole package goes through? I think the answer is probably no. The estate tax has been doubled under Trump. The estate tax exemption has been doubled under Trump in his 2017 tax cuts. You have to look at capital gains, things like that greatly affect that segment of the population. So, and again, 37% to 39.6% is not necessarily the kind of increase that would break someone's back at that point. So, and I think Bloomberg has estimated with the tax foundation that's less than $70 billion in additional tax revenue over 10 years. They're looking for massive tax cuts in the trillions. So, again, we'll have to see. I think that the more populist Republicans in Congress would be happy to see that go through.
Josh, thank you so much for joining us this morning. Enjoy your weekend. That is Bloomberg's Josh Galou. Now, over in Europe, earnings continue to roll in. IAG beat estimates for revenue and announced a major order for both Boeing and Airbus jets. That's the largest order for the parent company of British Airways in recent years. For more, let's bring in Bloomberg TV's own Guy Johnson. Guy, great to see you this morning. We also saw part of this order specifically with the Boeing jets tied to the UK-US trade deal. At least that's what the team Trump started to tout. So can you separate for us the politics of this deal versus actual need for IAG?
So IAG, this order started a long time ago. IAG has been looking to expand its long-haul fleet, and this is part of that story. It's part of an ongoing story. We have seen another big order from IAG only a few months ago. So this is part of a long-term strategic plan that IAG is pushing through to expand its wide-body fleet. Part of it is going to be for replacements of existing aircraft. They've got a lot of 777s, Boeing's 777 in their fleet at the moment. Some of the 787s that they're ordering will replace those aircraft. But they're also looking to expand as well. So that's the kind of the fleet story. They want to expand the fleet. So what is interesting about this order, Danny, is that there is an element of politics to it. So they are ordering Boeing aircraft and Airbus aircraft, but it's interesting to where those aircraft are going to go. So the Boeing aircraft are going to go to the UK, and the Airbus aircraft they're ordering, A330neos, are going to go to other parts of the business, for instance, Iberia, Aer Lingus, other parts of the business that are inside the EU, two different jurisdictions. So Boeing goes to the UK, and that is now being facilitated by this new trade deal, which will make that a lot more possible. and the Airbus aircraft go to the EU. Now, this is raising interesting questions for others within the region. For instance, Michael O'Leary over at Ryanair, probably the biggest importer of Boeing aircraft in Europe, or Carsten Spohr over at Lufthansa. He's got a load of 787s. I think they're already built. I think they're sitting at Charleston right now. What does he do with those? Because it looks like the Boeing Airbus story could become part of the EU-US story, and we don't know which way that's going to go. So this is part of a long-term plan. It was already in train. But it's interesting that we are seeing actually the tariff story, the politics story, having an impact here in terms of where the different aircraft are going to go within the IAG fleet and where it is possible to import those aircraft without any tariff hit coming through. So it's a little bit of both. There is a tariff story here. There is a deal story here. But there's also a long-term fleet planning story as well, Danny.
Guy, it is so fantastic to have you on. Thank you so much for joining us. That is Guy Johnson in London in the latest for IAG and Boeing and Airbus. Coming up, we're going to wrap up the week with a deluge of Fed speak. We also have trade talks over the weekend. We're going to break down your diary for the day from a cloudy New York City coming up next on your brief.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Good morning. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
Let's get you set up for your trading day on this Friday. We're going to get a slew of Fed speak on deck. That starts with Governor Michelle Barr. That happens basically now. Plus, don't miss our exclusive interviews with Governor Adriana Kugler, 7:15 a.m. Eastern. Over the weekend, trade negotiators from the U.S. and China meet in Switzerland. Quickly, let's just get through some earning movers. Pinterest extending double-digit gains. It topped estimates. Lyft, that is up more than 7.5%, also rising its bookings beat. Finally, Expedia, that fell 9.4%. Softer travel demand. Piper Sandler also cut to underweight after that move. All right, that is it for your Bloomberg brief this morning. Surveillance will take the reins from here. This is Bloomberg.
in 2000, post-Napster, generally everybody wrote off the recorded music industry, including the investment community. And I didn't mind that chapter because then I got left alone. And actually, I think out of that period, we started to create better art because the pressure wasn't on from the technology to be the most powerful chapter. And then iTunes came in, and iTunes, to Apple's credit, did have a boutique taste mentality about the store, which meant that I think they understood. I can tell you from that period that the artists that came through were of a very high quality because it was encouraged to be boutique. Now, ironically, this chapter has made us more money times 5 than the iTunes chapter and the post-Napster chapter. But an algorithm tells you what you want, not what you might like. And there's a difference between what you want, but with streaming, the downside is you have incredible penetration, and we have hundreds of millions of people around the world. And so that has been very lucrative as a business.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Ottawa, Canada, and this is Bloomberg.
It's going to be a real bumpy road on this whole tariff process.
At this point, rubber needs to meet the road. We need to actually see some numbers here.
This is a process. It's going to take time.
This is a really big shock that's coming at the economy.
The damage is already being done. The rest of the world now sees the U.S. not necessarily as a very credible trading partner.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Heading into the weekend, preparing to negotiate.
Mr. President, if the talks go well this weekend between Secretary Bessent and Ambassador Greer with their Chinese counterparts, not preemptively, but if the talks go well, would you then consider lowering the tariff rate on China?
Well, it could be. I mean, we're going to see. Right now, you can't get any higher. It's at 145, so we know it's coming down. It's going to be very good for both countries. I would like to see China open. I do think they have far more to gain than we do in a sense, but we're going to have I think we're going to have a very good weekend.
Setting up for talks about talks with China. Delegations from both nations heading to Switzerland. The team here at Bloomberg reporting the U.S. side has set a target of reducing tariffs below 60%. Investors are hoping there's a whole lot more to come.
Maybe what we've learned over the past week is that Trump is perhaps a little bit concerned about the damage that he's wrought with some of his discussions about taking hard talk, saying you better go out and buy stock now. Stocks sort of gussied up and said, wow, we feel recognized. There is this question of how much of the talks actually gotten done, how much can they get done, and how much has this president changed his tone when it comes to conciliatory talk?
Some deals are easier to strike than others, and I think the UK deal, the administration themselves suggested the UK deal will be easier to strike than others. This from Europe just in. The European Commission President, Ursula von der Leyen, saying, I want a trade package ready if I'm going to visit Washington, D.C.
Well, the talks are ongoing when it comes to the European Union and this administration. I actually caught up very quickly with Jameson Greer yesterday walking outside the White House, and I said, is Europe very low on the totem pole when it comes to this list of deals? And he said, we are willing and ready to negotiate with anyone that comes to the table with also plans ready to negotiate. So potentially this is von der Leyen and an olive branch saying, I have something, potentially if I come to Washington, D.C., I want to sign it, just like the United K did.
You're already seeing this story in the data, the trade data out of China. Exports to the U.S. down 21% from a year earlier in April. Where were they up? Across Asia and across Europe. Exports to the EU up 8% over the same period. This is the discussion we've been happening. Central banks abroad are facing potentially a disinflationary shock, and that's reinforced by the data we saw overnight.
Which is the reason why you're starting to see negative yields make a comeback in places like Switzerland, because the appearance is there is this ability for central banks in Europe to cut because of these disinflationary impulses that maybe are unique relative to the United States. Look, there is a real question about how these negotiations can go when Europe agrees that this is a problem. I will say Europe, most of Europe agrees that this is a problem to get cheap exports from China, but they are not negotiating necessarily as a bloc, and that's what needs to happen first.
When you see exports of Chinese goods on other economies going up and lower in the United States, it also proves that other economies are going to want to see a trade deal between Washington and Beijing, because they don't want their economies to be dumping grounds. And I spoke to their Treasury Secretary about that 3 weeks ago, and he talked about how the Chinese economy is not going to stop manufacturing. It's like that movie Fantasia in Disney with a bucket and the broom, and it just keeps going and going. They will dump somewhere, and we see in this data they actually are.
I never enjoyed that production at all as a kid. Anyway, equity futures on the S&P. I don't know how much you're enjoying this. Equity futures on the S&P positive by 0.2%. Coming up this hour, Max Kentner of HSBC, as the president says buy stocks. Ed Mills of Raymond James previewing US-China trade talks. And Tom Tsouras of Strategas as Trump keeps the pressure on Fed Chair Jake Powell. We begin this hour with Stock Steady ahead of US-China trade talks. Max Kentner of HSBC with this to say, remaining cautious against the backdrop of volatile policy conditions and high uncertainty. It is difficult to envision a scenario in which this resilience of risky assets persists. Max joins us now for more. Max, welcome to the program, sir. Looking forward to the weekend. Can these talks and the hopes of deals continue to persist this equity market? Has been a story, a question we've covered for the last several days, Max. What do you say back?
Yeah, good morning. Look, I think we have this dilemma right now between, on the one hand, the hopes for trade talks or successful trade talks, on also, of course, on the other hand, also positioning and sentiment data, particularly from systematic strategies. Think things like volatility target strategies. Think things like risk parity strategies or CTAs, trend following strategies. At least on our measures, there the positioning, the exposure is still really, really low. So yeah, any kind of whiff of positive news around trade talks that could propel us a bit higher. But of course, on the other hand, that's the dilemma that we're facing, that pretty much all the leading indicators that we are tracking are really pointing south. And that is not south in terms of, oh yeah, it's a little bit worse, but we're talking COVID levels or we're talking financial crisis levels. And the difference to, I would say, 2-3 months ago is 2-3 months ago, you could have argued that's just consumer sentiment, ignore it, it's no longer working, because it really is dominated by this political division between the responses from Democrats and Republican-leaning consumers, whereas now it is, of course, it's capex intentions, it's labor market conditions, it's CEO confidence, it's regional Fed service, it's the new order outlooks, right? It's things like shipment expectations. So it's across the board where we are seeing the weakness. And that is what I am scared about. I think not only just the next sort of 2-3 quarters, but specifically the next month or two, that already now we're going to start to see some disappointments on some of the hard data, which I think is enough because, let's face it, the narrative is still very, very broad-based. This is not a recession. This is just a slowdown. It's just the soft data. The hard data is keeping up. And therefore, I think a couple of hard data points disappointing is already enough to send us a bit lower.
Max, you know what the response would be? Look at claims are okay. Look at payrolls on Friday, payrolls are okay. What do you say back to people when they raise those data points? Do you say, well, wait another month, wait another 2 months? What's the calendar look like for you?
I mean, that would be exactly my response, wait another month or wait another 2 months. Look, I think on jobless claims, there is actually a basis for saying in the next 2 months, we could see a bit of a seasonal pickup into summer because we've had that in 2023 as well and in 2024. Remember this time last year, we've had sort of the peak in yields. We've had the peak in 10-year yields, and then we had negative surprises, and we had in particular jobless claims picking up sort of 40, 50,000. Nothing dramatic, but we had, of course, things like, you know, the auto plant shutdowns in Michigan. So we have things like the hurricane season, school holidays. All of that could propel us a bit higher. Again, nothing dramatic, but perhaps 40, 50,000 higher over the next really specifically 2 months. We are seeing that seasonally normally beginning at the end of May until sort of the third week of July, most likely, right? So it's really a case of the next 2 months. And let's face it, we're also probably going to see in the next 2 months the first effects from Doge, because of course, a lot of those 3-month pay packages are running out. So we could be seeing perhaps a couple of thousand or so in those jobless claims. Again, nothing dramatic, but something that perhaps puts us really quite close to the 300,000 mark, at least temporarily over the next 2 months. It might easily be a head fake when we look then into the second half, but I do think if that really happens in the next month or 2 months, that is enough to, you know, get you guys, for example, going in Bloomberg and saying, oh, are these the cracks in the labor market? I think then we'd be all waking up and on the terminal we'd be saying, oh, you know what, these are the first cracks that we are seeing. And I think that already would be the first sort of hard data points that would be pointing to the downside.
I love your impression of us, Max. Thank you. I am curious. You did say that you do see a sort of surprising amount of resilience in risk assets so far. What kind of downside are you expecting, and would get you, frankly, interested in U.S. risk assets?
Yeah, look, when we look at cyclicals over defensive, so the ratio of cyclicals defensives globally in equities, that is around 9 percentage points away from our top-down estimates, top-down sort of revision estimates and fundamental indicators that we've got. So I do think it's particularly the cyclicals, right? Again, 9 percentage points. It's particularly the cyclicals that have rallied really a little bit too much and are pricing in a bit too much hope and a bit too much hopes for this is just a one-off, and if anything, it's just the soft and the survey data, and if anything, it's just a growth scare like last year and summer as well. Let's face it, particularly long-only investors, at least on our measures, have also not moved particularly strongly. Yes, they've sort of cut their overweight in equities, but they're still slightly overweight. They're still nowhere near even neutral. And in particular, they're nowhere near that underweight stance that they were having on consensus, particularly the real money investors that they were having during 2022, during that bear market. We're miles away from that. So that is, I think, where we are waiting for the first couple of hard data points to disappoint. And that, I think, would then get us going in terms of a bit more selling coming from discretionary and particularly long-only investors.
It seems like there are two different ideas embedded in your call, Max. There's the policy uncertainty, which remains a question, and whether we can get some more certainty, not only with the UK-US deal, but over the weekend. And then there's the damage that's already been wrought. How much is your concern the former and ongoing policy uncertainty, despite some of the more constructive talk we've heard? And how much is it the latter, the idea that you can't put the toothpaste back in the tube and that the damage is already a de facto reality that's going to be in the data in a couple months' time?
Yeah, I think it's more the uncertainty, really, because so let's hypothetically go through a scenario where we wake up tomorrow and the administration decides, look, tariffs were not particularly the smartest idea. Let's scratch it entirely and let's move on to only deregulation, tax cuts. Let's perhaps cut the SLR for banks, for example, so only the supportive stuff. Then I think we could comfortably say any kind of disappointments in the data going forward in the next month, 2-3 months, any kind of disappointments there, the market is comfortably going to look through that because that's based on the old policy setup. Now we've got the new one. The possibility of that, or the probability of that, is maybe it's a slight, ever so minusculely slight tail risk, but it's extremely low. So to me, it's really the continued uncertainty, even though, we might have some further deals. I think John was saying it in the very beginning. The US-UK trade deal, of course, was pretty much the lowest of the low-hanging fruit. So therefore, I'm not sure if I'm reading too much, or if I'm getting too much comfort from that. The big ones are European Union and China. And if we see further uncertainty prolonging over the next 2-3 months into summer recess, into the summer holidays, then suddenly we're talking September. And then, CapEx intentions continue to be really low, continue to be delayed. I think that is then really the much more crucial one rather than just looking at the hard data. The hard data is crucial right now because the narrative of it's just the soft and survey data. That narrative is so entrenched. So that's why specifically right now the hard data is really important. But overall, I think it's really that prolonged, extended time of uncertainty that really is a drag overall on activity.
But Max, yesterday the president was saying that he's expecting substantive talks with China and that the rate at 145% is going to come down. So what happens Sunday evening if they come out and say we're cutting the tariff rate to 50% on China?
Yeah, I do think, however, that is pretty much market chatter. I think, I'm not sure if I would call it overall consensus, but I think that is something that's been sort of touted quite strongly already. So I'm not sure whether, you know, we wake up on Monday, we're like, oh my God, this is so surprising. You know, we'll need to send US equities up another 2%. I think that's pretty much expected at the moment. So from that, again, I'm not taking too much comfort.
Hey, Max, if you had a market birthday wish for this weekend, what would it be?
You know, it's probably one where I would say perhaps, at least for our view, perhaps less positive news, you know, and people really realizing that uncertainty is not going to get away. I think on the weekend, of course, the problem is it's probably the wrong period for me to wish anything for because, of course, we're not going to get any hard data. It's really perhaps next week retails, next week CPI, for example. Perhaps if we get CPI, particularly goods prices, already higher than expected, that already would tell people, oh, you know what, we're already starting to see the effects on tariffs now. But for that, Saturday, Sunday, luckily, is off, and we're going to wait until next week.
I'm just honoured to share this birthday with you, Max. Happy birthday, sir. It's good to see you.
Thank you.
Thank you. Max Kentner of HSBC. Equity futures near session highs here, up 0.25% on the S&P, with an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahara Arnold. Hey, Yahara.
Hi, John. President Trump wants to raise the tax rates on some of America's richest people to offset cuts in his economic package. Sources telling Bloomberg Trump wants a new 39.6% tax bracket for people making at least $2.5 million or couples making $5 million. President Trump is calling for a 30-day ceasefire between Russia and Ukraine and threatened additional sanctions if conditions were not met. Trump's comments contradict Vice President J.D. Vance, who said the U.S. has tried to move beyond the obsession with a 30-day ceasefire and focus on a long-term settlement. And Cardinal Robert Francis Prevost has been elected the new leader of the Roman Catholic Church. The 69-year-old is the first pope born in the United States. He is also a citizen of Peru, where he spent much of his life as a missionary and archbishop. He chose the papal name Leo XIV, and he's currently celebrating his first Mass as pontiff. That's your Bloomberg Brief. John?
What a special time to be in Rome. Yahara, thank you. More from Yahara later on this hour. Up next on the programme, the US and China coming to the table.
Mr. President, if the talks go well this weekend between Secretary Bessent and Ambassador Greer with their Chinese counterparts, not preemptively, but if the talks go well, would you then consider lowering the tariff rate on China?
Right now, you can't get any higher. It's at 145, so we know it's coming down. But we're going to have I think we're going to have a very good weekend.
This week never ends. US and China trade talks this weekend in Switzerland. A preview with Ed Mills of Raymond James up next. Live from New York City this morning. Good morning.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything.
Don't miss this. Later on this morning, 8 a.m. Eastern Time, a few hours away, Dr. Navarro, the senior trade advisor to the President of the United States, a conversation on trade heading into the weekend, looking for talks between the U.S. and China. Equities right now in the S&P 500 firmer by 0.25% following a two-day winning streak. We add just a little bit more weight to the index, the S&P at 0.26%. Under surveillance this morning, the U.S. and China coming to the table.
Mr. President, if the talks go well this weekend between Secretary Besson and Ambassador Greer with their Chinese counterparts, not preemptively, but if the talks go well, would you then consider lowering the tariff rate on China?
Right now, you can't get any higher. It's at 145, so we know it's coming down. It's going to be very good for both countries. I would like to see China open. I do think they have far more to gain than we do in a sense, but I think we're going to have a very good weekend.
Will you speak to Xi after the weekend talks?
I might, yeah, sure.
Here's the latest this morning. The first trade talks between U.S. and Chinese officials beginning tomorrow in Geneva. Sources telling us here at Bloomberg, the U.S. is targeting a reduction of the tariff rate below 60% as a first step. Joining us now is Bloomberg's Tyler Kendall for more. Hey, Tyler.
Yeah, hey, John, good morning. Well, if the talks go well, Bloomberg News is reporting that U.S. officials feel that China may be willing to match that tariff rate below 60% and that it could be implemented as soon as next week. But people familiar caution us that things are far from certain, not to mention that Bloomberg Economics says that they do not expect an immediate agreement or a permanent de-escalation after these talks, but that if President Trump wants to get ahead of fears when it comes to empty shelves, tariff rates do need to come down significantly and fast. Now, the White House maintains that China really needs to be the one to de-escalate first here, and that could look like a range of things, including increasing purchase orders, also maybe tightening controls when it comes to fentanyl flows, but then importantly, loosening curbs on critical and rare earth minerals. Our reporting indicates the latter, that's pretty high on the U.S.'s priority list. Now, of course, the other side of this is that China is holding firm that they would like the U.S. to remove tariffs on a unilateral basis. They say that the U.S. put the tariffs on first, so they should take them off first. But it's something that this White House has publicly ruled out. At the same time, though, it's uncertain what the U.S. will commit to and what the U.S. is willing to accept. And officials tell us that's all by design. Going into this weekend, they are focused on strategic uncertainty. But, John, President Trump made it pretty clear to Anne-Marie in the Oval Office yesterday he does think that these talks could be constructive.
Tyler Kendall down in Washington. Tyler, thank you. I think they've all been pretty clear in the White House. They all seem pretty aligned on bringing tariffs down from around 150%, somewhere closer to 60. What is achievable beyond that? Joining us now is Ed Mills of Raymond James. Ed, welcome to the program, sir. What are you telling clients about that? What's reasonable? What's achievable?
Yeah, so I think that the key things here are exactly what you reported. Getting those rare earth mineral restrictions off, that's going to be a key ask of the U.S. government, because when we look at those rare earth minerals that China is restricting, we have about a 6 to 9 month supply of that. After that, a lot of industrial capacity, John, in this country goes away. Something that is under the radar, though, that I think is really important to China and really important to retailers here in the United States is there is right now a penalty on Chinese ships. Any of their tonnage has a massive penalty that's going to prevent a lot of ships that are carrying goods from other countries from entering U.S. ports. So that's something that this Trump administration can take away, short of completely taking off tariffs. That would probably do the biggest thing to get more ships coming into U.S. ports and more goods coming into our economy, John.
Ed, when it comes to the potential rate that the U.S. administration can set, a new rate when it comes to China, what's your base case?
Yeah, Anne-Marie, first of all, great questions and really getting to the point here in terms of getting understanding of what Trump is willing to do. I have heard that the rate going forward could be in that 50 to 60% range for national security goods, potentially lower for non-national security goods in that 30 to 40%. That's what the China committee recommended last year. But it is pretty remarkable that we could have a market positive event where the tariff rate on China is only in the 50 to 60% range. But that's kind of how Trump does things. He really moves the goalposts to 145%. So anything less than that gets celebrated by this market. The one thing that you could see things potentially lower is on those sectoral tariffs. Are there things that are really critical for the United States to get in the near term? You saw that as a key component of the UK deal. And so is that a format going forward? Howard Lutnick was on your ear last night saying that is probably the one way in which you can get lower tariffs on goods outside the baseline for your country.
Any meetings we see between the Chinese and U.S. representatives usually end up being just long lists of grievances. What are the Chinese coming to the table with that potentially a concession that then Trump could end up lowering the rate to 50 or 60%?
Yeah, so I think President Trump cares a ton about fentanyl, and I don't think you can ever underestimate that. I think it gets pushed aside, but that's really what led these conversations to begin with. Now, there is the 20% fentanyl tariffs, and I don't think that those necessarily come off. But if China comes and says, we are going to be serious about the crackdown and making sure we know where the base materials are that go into fentanyl, and if we're restricting that, that would be something that they absolutely would get a positive reaction from this delegation. I think when I look at the delegation, Anne-Marie, one of the good things here is that it is led by the Treasury Secretary Besson. You do have U.S. Trade Representative Jamieson Greer going, but you do not have Peter Navarro going. So you can at least have a constructive dialogue versus a complete airing of grievances. So in many ways, what China is bringing to the table is the fact that they're willing to show up at the table. Anything from there, I think, is going to be very positive.
We have Peter Navarro coming on shortly, and we can ask him about that. I am curious what we learned from the UK-US negotiations that can be potentially applicable to what may transpire over the weekend between the U.S. and China, or is this really apples and oranges at this point in terms of the nature of negotiations?
So, Lisa, I think that the UK deal is probably more applicable to other countries. Can we get similar kind of concepts of a plan, if you will, with Japan, South Korea, Australia? India kind of seem to be at the front of the list. What I get asked a lot at Raymond James is, when are we going to get something with Vietnam? Because that's so critical for a lot of consumer goods that come into this country. I think that might be a tier 2. And so as it relates to China, just starting these conversations is going to be the #1 priority. I think it's going to be the longest negotiation that's out there. I think what we learned from the UK deal, Lisa, is the fact that we get some kind of details, but a lot of it is to be determined later. That is one thing that gives me a little bit of pause in this market, is that if that is only going to signal that the uncertainty is clearly going to be prolonged, that's a bit of an overhang. But what a lot of folks tell me is, as long as we are past peak tariff, that could be okay. But this is going to be a roller coaster, because this is how Donald Trump negotiates.
And just quickly, what's long to you? Because last time around it was 18 months. What's long?
I think it's probably going into kind of 2027, 2028. How much of this can truly be wrapped up within the administration? Trump went all the way to March of 2020 before he got one trade deal with China. It took 2 years with the USMCA. Now we're trying to do trade deals with the entire world. I think it would be pretty impressive if you can wrap up a lot of that in a 4-year term.
Ed Mills of Raymond James. Ed, thank you, sir. Appreciate it. I'm not sure how thankful the audience are right now, thinking this could drag on to 2027.
Yeah, and what he was getting there, Ed was talking about how the market seems really hopeful that you can tie this up. The market is only down 3.7% since April 2nd. It has surged 14% since April 9th, and the prolonging of some of these tariffs.
Rallied pretty hard off the lows. Equities this morning near the highs of the session, up by 0.25%. Up next on the program, Tom Fitzgerald of TD Cowen, as the White House looks to overhaul air traffic control.
the President of the United States does say he wants to keep a more mutually beneficial trade balance with these countries. What does a country like Egypt and Kenya and some of these others have to provide that won't completely dent their own GDP?
No, it's tough. I mean, there is the commodity side. There is the. I think it's less about bringing it to the table and more trying to take advantage of the hit elsewhere. So China exports 30% of all the textile exports to America come from China in 2023. It's something like $40 billion. And whatever the tariff rate ends up being on China is going to be a lot higher than it is on Africa. So there might be scope for African countries to say, well, let's move those textile factories.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly.
There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case very quickly becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
It is going to be a long weekend of trade talks between the US and China, and this equity market is moving higher going into it. 2 days of gains and looking to make it day 3. Equity futures on the S&P higher by 0.25%. On the Nasdaq up by 0.4, with 3 hours until the opening bell. With your morning movers this morning is Danny Berger. Hey, Danny.
Hey, John. We're almost through the busiest week for this earnings season this quarter, and we heard from Pinterest yesterday surging. There'd been a real fear going into this quarter that there would be something of a digital ad spending slowdown. That is not what we got. Not only did Pinterest beat in their earnings for the first quarter, but the current quarter, their guide for it was higher than expectations. They touted their AI advancements for why that's the case, but we also heard similar things from Meta, from Amazon, from Reddit, all the digital advertising actually looking healthy. Also healthy were Lyft earnings. And it came just a day after Uber disappointed. Not a disappointment for Lyft. Their gross bookings were higher than expected. They said that they had more active users on their platform. So those shares surging 8%, also getting a boost from an expanded buyback program, something activists at Lyft had been pushing for. To the downside this morning, Expedia after their earnings. The story here is one we've heard from other travel companies, that travel in the U.S. demand has been slowing down, also inbound travel from internationally. They said that for 2025, they now think that the most optimistic scenario is that they'll grow 4%. That was the low end of their estimate prior. Again, we've heard this before, and they said that Canadian visitors coming to the U.S., that has shrunk by 1/3. So those shares down 9.8%, John.
Danny, thank you. I've been using Expedia as travel Google for the last several years and then never booked direct. Doesn't everyone do the same thing?
You're not supposed to say that,
Isn't
but
that
yes.
what everyone does?
It's true. You want to get a gauge of it, and then you figure out what you go to, and then you find out you don't have to get that much higher prices at the actual location, and then you don't have all the strings attached. It is true, but just don't tell anyone.
And then if you want the customer service, it's always beneficial to be
direct.
Direct.
Yes, it's true. Maybe that's why
And you
Canadians
can go
aren't
direct
going
and tell them the price you saw on Expedia.
And then they fix it. Okay, all right. It's not just me. On our radar this morning, the Trump administration considering lowering tariffs significantly during talks with China this weekend. Sources telling us here at Bloomberg, the US is targeting a reduction of the tariff rate to below 60%. The stars are aligning for a move lower in tariffs.
Definitely. And the president said yesterday that you can't go higher. You can't go higher than 145%. If talks go well, then we could see a lower tariff rate. And sources telling Bloomberg that the administration is actually targeting that, maybe 50, 60%. Ed Mills was just talking about maybe it's going to be 50, 60% for national security concerned goods, and maybe even a lower rate for some of the more goods that are textiles. What's also interesting is the U.S. wants magnets. They want the rare earths to make magnets. That's going to be another ask. What does China come to the table with? Do they actually come to some sort of plan to stem the flow of the ingredients to fentanyl? If they do, then I think you can have a deal potentially, or concepts of a deal, by the end of the weekend.
Just to expand on that, what does China want? What do they want out of these deals? We haven't really seen the contours of what the asks are from the Chinese side, or the potential desire to get some sort of deal done, because right now, this is playing very much to the favor of Xi Jinping in domestic media, where he can say all those problems for the past decade in China's economy, that's Donald Trump's fault. So it's unclear what the incentive is right now for China to come to some sort of a quick de-escalation, especially with exports elsewhere around the world surging.
I can pick up on two things that they'd like. One, they'd like the restrictions lifted on US tech. Two, I think they're very concerned about what happens in places like Vietnam at a time when the United States is pushing for Vietnam to become a closer trade partner to the United States. And I think you saw that in the first move from President Xi Jinping to go up around Asia and just make sure those ties were close with the Chinese and make sure the Chinese don't fall into US hands alongside some of their allies.
The problem with both of those asks, those are red lines. And those are essentially the reasons why the U.S. initially had some bipartisan effort to really go up against China. It is the issue of the decoupling of the tech universes between China and the U.S. And it is this question of where exports are coming from and where they are going through in terms of the connector countries.
Yeah, we said that a few times already this week. There's going to be a sticking point for talks between these two nations potentially this weekend. You're seeing it show up in trade volume. China's total exports rising more than expected in April, even as shipments to the U.S. slumped 21%. Exports to India and 10 other Southeast Asian nations soaring by more than 20%, while shipments to the EU were up 8%. This is the change we're expecting and the change ultimately we're already seeing.
Which raises the question how much they are able to offset any decline in exports to the U.S. on an ongoing basis. This also could be a bunch of front loading. And that's why this is difficult to really get a handle on, because a number of companies were saying, look, let's get as much in as we possibly can. Can this continue? And if so, what are the problems for the European Union with this?
That's just trade. So we try to turn to taxes. Let's do that now. The president calling for raising taxes on some of the wealthiest Americans. Sources telling us here at Bloomberg, Trump is proposing a new 39.6% tax bracket for people earning at least $2.5 million or couples making $5.
And Kayleigh asked Secretary Lutnick about this last night, and he called it a, quote, smart move to free up more money to pay for Trump's other proposals like no tax on tips that he talked about on the campaign trail. The issue with this goes against the orthodoxy of the Republican Party. So there is going to be pushback from conservatives in Congress on raising the tax bracket. Even though these are high net worth individuals, this goes against the core beliefs of the Republican Party. And this just shows, like, Trump at his core is a populist. This is going to be very challenging. Punchbowl News puts it this morning. The reconciliation bill is not ready for prime time.
To that point, what is the relevance of the core beliefs of the old school Republican Party now under the President of the United States, Donald Trump, in the White House at the moment? Because this is not the same party anymore. We already know that.
It's a great question, but the majorities are so slim in the Senate and the House that he needs to get everyone on board, and this might just be too high for them to go.
Herding cats down in Washington. Let's talk about something much, much more serious. The U.S. Transportation Secretary Sean Duffy calling for a major overhaul of the air traffic control system. Airline CEOs joining Duffy on stage as he outlined plans to build 6 new centers and replace more than 600 radars. Joining us now is Tom Fitzgerald of TD Cowen. Tom, welcome to the program, sir. I want to start with the airlines. Clearly, we've had a series of aviation safety issues over the last 6 months or so. Tom, are you seeing that start to impact travel volume, start to hurt some of these airlines?
Hi, Jonathan. Thanks very much. It's not impacting travel volumes as much as it's just adding an operational constraint and more bottlenecks, especially for the airlines that have a heavy presence in the Northeast, like United, JetBlue, Delta. We see it in New York. We've seen it in other years in places like the Jacksonville Tower down in Florida. And it's not, there's never a safety issue. But what happens is when you have these outdated technologies, when we have short staffing in ATC, the industry has to just slow how much capacity it can put through the system. And that just, it's bad for the airlines' financials, but it's also tends to be pretty bad for the traveling public and their just experience with their trip overall.
Tom, from an objective standpoint, can you quantify how much less safe the aviation industry is today than, say, 5 years ago? And I ask this at a time where administration officials have come out and said, look, it is incredibly safe to fly. A number of emergency responders say it is, again, safer to fly than to drive a car. Can you quantify the deterioration around the edges?
Yeah, I don't have any numbers on quantifying that, and I think it's a pretty tricky thing to quantify. You might be able to quantify the impact to an airline's hub economics, maybe, if you could just rough out back of the envelope how much capacity they had to pull out, but then a lot of it's assumption based. But again, this isn't a safety issue. I mean, the North Star for everyone in the industry, all the stakeholders, is safety, but it just, the impact is that we just have a much less efficient aviation system as a result.
Going forward, how much is this going to dampen earnings in addition to just a general reluctance right now at a time when Air Canada just came out and said that passenger revenue on U.S. routes fell 4.6% in the first quarter, understanding that Canadians' inbound travel to the U.S. is a bit of an idiosyncratic effort. How much are we seeing that only compounded by some of these safety concerns?
It'll be a challenge. I mean, I think it's a really frustrating time at Newark for United right now. They've had to cancel 35 departures per day. They've had issues in past summers, and we've seen them route more connecting traffic through Dulles over the Atlantic instead of through Newark. But, you know, I mean, I think it's less of a, I mean, it's manageable for them. It's just, you know, they can't fully optimize. They view Newark as their crown jewel for international travel, and they just can't, they're leaving a lot of meat on the bone, I would say, in terms of its full potential. It's a bigger challenge for an airline like JetBlue, where, you know, in their Jet Forward plan, they talk about improving reliability to drive better NPS scores so customers feel more confident booking them. As long as it's a really, you know, as long as the infrastructure and the ATC towers are prone to these bottlenecks and very inefficient and just causing all these like snowballing effects with cancellations and delays, that's going to make it really hard for JetBlue to kind of maintain their reliability. So this is a really welcome development, and I think the problems have been known for a long time. There just hasn't been the political will in the past to get a bill like this done. But I think it, you know, it's going to take a long time, but I think the industry has a lot to be excited about from Secretary Duffy's conference yesterday.
Well, Tom, it needs congressional approval, and also how much is it going to cost? Because right now they've been very scant on details of the price tag.
Yeah, so our checks indicate it's probably going to cost around $30 billion, and then the bulk of that's going to go to telecommunications and technology upgrades, with the rest split between facilities and staffing. But, you know, as they noted yesterday, it's not, there's brick and mortar elements, but this is really a technology and telecommunications initiative.
Is there the impetus on Capitol Hill to sign off on $30 billion?
I think so. I just, you know, based on what we're hearing, it sounds like there is a bipartisan appetite. And I think, you know, the crash at DCA earlier this year, as well as the events at Newark, the events at the Philly Tower over the last couple of weeks, I think that's really spurring a lot of people on the Hill to want to take action.
Tom, can we just finish on what the previous administration did and didn't do? I think perception and reality are important to talk about. The perception was that the former administration focused very much on consumer rights and maybe didn't do enough on transportation safety. Tom, what's your read on that, and would you push back against that?
I think there's some of it's true, some of it's not true. I mean, they for sure pushed on consumer rights, and that was a pain point for the industry. And I think the industry's view is that the Secretary Duffy is going to be less of a micromanager. I don't think it's fair to say that they didn't try to solve the issue. I don't know if they went for as big of a funding bill as this, but they definitely made the attempt. But I think a lot of it got stalled in partisan gridlock. But, you know, but I think the bigger issue is what's coming forward. I mean, this wasn't an issue that started in the last administration. This has been decades in the making, and the can's been kicked down the road several times. But if we finally get the policymakers to take action, and in, you know, 3, 4, or 5 years' time, we have the aviation system that we would like, I think that's a great outcome for everybody, operators, traveling public.
Let's hope we get there and quickly. Tom, appreciate the response. Tom Fitzgerald there of TD Cowen. Years, decades in the making.
It's pretty incredible when you hear someone say that now all of a sudden there's this political will, even though for years people have been talking about this, complaining about it, and there's been anxiety when it comes to air travel in the United States. Some of his notes there were also talking about how this Secretary Duffy, the industry sees him as someone who's throwing himself into the job, getting into the weeds, and wants to really see this get across the finish line.
He's had to hit the ground running. That's for sure. That's for sure. If you're just joining us, welcome to the program. Equities are elevated by 1/3% on the S&P 500. Going into the weekend, key trade talks between the US and China. More on that still to come. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara. Hey, Yahara.
Hi, John. European Commission President Ursula von der Leyen saying that she wants a trade package ready if she visits Washington. This after the EU laid out retaliatory tariff plans against the U.S. President Trump unfazed by the bloc's response, telling reporters, quote, everyone wants to make a deal, and calling von der Leyen fantastic. Meanwhile, India and Pakistan claim to have shot down each other's drones and missiles over densely populated cities, escalating hostilities between the nuclear-armed neighbors. The U.S. and other global powers have called for restraint, with President Trump saying he wants both to work it out and offering to help if needed. And in sports, the Europa League final will be an all-English affair after Manchester United and Tottenham secured spots yesterday. It'll be the third time in the last 50 years the final will be two English teams. The winner will land a spot in next year's Champions League. The match is set for May 21st. That's your Bloomberg Brief. John?
I've got mixed feelings about this. Yahara, thank you. Should we just rename the tournament? Can you call it the Champions League? If you're allowed to secure a place and you finished in the league just above relegation the year before.
Wow,
seriously.
Throwing shade.
What are you going to root for?
Really?
I think even Tottenham and Manchester United fans feel this way. It's kind of ridiculous. Anyway, up next on the programme, pleading for a rate cut.
Even interest rates are down. Now, if the chairman of the Fed, Jerome, if he would lower interest rates like numerous other countries have done, it's like jet fuel. It would be great.
That conversation up next. We'll catch up with Tom Tsouras of Strategas, live from New York City this morning. This is Bloomberg.
Missed it on the China show.
President Trump has called Wednesday Liberation Day, and that seems like liberation from the rules-based order on trade.
We're seeing a lot of orders being canceled, particularly on product being sourced out of China. There's a threat to seeing a shortage of certain products because, look, China's our #1 supplier of footwear. When I got this job 15 years ago, it was 88% of our volume to the U.S. It's now 56% of our volume. But the fact of the matter is, most of that volume is for price-conscious consumers here in the States.
One of the things you see here when you talk to suppliers and buyers is that this essentially gives Asia and Africa to Chinese supply chains an influence, because now as American firms have to focus more on the home market, the companies and organizations with the money to invest in new areas, that will be mostly Chinese money.
Don't miss the China Show live every weekday.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
As of the close, Thursday, heading towards a week of losses, just down by about 0.4% on the S&P, following 2 weeks of gains. We'll see if we snap that winning streak. This morning, we are higher by 1/3% on the S&P 500. On the NASDAQ, up by 0.4. Under surveillance this morning, pleading for a rate cut.
Even interest rates are down. Now, if the chairman of the Fed, Jerome, if he would lower interest rates like numerous other countries have done, it's like jet fuel. It would be great. This country will hit a point that you better go out and buy stock now. Let me tell you, this country will be like a rocket ship that goes straight up.
So here's the latest this morning. The president saying Fed Chair Jay Powell is always too late as the U.S. economy faces rising odds of a recession. Tom Tsouras of Strategas, a Baird company, writing Fed funds futures show 100 basis points of cuts this year. We see 4 more cuts, and we're not going to pound the table on whether they all happen this year. Tom joins us now for more. Tom, good morning. Good to see you.
Yeah, good morning.
Middle of June, I think it's the 17th, 18th, something like that for the Federal Reserve. How different will things be compared to what they looked like the previous Wednesday?
Well, I think marginally different, but I think you're going to see jobless claims continue to trickle a little bit higher, and I do think that the labor market report that's coming out early next month will show the first signs of cracks. But with that said, the data has continued to remain stronger than expected. So the labor market's not showing any sign yet that households are losing jobs, employment's weakening, and you're not seeing a pullback in consumption. You're actually seeing an increase in consumption ahead of the tariffs.
That's one side of the dual mandate, next week's CPI. Is it too early to expect this to show up in the inflation report?
It is, which means if it does show up, that's going to raise some eyebrows, and it's going to be another concern for the bond market. But I think it's going to be too early for that to show up.
Is there a risk of an upside, potentially, to both growth and potentially inflation at a time when a lot of people seem to be talking about the downside? And I say this at a time when President Trump says, go out and buy stocks, tells people he cares about what's going on in markets.
Yep. Well, the risk of an upside meaning the economy continues to remain robust. Yes, absolutely. The consumer could continue to spend. You could see tax cut discussions really gather some steam here, and you could see businesses just decide that we're going to spend, we're going to continue to be business as usual, which would keep us pretty close to full employment, where we still are roughly at full employment. So there is a risk to the upside. Also, the service sector remains very tight. There's not a lot of slack in the service sector labor market. So wages still are not wobbling lower. That can continue to push the consumer forward.
What's the bias right now when it comes to the long end of the yield curve? Whether there's a sort of a soft landing being priced in with continued expansion, or whether people are starting to really look at some sort of deterioration in the macroeconomic backdrop, along with this ongoing lack of desire for U.S. assets?
Yeah, well, let's say 10s at 435 is really not pricing in a soft landing, in my view. Even under the most bearish outlook for bonds in a recession, you should see 10-year yields closer to 3.5%. Even in a shallow recession. Now, keep in mind, typically, from the point at which the economy begins to wobble to the point at which yields trough, 10-year yields might typically drop 200, 250 basis points. If you assume the peak in yields was 5, that tells us 10 should be down more like 3%, even in a typical recession. So if you factor in all the consequences of tariffs, steeper curves, not just in the U.S., but globally, a 350, 360 might be more reasonable. So at 435, we're not pricing in any sort of soft patch at this point.
Do you think there are other bond markets that might better perform in the face of an economic downturn beyond treasuries?
Well, yeah, I think obviously economies where you have a slower growth pace, more of a persistent weakness, stagnation are going to be outperformers in this environment. That might be the UK, that might be core Europe, that might be even parts of Asia Pacific. But in general, I think duration as an asset class in the G10 regimes is going to be an underperformer, all else equal, because this is a phenomenon that's affecting us globally.
Tell us why. Why do you think that's going to be the case?
Well, tariffs in the U.S. are obviously one factor here that leads to a steeper curve globally, because obviously we've got reciprocal tariffs and we have reduced trade, and that does increase inflationary pressures. But also you're looking at another round of sovereign stimulus, which is probably the last thing you need in terms of easing fears of a bond market sell-off. And so you're going to continue to see upward pressure on long duration because of weakening fiscal creditworthiness and inflationary pressures.
Where do you see the tariffs, though, going? Because the president's made it clear they're unsustainable and they're coming down.
Yeah, I think they're coming down. Where they're going to deposit, I have really no clear view. But if I had to guess, that something close to that 10% universal tariff is probably where we're going to end up. But we're probably going to get there very incrementally and slow. It's not going to be a fast process. I know the equity markets wants to think that this is going to be a quick process, and once we get one trade deal, they're all going to fall in line. I don't think that's going to be the case. I think it's going to be very slow over the next, say, 6 to 12 months. If we're lucky, we can complete much of this by the end of the year. And I think somewhere around a 10% universal tariff is where we kind of finally end.
Especially when it comes to China, it could be a long process, maybe even more than 18 months going into 2027, according to Ed Mills. When the president yesterday talked about go out and buy stocks, he was talking about looking at the entire policy perspective of this administration. He was talking about tax cuts. How do you think the Fed views tax cuts? Because we constantly hear them talk about the uncertainty of tariffs, but this administration has a pretty aggressive tax plan.
Yeah, this is from an outsider looking at the Fed. I think the Fed academically views tax cuts as more inflationary than fiscal government spending, which seems counter to what I intuitively think of it as. But I do think the administration is going to look at tax cuts as being another source of inflation that causes them to be slower to ease along the way. And I would disagree with that, but that seems to be how the Fed academically views the topic.
You put this all together. You buying bonds? You're basically saying we're going to see some kind of softer data, or are you saying, you know, this is all really complicated, I'm going to go into the negative yielding bonds in Switzerland?
No, I think we'd be buying bonds here, and we've been telling clients duration is attractive to us, 10s at 435 is attractive to us. It's a lot less attractive than when they were 480, but they're still attractive. The longer term picture here is clearly negative for bonds, but we've got to get through what is going to be a soft patch. There is economic damage that has been done, both from the uncertainty of tariffs as well as the consumer who's also beginning to pull back and is going to feel the pain of higher prices.
So you reject the idea that there's been some sort of structural change internationally where there is a less desirable appetite for treasuries. It sort of goes to John's question earlier when he said, are bonds going to, in the U.S., going to really rally the most in some sort of weak patch at a time when you see massive outperformance in Germany, you see massive outperformance in Japan, and there's this feeling that maybe the certainty of policy there is going to trump, for lack of a better word, that in the United States. You don't buy that, it sounds like.
I don't buy that as a primary driver of yields. I think yes, on the margin, there's less demand for dollar assets. I think Larry Summers had said something to the effect of, if you have a lower trade deficit, you have a lower capital surplus. Absolutely true. So you're going to have less demand for dollar assets, particularly longer duration assets. But I think that is small compared to the realization that there is still no alternative to the U.S. dollar as the global reserve currency. And as long as that's the case, I often say the dollar is the ultimate Irish potato. The weaker it gets, the more you need it.
Tom, appreciate it.
Trying to wrap my head
I
around
think I can make sense of that. Thank you, sir. Tom Tsatsouras there of Strategas, a bad company. On the Fed speak, we're going to hear from the Fed Governor, Adriana Kugler, a little bit later on this morning at 7:45 Eastern Time, so about 50 minutes from now, catching up with Francine Lacqua over in Iceland, of all places. Kugler having this to say this morning in a prepared speech. The labour market is stable. Unemployment has risen only sharply. She's one of the governors on the committee that's very focused on inflation and inflation expectations and getting some comfort maybe from where the labour market still is.
Yeah, this feeling that maybe they're in a good place, as we heard Fed Chair Jay Powell say. I wonder how many times she's going to say wait and see or wait, whether it's also going to be 24 or whether it's going to be more or less, because at a certain point, Fed communication raises a question mark as to its purpose when there is a lack of clarity on all sides.
We can count. Do you want to play a drinking game at home? If it is late into the evening, wherever you are, 7:45 Eastern Time, that interview will be taking place. In the second hour of Bloomberg Surveillance in just a moment, Alex Oldman of Barclays, Sarah Bianchi of Evercore, David Tinsley of the Bank of America Institute, and the Fed Governor, Adriana Kugler from New York City. This is Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
How much does the geopolitical volatility emanating from the United States perhaps undermine the bull case for Mexico? Is that a scenario you've plotted out?
Structurally speaking, we do still have a very positive view in Mexico. On the macro side, it is a very attractive investment geography for the U.S. Mexico is hugely competitive in terms of costs. The wages in Mexico are much more competitive than the wages in China. So why would the U.S. companies not take advantage of that?
And this structural cost advantage is going to lead Mexico to continue to contribute to the growth of U.S. as well. The value chains, the supply chains are so integrated that Mexico has to play a continuing role in the further development of the U.S. And U.S. is growing very healthily, very nicely. It will benefit Mexico. This way or that way, it will benefit Mexico.
Mexico for BBVA is, a source of resiliency of earnings, and it generates and complements the diversification that we have from the footprint. But there's another topic that is very important, which sometimes we don't focus a lot about, and why we're so convinced that Mexico is going to continue to do well, which is the leverage in the country. Because the leverage in the country is only 33%. And when you've seen Mexico grow and BBVA grow in Mexico, structurally speaking, the leverage is so low that just a little bit of growth in the leverage is going to be able to support that bull case in Mexico. So that's why we're structurally positive in Mexico.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Risk-reward is very unattractive to bet on stocks actually moving higher.
At some point down the road, we are going to see new all-time highs.
Definitely stay invested in the markets. Play a little bit more defensive here.
I'm not moving away from kind of the U.S. exceptionalism argument. I don't think it's dead.
We don't know how it's going to play out in any way, shape, or form, and that's the uncertainty premium that's in the market right now.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
2-day winning streak on the S&P 500, looking to make it day 3 going into the weekend. Live from New York City this morning. Good morning. The second hour of Bloomberg Surveillance starts right now. Equity futures near session highs, up 0.25% on the S&P 500. On the NASDAQ at the moment, positive by 0.4. Going into the weekend, this week never ends. We're going to have talks between the U.S. and China this weekend, and on the table, a reduction in tariffs.
A real question here about how high the benchmark is. We were talking earlier with Max Kettner saying it's almost baked in that we're going to get some sort of drop down from 145% rate on tariffs on China to something like 50%. If that doesn't happen over the weekend, as Anne-Marie was talking about, what does that mean for stocks at a time when they are just down 3.7% from where we were right before Liberation Day on April 2nd?
The consensus has been building for a while that we'd ultimately land somewhere around a 10% baseline tariff on the world and maybe 50, 60 on China. We might be there in a few weeks.
Back to square one. This is what Trump talked about on the campaign trail, and after all that up and down roller coaster of the month of April, we might end up ending where we started. When it comes to China, though, and this is really a great point, if the talks are just about talks and setting up another meeting and there's no reduction of a tariff rate, what is that going to signal to this equity market? Because the president said yesterday, the rates, you can't get any higher, and if talks go well, maybe we could see them go down. Well, what if the talks don't go well, or they're not substantive, and they're just an airing of grievances, and they come out and they just say, well, we decided we're going to meet again, but no change of policy.
In the meantime, the planet's still spinning, the economy's still moving, and we've got to focus on the data. You see it in the trade volume coming out of China. Will we see it in CPI next week, or is it still too soon? And are you going to see it in the labor market data in the weeks and months to come?
This is the real question. At what point does the hard data reflect what a lot of people are saying in the University of Michigan Sentiment Survey, or is that going to be always considered the outlier? I was looking at this one report who pointed to the fact that car prices might go up, and we saw that from Carvana. They're taking advantage of this. Even as you see airline fees go down because people from Canada aren't coming to the U.S. and travel domestically has been coming down. You have this push-pull, oil prices down, but on the flip side, you have these supply disruptions that are causing specific prices to go up.
If you're just joining us, welcome to the program. Equities right now just a bit softer. We're down by 0.25%. Coming up over the next 60 minutes, we'll catch up with Alex Altman of Barclays, with markets on hold ahead of China trade talks. Sarah Bianchi of Evercore as more trading partners approach the bargaining table, and the Federal Reserve Governor Adriana Kugler as the Fed snaps into wait-and-see mode. We begin this hour with stocks steady. Investors awaiting weekend news out of US-China trade talks. The president expecting meaningful progress, hinting he could lower levies on Chinese goods. Joining us now, Alex Altman of Barclays. Alex, good morning.
Good morning.
Very tactical stuff that you do alongside your team. So just walk us through the risk-reward profile now, going into the weekend, given where markets are and where they have been.
I think you guys have already covered it pretty well. The risk-reward is that we're not going to get anything substantive over the weekend. And I would dare I say, Treasury Secretary Bessent has already kind of outlined that. And I think people often lose sight of the bigger picture. They're so focused on the minutiae. And actually, if you listen to what has been said by the administration, they said, don't expect necessarily anything dramatic this weekend.
When we spoke to you last, there was a feeling that a lot of people were bearish, but very few were short. What does that sound like now in your conversations?
So I would say that the important thing, and this is a really good phrase, is that price and positioning drive narrative. And so where we're at right now is that obviously we've had a massive resurgence in price, a 13-14% rally in the S&P. Fun fact, April was actually the second best month for the S&P of the year. And it was only down 75 basis points. And consequently, we're now at the point where we have to sort of consider what is the path from here. We're back at the exact same levels that we were. And I personally think that people are still sitting on that slightly long neutral positioning. And in terms of narrative, it has, of course, shifted as a result of price. So people are thinking about the world and saying, oh, actually, we may end up with a better tariff outcome. We may end up with 10% universal and 50% on China. And if you take that as a blended global number, can we live with that? Sure, we could live with that. But my personal view, that's still a worse outcome than pre-Liberation Day. So we shouldn't be trading any higher.
You say the narrative. There are about 15 narratives, and they're all kind of overlapping, right? There's the tariff narrative and what happens on the policy front. But there's also the earnings narrative, and we're wrapping up earnings season with a lot of companies affirming their guidance and actually portraying an ability to be resilient and push through this, and even some seeing benefits as a result of some of the trade tensions. How do you square the idea that companies are managing through this with this overarching kind of macro paralysis that is leading people to be really concerned about the path forward?
It's a great question. So a couple of things. First of all is that the first quarter earnings obviously were not reflective of a new tariff regime, so to speak. And then if we think about the forward guidance, we had a large number of companies that was pulling their forward guidance for whether the Q2 or for the full year, in fact. I mean, think about what the airlines as sort of a case in point. So that, I think, is sort of one reflection of what's going on. The other thing I think we've got to think about is just like from a broader macro environment, like markets operate in very short-term time horizons. We're thinking about things day to day when companies and economies move at sort of monthly and quarterly pace. And the bottom line is that the impact of tariffs is yet to really be felt, and more importantly, yet to really be known. I mean, how can we possibly talk about what the backdrop for these corporates is going to look like on a forward-looking basis when they, nor the Fed, for that matter, know what the economic backdrop looks like?
Which raises the question, if Ed Mills is correct, when he came on earlier and he said that it could potentially be 2027 or 2028 when we start to see the true contours of some of these trade deals, what does that mean in terms of the ongoing uncertainty and lack of modeling ability by these companies?
And this has been, I think it's a great question, because that's really been the theme of what we talked about the past few times sitting right here, is that uncertainty really is the killer of everything. If you're a corporate boardroom and you don't have good certainty on what your forward looks like, then how are you supposed to make investment decisions? And I think that's a really critical thing about tariffs, is that if you're running tariffs on an emergency basis, and bearing in mind we have the CIT ruling on IEEPA coming up on the 13th, the same day as CPI, tariffs creates this logjam because you can kind of switch them on and off very quickly. Whereas if you create congressional frameworks for legislation to invest in your country, it's sticky and it creates a better backdrop for corporates. So the biggest problem I have with tariffs is not just the rate and the impact it can have on prices and price elasticity for consumers, but also it creates a less certain environment for corporates to actually invest in, and that's a consideration people don't really have right now.
But at this moment, the president has come out and did this deal, let's call it framework of a potential deal, trade agreement with the United Kingdom, and he talked about the fact that with China, it's unsustainable and the rate's going to come down. Don't you think we're past peak uncertainty?
I think we're definitely past peak uncertainty, and that was a question we talked about a couple of weeks ago. But it doesn't mean we're past peak negativity. And I think that those two are quite distinct. So I think what the S&P has done, and again, we're down, 4% or so for the year. The S&P is still one of, if not the worst performing developed markets in the world so far for the year. Meanwhile, if you take MSCI EFA, it's making new or close to new all-time highs right now. So that uncertainty, I think, has been factored into that kind of differential now. We've still got to work out what is the real path for the economy, and then we start thinking about what is the earnings trajectory. So if we just sort of take the S&P earnings forecast and we take like a best case example for next year, let's say $290 of earnings next year, which is higher than where basically we were, say, a month or two ago for the 2026, we're still trading at relatively rich multiples with that uncertainty. And so I think the biggest issue I personally have, my team has, is that we're kind of capping out where realistically we can go with the US equity market, with one caveat. If you remember, 2007, GFC, it was pretty much on our doorstep. S&P decided to make new all-time highs or retest the all-time highs in September of that year. So we have to respect the fact that things can get kind of wacky very short term, and at the end of the day, we have to be intellectually flexible.
I'll add to that, intellectually flexible as where else do you go? The German DAX just hit an all-time high. It's now the most expensive relative to its peers in terms of stock indices in Europe, going back to 2009. It's sort of this question, if you think the US is expensive, well, check out what's going on in Europe as everybody flees there with this momentary feeling that maybe this is going to be really positive for their growth.
So I love this question, right? Because what I love the most about it is that we can talk about valuations and globally and all the rest of it, but let's talk about liquidity for a second, right? So, and this is a stat which I think is really important. If you wanted to sell $1 billion of NVIDIA, you can pretty much do it, estimated impact cost, 15 basis points. If you took that $1 billion and you wanted to invest it in, say, ASML or anywhere in Europe, any large single company, ASML as a case in point, it would take you around about 2 weeks running 10% of the volume. So the liquidity differential to try and move money around is also a key factor as to why these indices are moving the way they are. Because sure, I can take my money out of the US quite easily, but to redeploy it elsewhere is very problematic. So I think, again, back to, we've talked about this in the past, like you have to get quite creative. You're gonna have to be quite patient about where you wanna go. And also, if things move that quickly because liquidity is diminished, we have to respect the fact the opportunity set may just be smaller because it closes much quicker. And that's exactly what we saw in Europe in January and February.
Can we finish on multiples? The superior American multiple. Have we seen enough damage, sufficient damage to attitudes to European investors for American equities to really put a lid on the American multiple?
I think that's a great question. At the end of the day, over a longer term, the equity multiple for the US will be dictated by the path of obviously the earnings growth and also the return profile. The US businesses have structurally grown their margins and their profits over time in excess of what, say, European companies have done. And that has reflected in the multiple. Has it been a fair reflection? Actually, if you plot the differential in returns between the two regions and the multiple differentials, we've now closed that gap to what I would consider to be a pretty fair representation of that.
That's enough markets. Can I just ask you a question as a Brit? Did you ever think you'd hear the British Prime Minister call into the Oval Office and celebrate a 10% tariff on the auto sector?
I'm not going to pretend that that was a highlight for the British, but I will say that I think that the deal leaves a lot to be desired. Comparing the two texts didn't line up particularly well. I think they both tried to sort of get their best wins from the situation, but the reality is that if the UK, which had been negotiating a trade deal for 5 years with the US and is considered one of the best trading partners, and bearing in mind, Liberation Day, they were only given a 10% tariff to begin with, right? Yep. If this is the best case outcome that we can hope for, then I'm not exactly sure what the market should be cheering.
What does it mean for everybody else? I think that's the question we're all asking. The president is so good at anchoring expectations to the extreme that you end up in a situation where the British Prime Minister is happy about having his football team game interrupted, one, and two, ending up with a 10% tariff on the whole auto sector.
That's true.
As if that's good news.
There's this 11th hour call, and it was while Keir Starmer was watching his beloved Arsenal. Anyway, they lost, so maybe he was a little bit happy about that, to be drawn away from the game. But then they were able to get this deal over the finish line. But you make a great point. When you read the text back to back, or you speak to an official from the UK or the US, there seems to be this wiggle room of the direction of travel where they actually will end in the end. I think the UK still believes they can get below 10%. where this administration says no one's really getting below 10% right now.
So we've got Peter Navarro coming up on the program in about 45 minutes' time, and I think this is the question for him. You've already got a pretty good relationship with the UK. That's why the UK was first in the line. You've already got a fairly balanced trade balance with the UK as well, which made it easy to come to some kind of agreement. If this is as good as it gets, what does it mean for the talks with the Chinese over the weekend? Not just the duration of the talks, but the content of the talks, and how much harder is it going to be to strike deals with other nations?
Yeah, and what counts as a contour of a deal if the most difficult aspects that are really being negotiated are not clarified, right? I mean, what exactly are you agreeing on that gives you any kind of structure of what the rules of the game are for just even negotiations going forward? And if your mind is spinning, so is everybody else's, because right now it is so hard to understand what was actually agreed upon over in that UK-US agreement. I think that is my takeaway.
I'll return to Marcus just quickly. A question we've asked repeatedly through this weekend is whether the hope of trade deals would continue to sustain this market. You've kind of poured some cold water on that idea. I just wonder how you'd position going into the weekend, what you're telling clients and investors going into this round of talks with the Chinese.
So what we're basically advising is that we're going to either come in Monday with an announcement or we're not of some kind. So my base case is that we're going to listen to Scott Bessent and sort of say we're not going to have much coming out on Monday. And then Tuesday we have CPI. So actually what we're advising to clients is that volatility has come down to allow you to re-protect your portfolio. And more importantly, the vol has come down as well, which basically means that the cost of protecting has actually cheapened quite substantially. So because of that, we actually quite like very, very short-dated tactical downside into next week.
So why are you listening to the Treasury Secretary and not the President when he says to me 145%? It's going down from here, and if the talks are good, he's prepared to drop it.
Because I think it's a bit of tautology, because, of course, if talks are good, talks wouldn't be good if they didn't come down. So there has to be sort of stick and carrot. I just would advise that the day before. So yesterday, the President said that if talks go well, we'll lower tariffs. The day before, he said, I'm not lowering tariffs.
Because it was about preemptively lowering the tariffs before they sat down for the meeting. He said, no, he would not do that.
So I think, again, we're at the whim and mercy of effectively one man's decision,
That's
which
true.
makes it incredibly difficult to navigate this environment.
We're going to be doing that for the next few years, Alex, all right?
Yes, exactly.
You prepared for that? Alex Solman there of Barclays. We've got a few years of this. To Lisa's point, we caught up with Ed Mills earlier on this morning and made the point this could drag on to 2027 and maybe beyond.
Which raises the question of how much of an uncertainty premium needs to be baked in, and how much can people really say, we're almost back to where we were on April 2nd? How much has actually fundamentally and structurally really changed?
Equities on the S&P higher by 1/3% this morning. With an update on stories elsewhere with your Bloomberg brief, here's Yahara Arnott. Hey, Yahara.
Hi, John. NVIDIA plans to release a downgraded version of its H20 chip for China in July. Sources telling Reuters the chip giant notified major Chinese customers of the plans. The H20 had been NVIDIA's most powerful AI chip cleared for Chinese sales, but was essentially blocked from the market after U.S. officials said it would require an export license. Meanwhile, Air Canada saying its passenger revenue on U.S. routes fell close to 5% in the first quarter. Just earlier this month, the airline announced it was cutting routes to San Francisco in addition to Miami and Washington. Air Canada also seeing cargo operating revenues up 16% year over year as a result of shippers front-loading cargo to avoid possible tariffs. And UBS is telling bankers to stop flying business class on short trips to China. Sources telling Bloomberg the move comes as deal-making and capital markets activity in China has slowed amid its trade war with the U.S. That's your Bloomberg brief. John?
Yahara, thank you. Appreciate it. More from Yahara later this hour. Up next, de-escalation with China.
Mr. President, if the talks go well this weekend between Secretary Bessent and Ambassador Greer with their Chinese counterparts, not preemptively, but if the talks go well, would you then consider lowering the tariff rate on China?
Right now, you can't get any higher. It's at 145, so we know it's coming down. But we're going to have I think we're going to have a very good weekend.
It might feel like a long weekend for investors. You are not getting the weekend off. Equity futures are positive, and we're looking ahead to talks between the US and China with Sarah Bianchi of Evercore up next.
is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Two days of gains on the S&P, looking to make it day three. Equity futures at the moment positive by 0.4%. On the Nasdaq 100 up by 0.5. Under surveillance this morning, de-escalation with China.
Mr. President, if the talks go well this weekend between Secretary Besson and Ambassador Greer with their Chinese counterparts, not preemptively, but if the talks go well, would you then consider lowering the tariff rate on China?
Right now, you can't get any higher. It's at 145, so we know it's coming down. It's going to be very good for both countries. I would like to see China open. I do think they have far more to gain than we do in a sense, but I think we're going to have a very good weekend.
Will you speak to Xi after the weekend talks?
I might, yeah, sure.
Here's the latest this morning. Officials from the US and China set for their first trade negotiations tomorrow in Switzerland. Sources telling us here at Bloomberg the US is aiming to cut tariffs below 60% as a first step, which China may be prepared to match. Joining us now from the nation's capital, Bloomberg's Tyler Kendall. Tyler, we've been talking about talks for a long time now. Walk us through how things are set up going into Switzerland.
Yeah, hey, John. Well, as you mentioned, if talks do go well, Bloomberg News is reporting that the U.S. feels that China may match a tariff rate below 60%. And in fact, it could go into effect as soon as next week. Now, people familiar caution that at this point, everything is so uncertain. But it does appear that the administration may be trying to bring those tariff rates back to where they were on so-called Liberation Day. Of course, that was the 34% so-called reciprocal tariff stacked on top of that 20% tariff that went into effect earlier in the year over fentanyl concerns. Now, to be sure, we do not know the exact rate, and this White House has said that any talk about a target tariff rate is really just speculation at this point, but still, it is giving us some sort of sense of perhaps where this administration is headed. Now, President Trump has said, of course, that he does think that tariff rates need to come down, saying that the current situation does amount to a trade embargo. But we know this White House is looking for concessions out of Beijing during these talks, and that could be a range of things, including having China tighten its controls when it comes to fentanyl flows or even loosening curbs on critical and rare earth minerals. Our reporting indicates that that is a high priority here going into the weekend. Now, what actually happens does remain to be seen. Bloomberg Economics cautions that they do not expect an immediate agreement or a permanent de-escalation to result from these talks. But of course, officials, including President Trump there, have been expressing pretty high optimism going into the weekend.
Tyler, thank you. Heading into the weekend, we can extend the conversation with Sarah Bianchi of Evercore ISI. Sarah, we've had positioning now for weeks ahead of these talks. Here they are. Who's got the leverage?
Well, look, at this point, I think China has a bit more leverage, but the reality is both sides would like these tariffs to come down from these levels that, as they all say, are basically an embargo. So I think both sides will be delighted to, just use even good mood music out of these talks to take things down, to de-escalate. So I do expect at some point next week we'll see these tariffs come down to the 60% range on the U.S. side, and I do think China will match in some way.
Sarah, how are you thinking about this weekend? Is it talks about talks, or do you really think that they are going to hash out some trade issues?
I think they're going to hash out minimal trade issues. As you know, the one thing we've been saying in all these countries is actual trade talks is hard and long. But this is not hard. This is trying to get down to something just manageable while they begin talks. So I think they will talk about rare earths. They will talk about some of these other issues, perhaps a few purchase agreements. But in general, everybody wants this to come down from these unsustainable levels, and then, which, by the way, 60, 50%
still really, really high, then that can at least do put us on a path for an actual discussion, an actual outline of what they're trying to achieve.
To drop that rate, does the U.S. need to see a concession from Beijing?
I don't think so. I think, look, they have to make sure it doesn't appear that it's just a purely unilateral a walk away, but I think they can use the cover of a good conversation, a commitment on, a small commitment on fentanyl. I think it can be largely symbolic or, policies that perhaps are already in place pretty much. I don't think there's a lot here because, again, I think Beijing has a lot more patience and pain tolerance in the United States, but nobody's really happy with where we're at right now.
Sarah, we're hearing from the president right now saying China should open up its market to the USA. It would be good for them. Closed markets don't work anymore. Sarah, you lived some of these negotiations with the Chinese before as the deputy US trade representative in the previous administration. How difficult is it to get China to move to where the US would like it to be? What is it that they're refusing to open up that we'd like to see them open up?
Well, I'm not sure that opening up is really kind of what, honestly, where the tensions really are, to be honest. Last time the president got China to agree to a bunch of purchase agreements, particularly around ag, I had the honor of trying to see if those were enforceable. There was not a lot. There was pretty clear that China wasn't going to do that. And so one of the challenges is not just what the agreement is, but does anybody actually ever listen to it? The truth is what China really wants from the U.S. is more access to some of our technology and chips. And that's why we always think this, quote, grand bargain is very, very difficult. We think the best you can do is sort of a package of trades and exchanges and maybe a little bit more market opening, but that's really not the core of the issue.
Sarah, appreciate your time as always. Sarah Bianchi there at the core on the latest going into these talks this weekend. If we revisit these purchase agreements, is that sufficient, Lisa? And if we do, how difficult is it going to be this time around to enforce them?
This is ultimately the question. What is the meat of this negotiation? Is it going to be some of the actual trade deficit? Is it going to be the tech aspects? Is it going to be where the exports are coming from, if they're coming from Vietnam, but from China? It is so difficult to know the contours of this, so it sounds good, but what does that even mean in the context of the current rules?
When the president tweets or truths China should open up their markets, all I can think about is a $300 billion trade deficit. That is a number he is squarely focused on and cares about. And if China can get that lower with a purchasing agreement, I think that would help this relationship move along.
Big weekend coming up. The talks about talks set to take place in Switzerland between the United States and China. Equities at the moment firmer by 1/3% on the S&P. Up next, David Tinsley of the Bank of America Institute with consumers buying ahead of incoming tariff costs. Live from New York, you're watching Bloomberg TV. this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly. There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
This just in from the President of the United States. Check this out. We're going into talks with the US and China this weekend in Switzerland. Tariffs are around 150%. The President says this, 80% tariff on China seems right. It's up to Scott B. Scott B being the Treasury Secretary, Scott Besson. Here's the reaction to it in the markets. Equity futures just coming off session highs. Rolling over, still positive by 0.1%. Think about the context for this. The reporting going into the weekend suggesting that maybe tariffs would drop below 60%. The president suggesting going into talks, it could be around 80.
So higher than what the market was expecting. The market expecting 60%, maybe even lower, and even lower potentially on knickknacks and textiles, a little bit higher with national security goods. Now the president is putting basically the weekend talks around 80%. And really, I guess, depends on how the Treasury Secretary deals with the Chinese, because it's, quote, up to Scott B.
What is the difference between 60 and 80 for Chinese negotiators this weekend?
I mean, hard to say at this point, hard to say what this does for Scott B and his potential negotiations. It is notable to me, given the fact that the baseline was 50%, that you're not seeing a sell-off, because it seems like this is a comfortably numb market to headline risk right now.
Equity futures rolling over just a touch on the S&P 500. Still positive. The up and about 2 hours away. With your morning movers, here's Danny Berger. Hey, Danny.
Hey, John. Well, we're not numb on some of these individual names, especially when it comes to earnings. Expedia, by far the worst performer in the S&P 500 pre-market. They cut their outlook. They now see the high end of growth in 2025 at 4%. Previously, that was their low end of estimate range. It's something we've heard from airlines, from other travel companies, that there's just less demand in the U.S., both domestically and from inbound travel. They said Canada in specific, they'd seen travel there be cut by a third for demand to travel. So those shares down again, nearly 10% this morning. We also, after the bell yesterday, got results from Monster Beverage. They, of course, make those Monster energy drinks. A weak outlook for them. They, in fact, missed on their earnings. Shares are down 4.5%. They said that the reason for the sales miss was the fact that alcohol sales were down. Again, I didn't realize that they made alcohol, which is a scary idea for this energy company, but even so, alcohol sales were down. They gave a bunch of reasons. One of them was economic uncertainty. They also said costs are going to be moving higher because of tariffs on aluminum, to be specific, so margins will look worse. Finally, rounding things out with Coinbase, which also reported their earnings. Again, a miss when it comes to their revenue. In fact, revenue shrank in the first quarter, but they said it's because the comparables were really tough versus the fourth quarter. Donald Trump had just been elected. Crypto trading was off the rails, but they said in the first quarter, trading fell by about 17% for most consumers. Even though Bitcoin was hitting new highs, they said that the volatility was keeping folks on the sidelines. So those shares down more than 1.5%, John.
You don't fancy a vodka and Monster beverage?
I feel like that should be illegal if it's not already.
I don't want to bump into anyone that's had vodka and Monster beverage. Danny, thank you. Thanks very much. On a radar this morning, President Donald Trump saying 80% tariffs on China are about right. Now it's up to the Treasury Secretary, Scott Besson, setting up talks going into the weekend.
So this is how the White House at this moment is looking at the talks in Geneva. Potentially, it's going to drop the rate to 80%. It's at 145%. Yesterday, I was in the Oval Office with the president. He said that right now you can't get any higher, and we know that it's coming down. Two things. Most analysts will tell you at 80%, that is still a trade embargo between these two economies. Also, you have to remember, second point, strategic uncertainty. We know this administration likes to use this idea and lean into game theory. Potentially, before, quote, Scotty B goes over to Geneva, the Treasury Secretary, alongside Ambassador Greer, the president is trying to cajole the Chinese to maybe give more concessions, and maybe he'll be a little bit more warm or helpful on the 80%.
We've not got much to work with here. We're working off a social media post. But I do wonder what about right means. About right for what? About right for the talks, to set up the talks between the two leaders, or about right going forward for the foreseeable future?
Scotty B, what's your take? I mean, at this point, we're having to wonder and parse through some of these truths to understand the mood music heading into this. But what does it mean that 5 minutes apart, we get one that says China should open up its market to the U.S., all caps, and then 80% tariff on China, low caps? Seems about right, up to Scotty B. There is this drumbeat, this mood music to try to get leverage, but also conciliatory tone heading into these talks, which is really highlighting how high the stakes are right now for a market that is on pins and needles trying to understand the path ahead.
It's framing for negotiations going into Switzerland. We had a deal with the UK yesterday. We caught up with the Commerce Secretary, Howard Lutnick, who signalled that other key trade partners might have to wait for tariff relief.
But obviously, when you talk about Japan, I mean, come on, you've got to spend an enormous amount of time with Japan, Korea. These are not going to be fast deals. Now, India's been leaning in really hard, right? You know, I love doing a deal with India. That's certainly a possibility, but this is a lot of work. These are a lot of lines.
The Commerce Secretary is right to point this out and set expectations. This is going to take a lot of time, and I just wonder if we've got enough time left. Remember that 90-day tariff pause? The clock is still ticking. If you listen to the Commerce Secretary there, you have to understand that it could go well beyond that time period.
Right, because trade deals take years. What's so interesting about this, he seemed to throw cold water on the tone the president was setting in the Oval Office, which is that trade deals are going to be coming fast and furious. What's so interesting about Japan, they were the first in. Remember, the president sat in on the negotiations when the Japanese team came to Washington, D.C., and everyone thought this close ally, very close, very strategically, in certain geographic terms, close to China, that they would be the first out with a deal. No, it wasn't. It was the United Kingdom. And I think what he's doing is just saying this is going to take a lot more time. Not everyone is going to get the Keir Starmer treatment.
All I can say, my takeaway, Boeing. They seem to be the big winner from all of this stuff because every single deal seems to involve some sort of buying of a Boeing plane. So I'm curious, for Boeing's standpoint, how the CEO is really understanding how they're going to juice production to meet all of this buying that's going to come in from all of the contours of deals and talks and deals.
I'm not a fan of central planning. So there's parts of these conversations that I'm a little uncomfortable with.
You're uncomfortable with Boeing?
Not Boeing per se, just uncomfortable with purchase agreements. I don't want to see private companies come together and strike deals because government officials have pointed them in one direction and the other.
Boeing and Rolls-Royce engines, it's sort of this sort of outlier.
I want to see tariffs down and free markets, that we want to see that happen, and hopefully we end up with that, but yeah.
From specific places.
That's the struggle. Let's get to this. Much lighter news. The Catholic Church has a new leader, Cardinal Robert Prevost, becoming the first ever American Pope. Born in Chicago, but spent 20 years in Peru, he chose the name Leo the 14th.
He is from the south side of Chicago.
How cool is that?
It is very cool. What's interesting is that President Trump has been welcoming him as the American Pope, and at the same time, and he put out something that was really nice, at the same time, in the past, he's had some interesting and sort of controversial statements about immigration and kind of butting up against President Trump. So it's going to be a very interesting American representation in the papal office.
Beautiful scenes coming out of Rome. More on that story, of course, throughout the day on Bloomberg TV and on Bloomberg Radio. Let's turn back to trade. Companies from Apple, Nvidia, GM and Procter & Gamble warning of a tariff hit. David Tinsley and the team at the Bank of America Institute writing the following. The gradual easing in consumer spending is not just due to lower inflation. The growth in the number of transactions has also cooled. David joins us now for more. David, welcome to the program, sir. Just walk us through what you're seeing in your data, what you're seeing in spending over the past month or so.
Yeah, thanks for having me on, John. I mean, all the stuff you were discussing before this interview was about the uncertainty facing economies in the US economy. And when I was listening to that, I was thinking, it wouldn't be unreasonable to expect the consumer to be taking some of that in and slowing. And we have seen some moderation in spending growth in our data. But in a way, I think the major takeaway is that consumers do continue to have forward momentum. And actually, when we look at our data and look at the financial health of consumers, sound. It's pretty good. There are a few, margins where there are more concern, but the body of consumer health is solid, and consumers are continuing to spend.
David, one big feature of this cycle coming out of the pandemic is to consistently underestimate the resilience of the US consumer. When you look at checking balances and the data that you have and compare them to pre-pandemic, just how healthy are things?
Yeah, that's a great question. So basically, right now they're being swollen a little bit by tax refunds. And so when you look at the data right now, even the worst case scenario for you, the lowest increase relative to 2019, cash terms, is up around 70%, I think, off the top of my head. And obviously that's, in inflation-adjusted terms, still a big increase. I think the other thing on financial health that we take some comfort from is when you look at people who pay off their credit cards every month, or when you look at people that don't pay off their credit cards every month, that percentage is actually down about 7% on 2019. So most people are paying off their cards and they have cash in the bank relative to where they were pre-pandemic.
Averages have kind of broken down a little bit, given the huge gap that we've seen in spending and resilience among the upper income echelons versus the lower tier of earners. I'm just wondering how you see that difference developing. Are you seeing ongoing resilience to a really strong degree in the top earners, or is this resilience really across the board?
So it's certainly the case that the lower income households in our data are showing the slowest growth. It is still positive, but it is the weakest. And so we are at the top end, and I think the middle, we're still seeing some sort of steady resilience. I think when you look across to the labour market, what we also see is that the lower income households have shown the largest deceleration in their wage growth. In our data, the year-on-year growth in April was around 1.5% for lower-income households, quite a bit weaker than the higher-income households, which I think was about 2.3%. So it's all, to a large extent, a labour market story, but there is more resilience, I think, at the middle and higher end of households.
David, this is one of my favourite reports, so thanks for sharing it with us this morning. We appreciate it, sir.
Thank you very much.
Thank you, sir. David Tinsley there of the Bank of America Institute on the state of the consumer right now, and the read is pretty resilient compared to and relative to some of the fears out there at the moment. Let's talk about some of the fears going into the weekend. Just where will tariffs land once we have these talks between the US and China? Let's get you an update on stories. Elsewhere this morning with your Bloomberg Brief, here's Yahira.
Hi, John. President Trump floating an 80% tariff on China ahead of this weekend's negotiations between the two countries and saying China should open up its market to the U.S. Trade talks, as you said, are set to begin tomorrow between the two nations. Meanwhile, TSMC's revenue jumped 48% in April, underscoring how electronics firms scrambled to acquire essential components before global tariffs took effect. The main chip maker for Apple and NVIDIA reported monthly sales of $11.6 billion. The company has stressed that demand remains resilient despite tariffs. And New York City slashed its forecast for international tourists in 2025 by 17%, blaming Trump's tariffs and hardline policies on immigration. The decline in foreign visitors is expected to hurt the city's economy, as international visitors typically stay longer and spend more money than domestic tourists. That's your Bloomberg Brief. John?
Yahira, thank you. More from Yahira in the next hour. Up next on the programme, to Lake Powell.
The Bank of England cut, China cut, everybody's cutting but him. It's a shame. I call him Too Late, Too Late Powell, that's his nickname, and it's a shame, it's ridiculous.
Up next, the Federal Reserve Governor, Adriana Kugler, sitting down with Francine Lacqua in Iceland. From New York, this is Bloomberg.
What makes it India's time?
It's us women who are going to transform India. I truly feel that the time for Indian women has come. They're not only breaking glass ceilings, but they are redefining, you know, whether it is in sport, whether it's in medicine, whether it's in creative arts. They are everywhere, and I have so much positive energy that comes back to me when I'm talking to Indian women. And I just think at all these little girls and boys, I don't want to discriminate, who are now in school-going age, imagine once education, sports, we empower them. What a difference they would make not only to India, but to the planet and the world. And the world needs it now than ever before.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute geopolitical news wherever and whenever it happens. I'm Anne-Marie Hordern in Buenos Aires, Argentina, and this is Bloomberg.
Just in, moments ago, heading into the weekend for talks between the US and China, the president writing this on social media. 80% tariff on China seems right. It's up to Scott B. It's up to the Treasury Secretary, Scott Besson. Equities responding, just rolling over a touch. Not a big drama. We're still positive by 0.25% on the S&P 500. On the NASDAQ, we're up by 0.3. Out of surveillance this morning, too late, Powell.
The Bank of England cut, China cut, everybody's cutting but him. It's a shame. I call him Too Late, you know, Too Late Powell, that's his nickname, and it's a shame, it's ridiculous. He's always too late. But in this case, it's not going to matter that much because our country is so strong, we're so powerful in terms of economic strength.
Here's the latest this morning. President Trump criticizing Fed Chair Jay Powell for staying in wait-and-see mode while central banks across Europe and China cut interest rates. Joining us now with a special guest, Bloomberg's Francine Lacqua. Morning, Francine.
Good morning. Thank you so much, of course, for coming here to Iceland, Reykjavik, where we're delighted to be joined by Governor Adriana Kugler. Governor Kugler, thank you for joining us. Look, there's been a lot of talk about central bank independence. Jay Powell under attack many times by Donald Trump saying, look, that actually the Fed did not cut. How do you think and how would you explain to the markets and maybe the president of why we're currently in a wait-and-see mode for the Fed?
Thank you, Francine, for having me here. And so let me tell you a little bit. Obviously, we held steady at 4.3%, and I supported that because the way I think about it is that our policy rate is currently moderately restrictive. And I think it makes sense to keep it that way. And it makes sense to keep it that way for a number of reasons. First of all, we have been seeing the progress on disinflation slow down a little bit. We have also seen an increase in inflation expectations, and we want to keep long-run inflation expectations very well anchored. So that's the second reason. Third, we see some risks, upside risks to inflation from the tariffs that are currently in place, and given that, it makes sense to make sure we keep, again, the federal funds rate moderately restricted. On the real side of the economy, on the other hand, things have remained resilient. The employment rate is still high, and the unemployment rate is still currently at historically low rates. And by the same token, private activity is judged by PDFP, the private domestic final purchases number shows us that private activity grew at 3%. We saw some conflicting evidence between imports and inventories, but But overall, we see health still in the real economy. So that gives us time to make sure that we continue to make progress on inflation, and we keep our inflation expectations very well anchored.
Governor, how problematic are the uncertainty, actually, of the tariffs to look at scenarios for GDP, inflation, and rates? So do you look at scenarios, or do you look at baseline projections?
Yeah, thank you for asking that. We look at a broad range of scenarios, in fact, because it is particularly important during this time period of a lot of uncertainty. Uncertainty is the word of the day, as you know. And so the way we see it is that we don't know which way this is going to go. We started at 2.6% effective tariff rate at the beginning of the year. It depends who you ask, but it's somewhere between 20 and 27%, according to many analyses. And we do our own analysis, but also look at private sector analysis on this issue. So it's still very high. It may still change. It could come down because there could be negotiations or exemptions. It could go up some if additional tariffs get put into place. So we're not sure even about the magnitude of the tariffs. We don't know which products are going to be affected by the tariffs at this point. We have a baseline case, as you said, as to the ones that already have been implemented, but we don't know if that's going to change in the next week, in the next months, in the next year. So we're keeping close attention to many different scenarios and paying attention as to how that may affect the economy. So obviously, that is the question of the day. How will it affect the economy, right?
So Governor, first of all, what's your main takeaway from first quarter GDP, and how are you see U.S. consumers behaving right now?
Yeah, as I said, on the real side of the economy, what we got is GDP for the first quarter, so it's backward looking. Yeah. And that backward-looking number is showing us exactly what one would have expected, which is a lot of front-loading. So front-loading of imports ahead of the tariffs, people trying to buy, both producers and consumers trying to get those products before the tariffs get put into place. That showed up in a huge increase in imports and some increase in inventories, but not as much. So overall, the GDP number showed some weakness of 0.3%, minus 0.3%. But if you look at the private side, on the other hand, you see a very resilient economy with 3% growth in PDFP, the private domestic final purchases part of the economy, which shows a resilient consumer and a resilient investor as well. Now, if you look at some of the more real-time data, the picture could look a little different. We did see high retail sales, but if you ask the consumer what they think they're going to do ahead, there's a fall in consumer confidence. And people are thinking, well, maybe we'll hold back. Investors are thinking, well, investment may come down because we don't know what is coming ahead, and they're concerned about tariffs.
And Governor, I mean, there's a lot of talk, of course, that employment will rise. You could also see tariffs actually putting inflation up. So at some point, if it happens in the third quarter or the fourth quarter, if you have this employment going up, but also inflation being pushed by tariffs, does the higher unemployment bring disinflation? Does it somehow make the job a little bit easier for the Fed?
So there are two effects, right? One, upside risk to inflation, and upside risk to unemployment or slowdown in economic activity. You're right. I think the way I think about it is we're already seeing, especially from surveys of manufacturers, some indications about tariffs putting upward pressure on prices, in particular on the cost of materials. Those costs already being passed on to the consumer. That's already showing up in those surveys, whether it's the ISM surveys, the surveys that are done by the regional feds. So that's definitely showing up in the data, and it's showing up in goods prices and goods inflation going up as well. That's happening. Now, down the road, you're right, there could be a slowdown. And that slowdown partly because of uncertainty, but also because real disposable income is going to fall. Also, because the real value of financial assets may fall, and that will decrease wealth. And so those two effects are going to push down aggregate demand. In addition to that, I would point out that there could be reallocation of economic activity and a reduction in productivity. And that could come up if, for example, new businesses or existing businesses start producing things that used to be produced by those abroad, and then you're having lower productivity. That could put potentially some downward pressure on prices coming up from the other side. But it's not clear whether they'll exactly counteract each other. I would say one has to be cautious to think that that in itself is going to do the trick of getting prices back down.
Governor Adriana Kugler, thank you so much for joining us today. With that, I'm going to send it back to you, and we'll have plenty more from Reykjavik here in Iceland.
Looking forward to it. Francine, thank you. Francine Lacqua, alongside the Fed governor, reinforcing the balance of risks articulated by the Fed chair in the news conference on Wednesday. Upside risk to inflation, downside risk to growth, but I think emphasis always matters. And once again, a Federal Reserve official choosing to emphasize anchoring inflation expectations.
At a time when they haven't gotten inflation down to that 2% target for a couple of years, and they seem pretty close to that place. Key question, how does that emphasis change when we actually start to see some of the weakness in the hard data? It's very easy to put the emphasis on the strength when you hear things like credit card receivables are going strong. There are plenty of companies that are reaffirming their guidance. It's much harder when all of a sudden people are losing their jobs and you see the unemployment rate ticking up.
The policy can change quickly as well. The President of the United States this hour saying an 80% tariff on China seems about right, and it's up to the Treasury Secretary, Scott Bessent, going into these talks this weekend.
Well, we certainly know it's going down. He said that yesterday, and he's reiterating that today. Now he's putting a figure on it, so 145% potentially dropping to 80. The question, of course, is this: is Trump just trying to rattle the Chinese delegation before they sit down with the Treasury Secretary and Ambassador Greer? Because our reporting was that actually they're looking to something closer to 50 or 60%. All we know is it's going to be a working weekend, and by Monday morning, there might be a lower rate when it comes to China than there currently is now.
He likes to anchor negotiations, and he's anchoring negotiations around 80% going into the weekend now, and we'll see what we get. Equities are just about holding on. The S&P 500 positive by 0.2%, and looking for a third day of gains. Up next, a must-watch. The senior Trump trade advisor, Peter Navarro, Alicia Levine of BNY Wealth, Dan Ives of Wedbush, and Tiffany Wilding of PIMCO. Live from New York City, the third hour of Bloomberg Surveillance. Up next.
We're building another art museum called the Guggenheim. Now, Louvre's big enough. Why do you need a Guggenheim as well, right next door?
I think it's a great question. I think the beautiful thing about the UAE and Abu Dhabi is we live with over 200 nationalities. And in doing so, they have become a part of the country's and the city's fabric. And we need to celebrate that. So we need to celebrate everybody's identity, everybody's background, everybody's heritage, everybody's history. And what a beautiful way in doing so in these beautiful institutions. These museums are educational institutions and they're community institutions. So we wanted to curate really a story where you come to Saadiyat Cultural District and you, if you allow me to curate the story, you start off at the Natural History Museum. And at the Natural History Museum, you get a glimpse and you get an understanding of how we came to be, how our Earth came to be, how our universe came to be, from a scientific perspective. Once you leave the Natural History Museum, you go to our National Museum, the Sheikh Zayed National Museum. There, you understand the history of this great land. Not just the history of the country, but the people of this land that have been a part of this land for over 300,000 years. You get a glimpse of what the past and the present and the future looks like here in the UAE. From there, you maneuver yourself to the Louvre Abu Dhabi, which is a beautiful universal museum. It is universal in its thematic approach. So there, you basically see a part of you on an equal pedestal with the entire world.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
But what about the diagnosis? If the diagnosis at the end is worries about growth rates,
How do you get from point A to point B? Why do you worry so much about that end goal of better growth?
Because if we can't grow, you're going to have a much more inflated debt to GDP and federal deficit, and that's not good for the economy. Growth is really critical, and I think what's underappreciated is what the inputs are to get to the growth number. And so we talked a little bit about productivity. I hope that we can continue to produce at 2% indefinitely on productivity. I think that would be great. But you got to make sure you have the other levers in place, I think, to buoy that. So if you look back over the last several years, we've had 8 million immigrants come into this country in the last 4 years. And that's helped growth. And by the way, that's deflationary.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
The new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
It's going to be a real bumpy road on this whole tariff process.
At this point, rubber needs to meet the road. We need to actually see some numbers here.
This is a process. It's going to take time.
This is a really big shock that's coming at the economy.
The damage is already being done. The rest of the world now sees the U.S. not necessarily as a very credible trading partner.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
The third hour of Bloomberg Surveillance starts right now, and your scores look like this. The S&P 500 on a two-day winning streak, looking to make it day 3. On the S&P, we're positive by 0.2%. On the Nasdaq 100, higher by 0.3. Going into the weekend, important trade talks between the United States and China taking place in Switzerland, and a flavor of things to come maybe from the President of the United States. President Trump, just moments ago on social media, saying an 80% tariff on China seems about right. It's up to the Treasury Secretary.
Two ways to read this. On one hand, you could say 80%, as Anne-Marie said the last hour, is basically a trade embargo. It's still substantially higher than what people were expecting, with a 50% potential rate after the talks. On the other hand, you could say the openness to even lower the rate is a positive step toward really ratcheting down some of the pressure, which is the ultimate goal of talks about talks.
Well, the president yesterday said it's at 145% and can't go higher. It's got to come down. If talks go well, then potentially could come down this weekend. The issue is a lot of reporting and smoke signals from the White House has been 50, 60%. Now the president is saying actually maybe around 80%, but let's see how the Treasury Secretary does. It's up to him.
Let's see how it goes. Right now, equity is just about positive going to all of that. We begin this hour with markets looking ahead to high-stakes trade talks between the US and China in Switzerland this weekend. Joining us now, I'm very pleased to say, Peter Navarro, the Director of the Office of Trade and Manufacturing Policy at the White House. Dr. Navarro, it's been too long, sir. It's good to see you. Thanks for being here.
Been a long time, Jonathan, and it is good to see you too, sir.
Thank you, sir.
First-class digs here, my friend.
Well, I'm pleased we're looking after you. Let's kick it off with these talks this weekend. We just heard from the president just moments ago, and he mentioned an 80% tariff might be about right. It's up to the Treasury Secretary. We understand you won't want to get ahead of those negotiations, but I just wonder, could you offer some clarity on what about right means? When the president says 80% tariff on China seems right for the talks this weekend, or seems right for the foreseeable future?
Yeah, I was one of 3 people that was with the White House the first term for all 4 years. One of the big reasons is I never got ahead of the president. But let me tell you about Geneva, which is kind of, so I've got a very warm memories. It was my finest hour as a negotiator. I went there to lead the negotiations for the United Postal Union reforms that essentially got China rates fair to, we save billions on that. But I mention this because Geneva has symbolic value in this negotiation. It is the headquarters of the World Trade Organization. And the scariest thing I ever saw in Geneva was the size of the China delegation at the World Trade Organization. And they've played the WTO like a fiddle. So let's see what happens tomorrow. I'd be happy to come back on Monday and do the debrief, but I don't want to get ahead of the boss or Scott Besson. And don't forget, Scott's going with Jamison Greer, the United States Trade Representative. He's the guy who learned at the knee of Bob Lighthizer the first time around, was there for all the China stuff, and he's the guy who was the architect, along with Howard Lutnick, of the UK deal. So let's see what happens. It's
two of the very best, sir. We'll certainly pencil in.
Weekend for the markets.
We'll pencil in an appearance with you for Monday. No worries about that. I'm looking forward to that conversation. Just going into the weekend and reflecting on your experience dealing with the Chinese. They're not the UK. This is not the same relationship. The trade relationship is tremendously unbalanced and has been for a long, long time. Can you frame for us how difficult it has been previously for you to negotiate with the Chinese and how much longer it could take with the Chinese relative to, say, the UK and other trade partners?
Well, I can tell you, I think I sat face-to-face with the China team maybe 7 times during the first term, and twice Xi Jinping was there. It was G7, excuse me, the G20. Both, I think it was Tokyo and Buenos Aires. What's interesting, what's so interesting to me, Jonathan, about China is that they have continuity. The same people are going to be in Geneva were the same people back then. And you know, our regimes change. We have different governments and things like that. But they have the advantage of that kind of continuity. But look, it'll be interesting. Again, I don't want to get ahead of Scott and Jamison or the president. I think let's see what happens. My role, and we've got 15 countries we run enormous trade deficits with that we've got to renegotiate the whole structure of those deals. And there's another 100 countries that cheat us in some ways, but smaller ways. My role in the administration on all of this is to do the background analytics to see how each country is cheating us, which basically sets up the terms of the negotiation. And every country is like fingerprints. Like India is the Maharaja tariffs. They have the highest tariffs of any of our major trading partners. Japan is the most clever at protecting its own markets with a combination of domestic protectionism, non-tariff barriers. You know, Germany, they have auto tariffs at 10%. We have them at 2.5%, but they also have the VAT tax, which acts as another 19% tariff, and an export subsidy. So what I do is do the background and look at kind of how these countries are doing what to us. And we get great deals for the American people. I think the UK deal is very interesting. I think the significance is not just that it's a deal, but that it's a template for the future deals. What we do, Jonathan, is there's like 4 or 5 verticals we look at. It's the tariffs, the non-tariff barriers, the digital taxes, and then the various kinds of cheating, the dumping, the currency manipulation, things like that. And then from there, we assess what the asks are and what we need, and go forward from there. You're going to see a steady wave of deals. The USTR building is right across the street from the White House. It's got the most staff negotiating these deals. And it's like you go to the deli and you have to take a number and get in line. Every day there's delegations from around the world lining up to meet with Jamison Greer and Howard Lutnick. And I've seen, I looked yesterday at the schedule. It was kind of fun out to July, and it's just, one after the other.
Well, Peter, looking at the countries lining up, one key aspect of the UK deal was, of course, bringing down the auto tariff to 10%. So right now you have a tariff rate that's lower for Bentleys, which is a car that most American families can't afford, made in the UK, where Chevys have a higher rate if they're made in Canada or Mexico. Is there an expectation that the next trade deals, auto tariffs, will be coming down, those rates?
It's going to be country by country. I mean, the beauty about the UK is that it's a very small amount of exports they send us, and we have a hard cap at I think it's 100,000 units, where it goes right back up to 25%. And again, we're trying to do something that's mutually beneficial to both countries to get to a better place. while at the same time changing the level of the playing field so that it is more level. I think for me, the beauty of the UK deal, besides that, was all of the good stuff we had for ag. I mean, one of the problems we have is this non-tariff barriers like phytosanitary standards. What's that? That's like these things they do to keep our pork out, our chicken out, or our beef. Right now, we're going to be able to sell a lot more beef, poultry, dairy, and ethanol. I mean, they had a really high tariff, like almost a lockout tariff on ethanol, and that's made from corn. So the folks in Iowa are very happy about that. So this is the way we're going to go forward. On net, the United States is going to be far better off. And all we're doing is trying to level the playing field. You know, I saw the EU kind of rattling sabers, I think it was yesterday, about some kind of retaliation. And I would just say to anybody who's in the European Union, I mean, how can you look us in the face and threaten us when your tariffs are higher? You have lost cases repeatedly at the WTO on us selling you things like beef and poultry, and you won't even honor that. So,
Peter, yesterday the president called Ursula von der Leyen fantastic, and he said he hopes to meet her. But are you saying that the European Union is not as high on the priority list than, say, other trading partners like South Korea and Japan?
Not at all. I mean, the EU, to be clear here, we have the second highest trade deficit with the EU behind China. So they're very high on the list. All I'm saying here is that I found it unfortunate that the EU kind of fired, I think some term was fired, shots across our bow. It's like retaliation will not work against the United States. We shouldn't have that. Let's talk. Let's figure this out. And it would be nice. Here, let's give peace a chance here. All we're asking for here in the United States of America is fairness. I mean, would you agree? Is there any disagreement on this set and on your set that the tariffs of the EU are higher and that the non-tariff barriers are higher and that the WTO in Geneva is basically sanctioning that through two things?
Okay, but
one
Peter,
is the... but would you agree with that? I mean,
I think
have I said anything
there's
that
a
you
bigger
would like
question.
to fact check there?
There's a bigger question here. There's a bigger question here, and this is something that the German finance minister has come out and talked about, which is they'd be willing to drop all tariffs to zero if the U.S. were willing to drop all tariffs to zero. There is a willingness to negotiate around the board to a lower tariff regime. Would that be acceptable to you, or is 10% the new floor?
So let's stay with that. See, that's such a misdirection, okay? It's the non-tariff barrier, stupid, to kind of paraphrase Bill Clinton. It's like it's the non-tariff barriers. So when countries like Vietnam or entities like the EU say to us, oh, let's all go to zero tariffs and everything will be okay. That's not the problem. It's part of the problem, but the bigger problem is the non-tariff barriers. In Europe, it's the VAT tax. I mean, I don't know if you know this, but the United States has tried going back to the 1970s to get equity treatment for the VAT tax, which most countries of the world use, versus the income tax, which we use. We haven't been able to get it because the WTO has a majority of people who benefit from sticking it to the United States. So they do. So the zero tariff thing, that's misdirection, and on your set, you should call it on that. When they say, let's lower the non-tariff barriers and let's give you relief on the VAT tax, now we're talking.
The VAT tax is a slightly different mechanism. This is all going to take a long time, and there are a lot of competing factors here in terms of who can possibly pull these levers. And I'm just wondering, we've got 2 months left in this 90-day negotiating period that is paused for the retaliatory tariffs. Does that just get extended out another 90 days as you have to deal with different legislative bodies to possibly remedy what you see?
Well, we don't have to deal with legislative bodies. Well, okay, in the EU perhaps, but I coined a term in Trump time, which is to say do it as fast as possible without screwing it up. And that's all we're trying to do. I go back to the observation that the United States Trade Representative in that building, which is a historic building, by the way, beautiful to see if you ever get there, the lines, they're coming in and out, and we're talking, And, you know, as the boss says, let's see what happens. I mean, it's in everybody's interest around the world to level the playing field with the United States in a way which allows us to restructure this international trade environment, which is fundamentally skewed against the United States. I mean, we're losing, because of this system, the United States is losing our manufacturing base, we're losing our defense industrial base, and when push comes to shove and folks around the world are looking for the United States to help defend them, I mean, if we get to a point where we can't do that, what good is that? So economic security is national security is one of the guiding principles of President Trump and this administration. So we're just trying to get fairness here. You know, give fairness a chance here and work with us.
Looking forward to an update on Monday, sir. It's good to see you once again.
Yes, sir.
Thank you.
Right,
Dr. Navarro, Director of the Office of Trade and Manufacturing Policy at the White House. A couple of things to point out there. How much harder it will be to deal with the Europeans, because it goes beyond just tariffs. And I think you heard it there articulated very well from Dr. Navarro.
He's talking about the VAT tax, which has to do with exempting certain goods or getting a rebate if you're a European company. This is a complicated measure to try to undo in the same mechanism as any type of tariff talk, which raises a question: what happens in 2 months' time when the 90-day pause in retaliatory tariffs comes up?
When he talks about Europe, we didn't even ask the question. He just went there on his own about the retaliation he's seeing out of Europe. There's $100 billion worth of U.S. goods that they might target if talks fail. Even though yesterday in the Oval Office, the president said he thinks Ursula von der Leyen is fantastic and wants to meet with her. The VAT tax is the problem the U.S. has with Europe, not the tariff rate.
With us around the table, Alicia Levine of BNY Wealth. Alicia, good morning.
Good morning.
You were following that conversation. He certainly didn't want to get ahead of negotiations this weekend. What's the best case? Monday morning, what are we waking up to?
So, you know, at 6 a.m., the best case was a 50 or 60% tariff rate and 10% universal. And then an hour later, it was 80% tariffs on China. The news changes quickly. Interestingly, the markets have been hanging in there. I mean, the futures actually have not reacted to that. And I think the message that the markets have learned is that this is one grand negotiating strategy, and there's good cop, bad cop in the administration, and it's very clear what the direction of travel is, and the direction of travel is lowering of the tariffs and getting to deals. I think it's also no accident that Dr. Navarro was on today before the negotiations in Switzerland this weekend, since he is seen to be the most hawkish when it comes to tariffs, and particularly on China. So if this is part of a negotiating strategy, I think the markets have learned it's a negotiating strategy.
So what do you make of that? The idea that there's been sort of, I don't want to say benumbing of markets, but the response to headlines has been coming in again and again. Does that give you actually a sense of comfort?
Oh, yes. I mean, look, what really happened, you know, so now April 9th was the 90-day pause, was the message to markets that we're moving the whole probability curve over to the right, and the worst-tailed scenario, that highest risk tail scenario, is actually off the table. That's why the markets were able to rally and bounced off the lows. That continues to be the case. And if you think about it just in terms of numbers, because this business is all about numbers, the original tariffs of April 2nd were about $600 billion worth of tariffs, $600 billion, which was basically a tax of 2% on the U.S. economy. U.S. economy is about $30 trillion of GDP. So $600 billion in tariffs was about 2% hit, which is why you had the odds of recession go straight up. Because if you think growth rates are about 2%, you put a 2% tax on it, you get to zero. Now, with all the walkbacks, we're at about $400 billion in tariffs. Okay, so we've walked back about 1/3 of that, and I think ultimately we get to somewhere of about $200 billion in tariffs. Still very high, but it's not a 2% hit to the economy, and that's what the market's been pricing in the whole time. Earnings are probably higher for next year than that immediate base case in April 2nd, and at some point the markets are going to look to 2026, and by the summer we're looking at 26 and not 25 anymore, and I think that's what's happening in the markets.
Are we getting a weekend this weekend? Doesn't feel like it, does it?
Not in this business. I mean, look, we've all glued to our screens for a long time. So there's no weekend. There's the Sunday nights checking the futures. Yeah. We're going to do that again. But I think the intensity of it, as I said, the markets have learned this is a negotiation with Dr. Navarro on to set the stake in the ground to commit the U.S. on negotiating strategy.
That negotiating is going to be going on for quite a while. Alicia's going to be sticking with us, not through all the negotiations, just for the next 5 minutes or so. Equity futures right now in the S&P positive by 0.2%, with an update on stories elsewhere with your Bloomberg brief. Here's Yahara. Hey, Yahara.
Hi, John. President Trump saying on Truth Social Republicans should probably not raise taxes on the rich, but adding that he's okay if they do. His comments coming after sources tell Bloomberg that Trump wants a new 39.6% tax bracket for people making at least $2.5 million or couples making $5 million. Meanwhile, NVIDIA plans to release a downgraded version of its H20 chip for China in July, sources telling Reuters. The chip giant notified major Chinese customers of the plan. The H20 had been NVIDIA's most powerful AI chip cleared for Chinese sales, but was essentially blocked from the market after U.S. officials said it would require an export license. And in sports, the Indiana Pacers look to extend their 2-0 lead in their series against top seed Cleveland. Elsewhere, the Timberwolves evened their series against Golden State after Steph Curry strained his hamstring. And in New York, fans are in a frenzy with the Knicks up 2-0 against the Boston Celtics ahead of Game 3 tomorrow. The cheapest seats in the Garden start at over $600. That's your Bloomberg Brief. John?
I've looked at the prices. Yahara, thank you. It's absolutely ridiculous.
$600 for the cheapest tickets. The most expensive are tens of thousands of dollars.
Count me out.
Think of the people. What about the people?
Count me out.
Yeah.
Ridiculous. Okay, let's get you some morning calls. First up, JP Morgan cutting its price target on Target to 105, citing sales softness and promotional risk. That stock is up by 0.6%. Your second call from UBS, raising its price target on Boeing to 226, saying it's able to navigate the changing tariff environment. And finally, Goldman upgrading Lyft to a buy, seeing strong execution and a stable industry backdrop. Let's turn to tech. The AI race between the US and China in focus as the Trump administration plans to repeal Biden-era chip export rules. Dan Ives of Wedbush writing, we're seeing China tech waking up to the AI revolution with the US. China trade tensions abound. Dan joins us now for more alongside Alicia Levine of BNY. Dan, it's good to see you, sir.
Great to be here.
Big weekend of trade talks. Where does tech fit in to all of this?
Look, I think tech knows that they're walking back from the cliff in terms of what they're going to need to do, right? Because the reality is that that's the hearts and lungs of the supply chain. And I think what you've seen, the NVIDIA moment really essentially giving Huawei the China market, I think that was really, that was the start of this. I think it was the start of the administration recognizing they're going to have to pull back. And look, you can't argue with the data.
How self-sufficient is Chinese tech without U.S. tech?
Look, they need U.S. tech, but let's just be, as someone that spends so much time in China, I mean, if you put them in a room with a seltzer bottle, toothpick, and, and a straw, they come out with an AI chip. So the problem is that you don't want to put China in the situation that they're going to have to ultimately innovate, because it's my view, for the first time in 30 years, the U.S. has been ahead of China when it comes to tech. So the last thing you want to do is cut U.S. tech off at the knees. And I think now the administration is part of why we're seeing in the market. They've taken steps back, and I think now we're at least getting to some sort of balance. But still, look, definitely a lot more wood to chop ahead.
They're rescinding the diffusion rule under the Biden administration. So some of these geopolitical swing states are going to get more access to U.S. chips. How does China take advantage of that?
I mean, look, China definitely is going to, from a market share perspective, go after. I think we've already seen in terms of Huawei and others what they're going after. But the reality is it's really the H20, right? Like once you restrict the H20 in terms of NVIDIA, that sort of started this sort of Game of Thrones battle that we're seeing. And China definitely edging in terms of what I view as the AI revolution. Baba, I think front and center. But U.S. continues to own the AI revolution. And I think the one thing as we go into Switzerland, you go into talks, the last thing you want to see here is administration just double down, because if you do that and you don't lower the tension, you don't de-escalate, it's U.S. tech that gets hurt. And right now, I think that's sort of the more positive. than call it 3-4 weeks ago.
And Alicia, it really points to what we've seen in the markets recently, which is as the tone has softened, we have seen a huge rip-roaring rally in tech, and everyone's been piling in. It's the AI stories back on. Let's go. Is that going to be the leadership again, or is this a tenuous rally in face of some of the uncertainties of how far some of these negotiating tactics can work?
So the one good thing about uncertainty is that it creates a two-way market. And I think many investors see this as a great entry point. The multiples are much lower. The stocks have been crushed. And, ultimately, I think the narrative that U.S. exceptionalism is over has been very strong. And we saw this rush into global markets. And the question is today, I'm just going to point out that the S&P has outperformed developed international month to date. And there's a reason for that. And that's partly because the tech earnings with the multiples and the cash flow, you can't get around it. And ultimately, as an investor, you're investing in future cash flows. And what we saw from these companies is that there's nobody else that can touch these companies.
Yeah, and to your point, it was a Jalen Brunson moment for the tech space.
Let's get the Knicks in.
And it was a Jalen Brunson moment. And you've seen what happened here in terms of the AI. The AI revolution.
2 flashpoints. Allow me to sort of detail a couple. DeepSeek's one. Okay, big upset. Beyond trade. Let's forget trade. DeepSeek's one. The second one, I think, this week, Apple coming out and saying search has peaked on Google. What was your reaction to that headline?
That was a shot across the bow, right? I mean, just given what we're seeing even on the regulatory front, it's the last thing Alphabet needed to see. Look, I think Bark's worse than the bite there, and it's our view, like search queries, like where AI is not ending Alphabet's hearts and lungs in terms of, their core money train. But it shows Apple, when it comes to AI and building it out, they're going to have to do their own path, and they're going to have to build some of that out. And you talk about DeepSeek to almost kind of put it in a bow. Look, every big tech firm wants to be at the seat at the table. No one's going to say, okay, hey, Apple, Google, you could be our AI or open AI. And I think that's the reality that we're seeing here.
Alicia, just quickly, has the tech trade changed? Is it different now? Do you have to play it differently?
I think you do have to play it differently. I mean, it's no longer close your eyes and just throw the dart at the Magnificent Seven. I mean, there's clearly different growth rates here, but the power of the size of the companies, we think, is still going to actually drive the S&P here. So we think the American exceptionalism trade lives on, and maybe in different ways. But look at industrials have been rallying, aerospace defense has been rallying, tech has been rallying. I mean, this is the base of the U.S. economy and the S&P. It does suggest also, I'll just say, that some of the conversation coming from the White House is finding its way back into the market in a positive way and not just putting a lid on things. Like we said weeks ago, the 4,800 low is in,
it's
regardless
a
of
major change.
recession.
Alicia Levine, Dan Ives from New York. This is Bloomberg. Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly. There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
Asia is at the forefront of some of the world's biggest stories. And we're here, where the action starts in Sydney. And in Tokyo, get ahead as the global trading day begins. The Asia Trade, weekdays, only on Bloomberg.
Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
Setting the stage for talks this weekend between the US and China in Switzerland. The President of the United States with this post earlier this morning. If you're just tuning in, welcome. If you've been with us for the last couple of hours, forgive me to keep repeating this, but this is how things are going to follow into the weekend. The President saying an 80% tariff on China seems right. It's up to the Treasury Secretary, Scott Bessent. We just spoke to Peter Navarro, the trade advisor to the President. Didn't really want to get ahead of negotiations going into the weekend. So this is how we're framing things going into negotiations.
He doesn't want to get ahead of the president, doesn't want to get ahead of Scott Bessent, who's leading the delegation when they sit across from the Chinese over the weekend. We know the rate is coming down. The president made that clear over the weekend, of course, unless the talks go really sour. But if the talks are okay and warm, the rate's coming down. Everyone thought this morning, 6 a.m., the rate was going to be 50, 60%. Trump is recalibrating everyone's thinking going into the weekend, and he's saying he thinks 80% is about right.
We always say you can learn something from the headline and how the market responds to the headline. Didn't really budge in the face of that headline. We're still just about positive on the S&P 500, up 0.2%. On the Nasdaq, up by 0.3. With 60 minutes until the cash open, let's get you some morning movers. Here's Danny Berger. Hey, Danny.
Hey, John. Pinterest, one of the big movers to the upside in the pre-market trade, up 13%. It had earnings after the close yesterday. For all these fears that there'd be something of a digital ad slowdown, it didn't happen. A surprise the upside on the quarter they reported and their forecast for the current quarter. All of that also reflected in what we saw in Alphabet, Meta, Reddit. All of those digital advertising giants also doing well. We also had a headline crossing the terminal just moments ago about CrowdStrike. Shares are moving lower on that headline. This is a Bloomberg scoop. There had already been an ongoing probe into CrowdStrike in a $32 million deal it did with a government reseller to provide tools to the IRS. The IRS said, one, it never got those tools, and two, it didn't even buy them. The latest turn in the saga, according to Bloomberg sources, is that regulators are now asking questions and probing executives at CrowdStrike itself, and now going back and looking at their other deals of CrowdStrike. Spokesperson saying that they stand by their accounting of that deal. Finally, rounding things up with Affirm, the buy now, pay later app. It also reported earnings. I gotta say the results were pretty solid. It said we can withstand any economic downturn we might get. Analysts were skeptical. JP Morgan cut its price target. They did run a scenario where you had a 50% increase in stress in the credit environment if there is a downturn. It just said it would take on less credit approvals and it would only hurt them by about 10 percentage points. But those shares down more than 6%, John.
Danny, thank you. Thanks for this morning. Have a good weekend. Danny Berger there with three of the movers going into the opening bell. The news flow has been absolutely tremendous. Here's another headline right here. The United States to seek preferential treatment for the United Kingdom on any pharma tariffs. We've still got to deal with the sectoral tariffs with the United States, and the US to seek preferential treatment for the UK.
And the comment period is over, so any day those sectoral tariffs could be dropping. It looks like if you're a very close ally and have a special relationship with the United States, you are going to get a better deal, especially when things are of critical national importance. So maybe a sectoral tariff on pharma is going to be more preferential, a better treatment with the United Kingdom than, say, someplace like China.
This is the gold standard for deals at the moment. Whatever you think about the deal, this might be as good as it gets, the relationship between the US and the United Kingdom. Kingdom.
And what did we learn? That 10% baseline stays. What doesn't stay necessarily are the sectoral tariffs. The steel and aluminum can come down in return for some number of different concessions. So does this give us any sense of where the negotiations could go, or is this basically, as you say, as good as it gets?
It's finger up in the air type stuff going into the weekend, right? 80, 60, yeah. We'll see what happens. Imagine being a Fed official. How much sympathy can we have for them? Mike McKee has tons. He joins us now. Mike McKee, lots of Fed speak still to come today and into the weekend.
Lots of Fed speak, but I don't know that we're going to get a whole lot out of it. You've already heard from Adriana Kugler, John Williams, people who are basically telling us they don't have any idea what's going on with the Trump administration, and so there's nothing they can do. It's a repeat of what Jay Powell has been saying. So we hear from a lot of people today, but can they add anything to the discussion? When you talk to people out here at the Hoover Monetary Policy Conference, there's a lot of frustration. They have to make policy, but they don't know what the policy is going to be from the administration, so they don't know what the effect is going to be on the economy. And I can tell you, Lisa just mentioned the 10% baseline tariffs. There was some talk at dinner last night of, remember back a couple of months ago when we thought 10% baseline tariffs and 50% on China would be a crisis for the world. So the president moving things around doesn't make anything easier for them.
Mike McKee from the most depressing looking hotel room I've ever seen. Mike, they need to do some paint work there. I'm not sure if there's a tariff on paint at the moment, but let's figure this out. Mike McKee, thank you. That's all I could think about.
It's what everyone was thinking.
Who chose the colour of those
you
walls?
actually said,
I mean,
you
of
actually
course.
said what everyone was thinking out loud.
Didn't think the same thing?
John, the sartorial
like
commentator.
That off yellow?
Yes, it's sort of
I pulled up
no windows.
10% tariffs, or yellow walls.
I pulled up our internal booking system, and I was like, I got to find him a better hotel.
It looked like a suite. I'll give him that. All right, let's stick with the Federal Reserve. Tiffany Warnig of PIMCO writing, our baseline view is the Fed is likely will begin cutting rates in September and continue into the next year as we expect the unemployment rate to rise and longer-term inflation expectations to remain relatively well anchored. Tiffany joins us now for more. Tiffany, welcome to the program. Let's talk about the outlook for the labour market. So claims have held up, they've come back down. The payrolls report on Friday was pretty resilient. When are you and the team expecting to see some weakness emerge in this labour market?
Yeah, I mean, so we think the risk here is that it's more delayed than what the markets are pricing. I think there's the same uncertainty that Powell and the Federal Reserve are dealing with. Companies are dealing with that same uncertainty, and they don't want to make labor decisions when they don't have the facts. We just think about the calendar for when we could learn more. Obviously we've had some news around maybe some incremental deals and some positive things out of China. But if you look at just when this 90-day window is over for the reciprocal tariffs, that's like beginning of July. There's not an expectation for anything to come out on the tax and spending bill until around that time as well, July 4th. We think the reality of that is that it'll take Congress longer, maybe closer to the summer recess before that happens. So companies are not going to want to move, to the extent that they can. They're not going to want to move until later this year. So you think about the Fed with release lags, they might not have data in hand that suggests the labor market is weakening until the fall. So I think that's what's driving our baseline expectation. I think the other thing that we're keeping an eye on is the federal government worker layoffs. That has not hit the payroll report yet. There are estimates of 150 to 200,000 jobs there. We think many of those people are still on administrative leave, and they might not actually get separated from their job until the midsummer as well. And all of the economic effects of that are still to come. So those are the reasons why we're looking for more of a lag here in the labor market impact.
The labor market is expected to lag behind some of the more quickly moving sentiment. Maybe CPI is a little bit different. Next week, we do get a host of inflation reads, CPI and PPI among them, at a time when you have kind of dueling effects here. On one hand, oil prices have gone down pretty significantly. Airline prices for tickets have also been discounted, but car dealerships are seeing car prices go up. So does it evenly balance itself, or could we see the inflationary effects as soon as next week?
Yeah, I mean, I think that is the key issue here is how quickly do those inflationary effects show up? And as you suggested, we do have, we do sort of have varying evidence of that. I think one of the big things that we'll be watching within the CPI is specifically the retail goods categories. Yes, we've heard some anecdotal reports about the auto industry. We can see some more acceleration in the wholesale auto market, but there's really a question around the brunt of retail goods that have a major portion of their supply chains in China, how those prices will start to adjust. And, I think it's possible, I've heard some retailers suggest that because they have inventory on hand, that they will wait until they're actually using inventory that's tariffed to start to raise prices. So that suggests we could see a little bit more of a lag with that as well. But we'll just have to see. I think it'll be really important to focus in on those retail prices.
How long can the U.S. continue to have an inflationary backdrop while the rest of the world sees a disinflationary backdrop, or the appearance of it? And I'm struck by the gap in interest rate expectations around the world that seems to be widening as the ECB is set to lower rates again. We had the Bank of England, we have the Bank of Canada, but the U.S. very much on hold.
Yeah, I think the important point on the tariffs is, although it acts like a supply shock for the United States, we're basically inducing the relative price of imports higher. It is very much a demand shock on everywhere else in the world, especially those countries that export to the United States. I think there's a real question around if demand for if U.S. demand for those goods is lower because the government is inducing higher prices on them, then where do those goods go around the rest of the world? And we think China, for example, will try to sell elsewhere, and they'll probably try to sell elsewhere, at lower costs. So although this is a near-term potential inflationary price level adjustment for the U.S., effectively it's the opposite. We have a relative price adjustment that's happening here as well. And that just means that central banks around the world can focus more on the growth hit that will likely come from this, and the disinflationary effects as well.
Tiffany, as we go into these talks over the weekend between the U.S. and China, is there a tariff rate that would not act as an embargo between trade in these two economies, but would still be a rate on goods coming from China into the United States?
Yeah, so I think, it looks like if you just take the administration, if you just look at what they've done and you take that for what it's worth, it suggests very clearly that this administration, wants to engineer a decoupling from the Chinese economy, and they want to do it rather quickly. Now whether that's 145% tariff on Chinese goods or down to 80, that is a significant increase in the average effective tariff rate, and it will provide an incentive for supply chains to move out of China, potentially into other Southeast Asian economies, maybe Mexico. Certainly we could get some of the production back to the United States. But again, this will happen at higher costs. We estimate based on census data, that on average, Chinese prices of goods are about 20 to 30% below the global average. So you have moving your supply chain out of China could give you 20 to 30% more in terms of costs, and then you still have this 10% average effective tariff rate as well. So all of that is going to induce more costs on the U.S. economy, but we think it will ultimately engineer, an accelerated move in that direction out of China.
Tiffany, appreciate your take as always. Tiffany Wilding there of PIMCO, going into the weekend and looking ahead to some CPI data as well. The president is annoyed with the Fed chair, Jay Powell. He's going to continue to be annoyed because these central banks abroad will keep cutting rates. One, because of the nature of the shock, disinflationary. Two, the move in the FX market. The dollar has been a whole lot weaker, which gives them the space to reduce interest rates. And then three, this is the issue they've got now. The way the Federal Reserve has set the reaction function up now, they're just going to wait. They're going to wait, and they're going to wait.
They need to see the hard data, in particular with respect to jobs, reflect the weakness that a lot of people expect, and that it will not come until much later in the year. So now the question is, how much of an inflationary shock is there in the very near term that sets them even on a longer course before they make that first cut?
Matt Dezok's with us around the table of Maryland Bank of America Private Bank. Matt, good morning to you, sir.
Morning, Jonathan.
Let's talk markets. Will treasuries provide that diversifier for people with a portfolio this morning?
We do believe they will. No, not over a short time. You're not going to see, bonds move intraday in the way you're going to want them to move. But end of the day, you can get 5% yields on the ag right now. More importantly, what's the limiter? 2 to 2.5% real yields from 10 to 30 years. We've been saying that for 18, 24 months now. That's still there. So it's very difficult, we believe, for that not to provide good diversification over a longer period of time. Where else are you going to go? You're going to go to Europe? What kind of real yields are you getting there? Less than 1% on average. Keep going around the world. Japan, negative real yields.
So you've mentioned the income you can get. Talk to me about the correlation with risk assets.
Correlation with risk assets, again, it's breaking down a little bit here, but we do not think it's fundamentally broken. Even over short periods of time, a week, a month, it's not going to move in lockstep. Over a multi-year period, it's going to diversify. It will come down. Real yields will come down, in our opinion, strongly, if we do get economic weakness, because the trade, tariffs, anything, over a longer period of time, 2 to 2.5% real yields on government-guaranteed securities are quite attractive as a hedge to macro and risk assets.
Why wasn't that happening in April? What went wrong?
April was a lot of technical selling. We talked about this last time. The S&P dropped 10% in about 16 days. Long bond said, hold my beer. I'm going to drop 10 points in 60 hours. Went from 4:30 on Monday morning to over 5%. A lot of technical selling. Should we worry about that? No, we don't worry about that. My clients, a lot of my clients are investing clients. They're capital and liquidity providers. Higher recession risk and higher real yields, that's good for my clients. Let's break it down. If we're worried about foreign selling of treasuries, we're not saying it was foreign selling, but if that's the concern, who's the largest holder of U.S. treasuries abroad? Japan. Over $1 trillion, not going to use them. Next largest holder officially is China, about $750 billion. Guys, the treasury market is 29 trillion outstanding. 750 billion is a lot, but not enough to move the needle.
Maybe so. There is this feeling, though, that there was a natural bid into treasuries because it was a dollar-denominated asset at a time when there was a huge trade deficit and people were getting dollars from overseas and needed to park them in something that was perceived as safe. You don't think that anything has shaken that thesis?
I do not believe that thesis is fundamentally broken. At the end of the day, we do not believe fundamentally that the U.S. dollar is a reserve currency by choice. We are, again, fantastically lucky, grateful, wealthy country. People want our wealth. Our wealth is denominated in U.S. dollars. If they want access to our wealth, they're going to need to accept dollars. You can denominate assets anything you want. We're going to pay dollars, so we believe it's a reserve asset by necessity.
There used to be a phrase, don't fight the Fed. Increasingly, as central banks around the world are cutting rates at a time when the Fed is not, as we were just talking about, do you chase that? A lot of people have come on and said that's the reason why foreign bonds seem so much better than U.S. government bonds, because in the U.S., not only is the Fed not cutting, but potentially we will expand the deficit. Why does that not concern you?
So I'm not saying it's not concerning, but let's break it down. At the end of the day, what is the real driver of long-term rates? Our belief is that it is inflation. It's not technical selling. It's not anything else. It is inflation. We learned the lesson in COVID that we should have known by World War II. If you decide to put $4 trillion extra into the economy and you decide your central bank to basically finance that, guess what? You're going to get massive money supply growth. If you get that money directly to consumers, you're going to get inflation pretty quickly. If we continue to get higher deficits, as long as the Fed doesn't abrogate its 2% inflation target or purchase those treasuries, deficits on their own are not necessarily inflationary. Look at Europe, Japan, even China. The 10-year in China right now is 1.6%. The Chinese 10-year is lower on a nominal basis than the U.S. real yield. They've had a massive increase in debt there, and yet you don't have higher rates. So as long as the Fed sticks to its 2% target, doesn't finance the deficits, we're not overly concerned about inflation or rates moving significantly higher from that 2 to 2.5% real.
Just want to jump in with some commentary from the President of the United States and save everyone a trip to Google. A container for a bulk material such as grain, rock, or trash. Hopper, okay? Many trade deals in the hopper, all good, great ones, from the President of the United States on social media just moments ago.
There should be some fine print attached to this. These aren't trade deals. They are general terms, the memorandum of understanding, they're letters of intent. You can see that this morning when the White House put out the general terms for the United States of America and the United Kingdom's negotiation, what they call a prosperity deal. So what you can get from this administration, they want to move ahead in terms of all of these talks, getting stuff on paper, coming to an agreement, but the actual trade deals will take years.
Can I just gauge expectations with you just quickly? What's your baseline for this weekend? What do you expect to hear when you return to work Monday morning?
The talks were constructive. That's what I'm expecting here.
Can you put some numbers on that?
I'm not expecting, we don't have a forecast on numbers. What I will say is 145, 80, 60, that's still pretty much a decoupling. And so the bid ask on those numbers to me is not the most relevant thing. I think starting the dialogue is the most important thing. I totally agree with what Anne-Marie said before, hit the nail on the head. We're gonna get better trade deals with folks that we wanna get better trade deals with. Just having the talks, constructive talks, that's what we're gonna get out of this. I'm not expecting a lot of big news personally.
Matt, appreciate your time, as always. Have a good weekend. Thank you, sir. Matt Diesock there of Maryland Bank of America Private Bank with an update on stories elsewhere with your Bloomberg brief. Here's Yahira. Hey, Yahira.
Hi, John. Details are emerging about the trade deal made between the U.S. and U.K. According to a joint statement, the two countries, quote, intend to promptly negotiate significantly preferential treatment outcomes on pharmaceuticals and pharmaceutical ingredients. Meanwhile, Bloomberg reporting U.S. regulators are investigating what CrowdStrike senior leadership knew about a $32 million deal between the company and vendor Carasoft to supply cybersecurity software to the IRS. Investigators are examining internal CrowdStrike records and questioning former employees and are looking into other transactions made by the company. Shares are down nearly 2%. And Cardinal Robert Francis Provost has been elected the new leader of the Roman Catholic Church. The 69-year-old is the first pope born in the United States. He is also a citizen of Peru, where he spent much of his life as a missionary and archbishop. He chose the papal name Leo XIV. That's your Bloomberg brief. John?
Wonderful scenes going into the weekend. Yahira, thank you. And you have a wonderful weekend too. Up next on the program, we'll set you up for the week and the weekend ahead. In just a moment, we'll catch up with Tyler Kendall. She joins us, head of trade talks between the US and China.
The President of the United States does say he wants to keep a more mutually beneficial trade balance with these countries. What does a country like Egypt and Kenya and some of these others have to provide that won't completely dent their own GDP?
No, it's tough. I mean, there is the commodity side. There is the. I think it's less about bringing it to the table and more trying to take advantage of the hit elsewhere. So China exports 30% of all the textile exports to America come from China in 2023. It's something like $40 billion. And whatever the tariff rate ends up being on China, it's going to be a lot higher than it is on Africa. So there might be scope for African countries to say, well, let's move those textile factories.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, And if you want to learn to listen for it, we'll show you how.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Down on the week so far by 0.4% on the S&P 500. Looking to see if we can erase that at the opening bell. Looking for a third consecutive day of gains on the S&P higher by a third of 1%. On the Nasdaq 100 up by 0.4. As we count you down to that opening bell, your calendar, your week ahead looks like this. At 9:15, the New York Fed President John Williams speaks on Bloomberg TV. Later on at 4 p.m., President Trump signing another batch of executive orders. Tomorrow, it begins the big one. U.S. and China trade talks kicking off in Switzerland. Then looking ahead to next week, CPI data on Tuesday, plus President Trump heading to Riyadh for the first stop of his Middle East trip. On Thursday, PPI retail sales and another round of jobless claims, plus standout earnings report of the week, Walmart. Joining us now from the nation's capital, Bloomberg's Tyler Kendall. Tyler, just a day away from negotiations and the president signaling maybe we could drop tariffs to 80 and not below 60.
Yeah, hey, John. Well, it appears that it's going to be all up to Treasury Secretary Scott B., as President Trump calls him, as he and the USTR Jamieson Greer land in Geneva ahead of these talks. And Peter Navarro told you earlier this hour that whatever happens will be interesting for the markets. Investment really has been at the forefront of this administration's efforts when it comes to trying to calm investors and consumer concerns alike around their trade policies, and that they will come to the table in a meaningful way to de-escalate. But while President Trump has said that he will lower tariffs at some point because it amounts to a trade embargo, that 80% levy that he floated, it probably goes without saying that's a pretty prohibitive number. We're just going to have to wait and see how it all shakes out.
Looking forward to it. Tyler, get some rest. Tyler Kendall of Bloomberg down in Washington, D.C. will be up all weekend following these talks.
Well, exactly. Sunday basically becomes Monday when you're dealing with China and the United States and trade. The president is now saying 80% is potentially the level it can come down from. The market was looking for 50, 60%. Is this just strategic uncertainty, or should we be preparing for a new level of 80%? That's a big question I have.
We've asked a few times, what can you expect on Monday morning from investors? And they sit there and kind of shrug their shoulders. They don't know what to look for this weekend.
There seems to be a dampening in just how much stocks respond to any potential theoretical number. Will there be enough of a relief rally that can be sustained even if there is just better tones around the talks? Or is there something substantive that needs to come? And I think that is the ultimate test for how far this rally can go.
Look for talks to kick off over the weekend. Coming up on Monday, reacting to that, Russ Kostrick of BlackRock, the former Trump White House trade official Kate Kalukowicz, Torsten Slok of Apollo, and Mira Pandit of JP Morgan Asset Management. To those of you worldwide, have a wonderful weekend. To those of you stateside, have a very happy Mother's Day. From New York City, thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
Welcome back to another Italian Open update for Bloomberg TV and radio from Tennis Channel. Iga Swiatek has lifted the trophy 3 out of the last 4 years in Rome, and the former world #1 got off to a terrific start as she dropped just a single game in her opener against Elisabetta Cocciaretto. Swiatek didn't face a break point in the victory, which was her 11th consecutive straight sets win in the Eternal City.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
And Davos, you were asking a question of President Trump, and he didn't quite answer the question, and he asked you a question. So the question he asked you was something like, why are you not banking certain groups? What is the answer? I don't think he gave you a chance to really answer that question, but what is the answer to that question?
Well, first off, the Bank of America has 70 million consumer customers and millions of small businesses all over the country, all over the world. And so we bank everybody. But the real question was about overregulation, frankly. And so as you look, what's happened is because the interpretations of AML, anti-money laundering, BSA, Bank Secrecy Act, KYC, know your customer, know your customer's customer. You know, there's a lot of burden upon the banking system to both report suspicious activity reports and do a lot of analysis. And we have to close accounts, so we can't tell people why we did it. And often we're told by authorities to close accounts. That creates confusion. Another area comes up in this discussion is in the crypto area where the regulator said you can't bank crypto operating companies, employees of crypto companies, et cetera. We are allowed to do, we bank everybody, but the operating company, they said that's a high-risk activity. Ask us for authority, and guess what? You would have never gotten the authority. So that came up as an issue. So at the end of the day, it's about getting these regulations right.
In case you missed it, on the China Show,
President Trump has called Wednesday Liberation Day, and that seems like liberation from the rules-based order on trade.
We're seeing a lot of orders being canceled, particularly on product being sourced out of China. There's a threat to seeing a shortage of certain products because, look, China's our #1 supplier of footwear. When I got this job 15 years ago, it was 88% of our volume to the U.S. It's now 56% of our volume. But the fact of the matter is, most of that volume
you see here when you talk to suppliers and buyers is that this essentially gives Asia and Africa to Chinese supply chains an influence, because now as American firms have to focus more on the home market, the companies and organizations with the money to invest in new areas, that will be mostly Chinese money.
don't miss the China Show live every weekday.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
Happy Friday before the talks in Switzerland. 30 minutes until the start of the cash trade. I'm Matt Miller.
And I'm Shonali Bassett. Katie Greifeld is off today, and Bloomberg Open Interest starts right now.
Coming up, President Trump floats an 80% tariff on China ahead of those crucial trade talks this weekend. Meanwhile, Bank of America warns the recovery in U.S. stocks is probably over despite all of the recent trade optimism. And we wrap up a busy week for central bankers with an exclusive interview with John Williams of the New York Fed. Shonali.
Let's take a look at some stocks to watch, Matt, because we are watching consumer-facing stocks really fluctuating after reporting results. Lyft is boosting its outlook, and you're seeing a rise of more than 10% this morning pre-market, though Expedia is cutting its guidance. You are looking at that stock down almost 10% this morning. A lot of concerns about the travel industry here, and Affirm has a disappointing forecast out for investors, down roughly 6% pre-market, Matt.
All right, we're talking about moving metal today as well. IAG is going to buy 32 Boeing jets for British Airways, its biggest order to date. Following yesterday's trade agreement between the U.S. and the UK, you can see Boeing shares are up only 1%, but still a gain. So a little bit of movement on that IAG order. Shonali?
And this weekend, Matt, the U.S. meets with Chinese officials in Switzerland, and the administration is considering a significant tariff reduction. Now, President Trump says an 80% tariff on China seems right, he says, but he says that it's up to Scott Bessent. Trade advisor Peter Navarro spoke on Bloomberg TV a little earlier about one advantage China has going into tomorrow's meeting.
They have continuity. The same people are going to be in Geneva were the same people back then. And you know, our regimes change. We have different governments and things like that. But they have the advantage of that kind of continuity. But look, it'll be interesting. Again, I don't want to get ahead of Scott and Jameson or the president.
Let's bring in our own Tyler Kendall in Washington to talk through expectations. Investors, Americans can appreciate, Tyler, that when it comes to China and negotiations with the second largest economic superpower here, it's a long road ahead. How much actual success is expected to come out of this weekend's meeting?
Yeah, hey, Shanali. So we're going to have to wait and see. Bloomberg Economics says that they are not expecting an immediate agreement or a permanent de-escalation at this point. Of course, the best case scenario here would be if both economies decide to lower their tariffs on a reciprocal basis. And while President Trump has said before that he would be interested in lowering tariffs on Chinese imports, saying that the current situation amounts to a trade embargo, to be sure, the 80% levy that he floated in that Truth Social post is a very prohibitive number and would likely keep U.S.-China trade still turned off. Now, we had been reporting this morning that if the talks went well, U.S. officials were thinking that China may be willing to match a tariff rate below 60% and that it could be implemented as soon as next week. It appears that they might have been tracking closer to where tariff rates were on so-called Liberation Day, where China was slapped with a 34% tariff stacked on top of a 20% tariff when it came to fentanyl concerns. But people familiar caution us that this is all still in flux. One thing is for sure, though, Shanali, which is that the U.S. is going to want to see some sort of concessions, and that could look like a range of things. It could be China potentially pledging to boost U.S. imports. It could be them tightening controls when it comes to fentanyl flows, or even maybe loosening curbs when it comes to critical and rare earth minerals. At this point, though, we're really just going to have to wait and see. This administration has been pushing forward that they are going with the strategy of strategic uncertainty.
Tyler, the president also has talked a little bit about, in the wishy-washiest, flippy-floppiest possible ways, raising taxes on millionaires. People who make more than $2.5 million a year, maybe getting their rate up to 39.6%. He said maybe Republicans shouldn't do it, but he'd be okay if they do. Maybe it lost George Bush Sr. the election, but it really didn't. What's the deal here?
Yeah, he appears to be trying to thread the needle, maybe walk the tightrope. Perhaps he got some pushback from some allies in his circle after he had said that he would be supporting that. President Trump previously saying that he would not support hiking tariffs because he would be afraid that wealthy Americans would leave the country. The issue at hand, though, is that they are having a difficult time getting through all of the tax cut priorities. Commerce Secretary Howard Lutnick was on Bloomberg television yesterday and said he would be in favor of this new tax bracket, but only if it meant that the administration also saw no taxes on tips, overtime pay, and Social Security. Those appear to be the three tax priorities that this administration is really pushing should be tied to reconciliation. But at this point, Republicans in both the House and the Senate are having a difficult time finding those spending cuts and those pay-fors to make it all happen.
All right, Tyler Kendall there talking to us about what's coming out of the White House off of Truth Social for the most part. China's latest export data shows a massive drop in U.S. trade. China's exports rose 8% in April despite a 21% drop in shipments to the U.S. It saw increased trade with other markets like India and Southeast Asia and the European Union bloc of countries. Let's discuss with Sean Donnan, Bloomberg senior writer for economics. And Sean, clearly this is something we can expect, right? Given that there's essentially an embargo between U.S. and Chinese businesses, there's not going to be a lot of shipments.
Absolutely. Look, I mean, this is the economic damage of the tariffs that's playing out in real time. And we're seeing this in what's happening at the docks in places like Los Angeles and Long Beach, where we know bookings are way down, that they're just not seeing the same volume of containers that they had been seeing coming in from China. So this is the first sign, really, of the impact on trade of these tariffs. But, you know, that really captures only the first few weeks of the tariffs, and they're going to be around and with us for a while.
Sean, you wrote that even a dramatic de-escalation is unlikely to ease much pain for American consumers. So you look at that rate that could go down to 80% when it comes to China. But if you look at the Chinese economy as well as the U.S. economy and compare them and the type of pain that they're experiencing as these talks are hashed out, what does it say about the relative power in these negotiations?
Look, I think both sides are going into this weekend thinking that they've got the upper hand. But what we've seen pretty dramatically play out over the last month is just how dependent the U.S. economy is on imports from China and how damaging, you hear this from businesses almost daily, it feels like nowadays, how damaging losing access to those imports is going to be for the U.S. economy. So, you know, the Chinese have a pretty strong hand here. On the other hand, China is still an export-driven economy. It's not dependent on domestic consumption like the U.S. And so if its exports to one of its main overseas markets are taking a hit, that's clearly going to hurt it as well. I think the key point to remember here is even if we get a de-escalation this weekend, even if tariffs come down, and the number that I was hearing in recent days was somewhere below 60%, that is still an astronomically high tariff level in historical perspective, and that's still going to do significant economic damage. In fact, it's unclear that if you get to 60%, if you get to 54%, even if you get to 30%, that is really going to solve the so-called empty shelves problem that we're thinking about more and more, and that is consumers getting worried that losing access to Chinese imports means we're going to be back to the kind of supply chain concerns that we saw during the pandemic, and some of that economic angst returns, and we slow down and kind of buckle up because these things aren't going away.
Sean, we're looking forward to your coverage after this weekend. That is Bloomberg's Sean Donnan. Now, British Airways owner IAG is announcing its largest order yet of wide-body jets. That includes jets from Boeing and Airbus, the investment totaling $10 billion. And for more, we're going to bring in Bloomberg's Benedict Kamel, who leads our global aviation coverage. Is this a significant win for Boeing, given all the changes that we are seeing? Of course, they and Airbus got some of these orders.
Yeah, it's a very important win for Boeing. It's a psychologically important win for them. Remember, they've had a tough couple of weeks given what's been going on in China. China has essentially barred the import of Boeing aircraft. Some that were already there have been sent back, so that's painful. So winning this order now was obviously very good. It was also very good timing because this was announced yesterday in the Oval Office as they were hammering out this US-UK trade deal. It's fair to say that this deal with IAG, with British Airways, probably came long before that. These things take months to put together, particularly at this kind of size. But it was obviously, very good timing. It looked like there was a direct connection there. And for Boeing, this was a good day news.
What does the supply chain look like right now, Benny? I'm wondering not only about how quickly they can produce these or if they have them sitting on a lot already, these planes, but also how many of the parts in a typical Boeing product come from overseas?
Well, if you look at the 787, the Dreamliner, that's the plane that IAG ordered. That really is assembled from parts coming from all over the world. There are parts that come from Italy. There are parts that come from Japan. There are aerostructures that come from Canada, from Mexico. They are sort of the final assembly is in the US, but yes, with parts from all over the world, and that is a huge problem. Kelly Ortberg, the Boeing CEO, he has said he is really concerned about the fragility of the supply chain, which has been fragile ever since COVID, and it was just sort of on the mend. The company was on the mend, and he's worried that these tariffs will sort of pull them back, all the good work that they put into the factory floor, into the supply chain in the last couple of months, that will basically get destroyed. So that's a real concern for the company.
All right, Benny, thanks so much for joining us. Bloomberg's Benedict Kamel covering airlines and plane makers for us out of Berlin. Coming up, we're going to head to Reykjavik, to the economic conference in Iceland. Bloomberg's Francine Lacroix is in Iceland, and she'll bring you an exclusive interview with the New York Fed President, John Williams, on this Friday. We're looking at gains in futures. Just about 19 minutes until the start of the cash trade. This is Open Interest. Start your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets
with the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
What is the issue between the type of information that's being collected by investors and the marking issue that you're describing?
But what mark-to-market assets do is it forces honesty into the situation. We're talking right after the DeepSeek model surprised everybody in its efficiency. It took hundreds of billions off of market caps because it legitimately raised concerns that maybe the future of AI was different. I guarantee you that if you look at other portfolios that aren't marked, they didn't move. If private assets are going to eat the world, as they say, with the equity market halving in the number of names, you come to a world that is increasingly an echo chamber. Imagine you have a firm that has some public assets and some private assets. If you see your public assets in AI going down by 20%, you're going to be thinking very, very deeply about what your private assets are worth differently than someone who just has the latter.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg. Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
A short time ago, the Federal Reserve Bank of New York President John Williams said keeping inflation expectations anchored near policymakers' target forms the bedrock of central bank policy. A warm welcome to all of our TV viewers, but also to our radio listeners. We're here in Reykjavik, and I'm delighted to be joined by President Williams. Thank you for joining us. I mean, there's a dual mandate at the Fed. We all heard also Jay Powell on the FOMC not cutting rates. You're putting firmly the focus on inflation. Why now?
Well, first of all, we do have a dual mandate of maximum employment and price stability, and these are both very important. But one thing we learned from history is that, having well-anchored inflation expectations, having the public have confidence that regardless of whatever's happening today, that inflation will come back to 2% and that we'll make sure that happens is very important for price stability and also for economic stability. It helps actually, it actually helps reinforce our ability to achieve both of our goals. And